I have emphasized in the preceding chapters that capitalist growth is driven by net profitability, i.e., by the excess of the rate of profit over the interest rate. This was the key to the theories of growth, unemployment, and inflation in chapters 14 to 16, respectively. Here I will extend the same principle to account for the two crises of the post-war period, the stagflation crisis of the 1970s and the current global crisis that began in 2007. Since modern chain-indexed output and capital series do not go back far enough, it is not yet possible to generate comparable data to cover the decades leading up to the Great Depression. I will therefore begin with an analysis of the patterns and determinants of the post-war general rate of profit, drawing on the empirical measurement of aggregate net output, profit, capital stock, profit rate, and capacity utilization developed in Chapter 6 and Appendices 6.1 to 6.8. After that I will address the interest rate, the corresponding net rate of profit, the total amount of real profit of enterprise, and the wage share. The neoliberal attack on labor in the 1980s that created a structural break in the wage share curve, Chapter 15, Section 6, served to reverse the long downward trend of the normal rate of profit. This was in fact its purpose. Meanwhile, the great policy-induced fall in the interest rate served to sharply raise the net rate of profit and greatly facilitate debt-financed spending in all quarters. The consequent boom was, therefore, both real and financial, racing past all sustainable levels toward the inevitable crash. Both the boom and the crash, it should be emphasized, were global. Appendix 16.1 describes sources and methods, and Appendix 16.2 contains the data tables. 2. Profitability in the post-war period. 1. Normal and actual profit rates. It was pointed out in Chapter 6, Section 8, Equations, 6.12, and 6.13, that the profit rate can be decomposed into structural and cyclical factors. The actual profit rate can be written as the product of the profit share and the output, capital ratio, with the latter expressed as a product of the capacity, capital ratio and capacity utilization rate, where the profit share, normal capacity net output, the rate of capacity utilization, and the capacity, capital ratio, which is the structural maximum rate of profit in the sense of SRAFA. Since when output is at normal capacity, the normal profit rate can be written as the product of the normal profit share calculated as its HP filtered trend, and the capacity, capital ratio. All the measures were previously developed in Chapter 6 and Appendices 6.1 to 6.8. Figure 16.2 displays the actual and normal values for the maximum profit rate, R, the profit share, and the average profit rate, R. All data is on a log scale so that the slope of each curve represents its growth rate. It is immediately apparent that the normal maximum profit rate falls steadily throughout the post-war period, that is, technical change is consistently capital biased, Chapter 7, Section 7. The normal profit share is another matter. It is essentially stable in U.S. labor's golden age from 1947 to 1968, falls during the stagflation crisis of 1969 to 1982, rises considerably during the neoliberal era starting in the 1980s and then retains its high level during the global crisis that begins in 2007. This is consistent with the empirical evidence on the corresponding downward shift in the wage share Phillips curve and the continued downward movement along this new curve shown in Chapter 14, Figure 14.14. The combination of a continuously falling wage share and large fiscal deficits dramatically raises the profit share even during the crisis. The end result is that the normal profit rate falls during the golden age, falls faster during the stagflation crisis, then begins to flatten out during the neoliberal era right through the current crisis. Table 16.1 summarizes the growth rates of the normal levels of each of the variables. It is clear that technical change steadily erodes the level of the normal profit rate in all three periods, and that it is only in the neoliberal era that a rising normal profit share, steadily decreasing normal wage share, is able to counteract the effect of the steady fall in the normal maximum profit rate and negate the trend of the normal rate of profit. It is important to keep in mind that actual profit measures are subject to many fluctuations and can be greatly influenced in the short run by particular historical events. For instance, the run-up in all measures during the 1960s reflects the impact of deficit-financed expenditures of the Vietnam War and Johnson's Great Society. However, in the long term, structural factors predominate. These include the secular increase of the profit share during the neoliberal era arising from a structural decline in the strength of labor, Chapter 14, Section 6. 2. Productivity and real wages. Figure 16.3 depicts the relation between hourly productivity and hourly real compensation, real wages, in the U.S. business sector from 1947 to 2008. Real wages tend to grow more slowly than productivity even under normal circumstances, but starting in the 1980s in the Reagan era real wage growth slowed down considerably. This is evident if we compare actual real wages from 1980 to the path they would have followed had they maintained their post-war relation to productivity. This departure from their historical trend was brought about through a two-pronged strategy: attacks on private and public institutions that supported labor and a surge in globalization which brought the world's large pool of cheap labor into more direct competition with labor markets in the developed world. 3. Impact on profitability of the suppression of real wage growth. Figure 16.4 depicts the salutary impact on profits of the suppression of real wage growth. It shows the actual profit rate as well as the counterfactual path it would have followed had business real wages maintained their post-war relation to business productivity. The repression directed against labor beginning in the Reagan era had the clear effect of reversing the post-war pattern of profitability. 4. Rate of return on average capital versus new investment. Figure 16.5 compares the average corporate rate of profit, which is also a real rate, with the lagged value of the HP-smoothed corporate current, real, incremental rate. The two follow similar paths, both drift downward in the immediate post-war decades, both benefit greatly from the Vietnam War/Great Society boost. See the effect on the rate of capacity utilization depicted in Appendix 6.6, Figure 6.6.1. Both fall thereafter, and both increase in the neoliberal era, although the incremental rate responds more to the boost provided by the dot-com bubble of the 1990s. 5. The extraordinary post-war path of the interest rate. The secular post-war decline in average and incremental rates of profit was reversed in the 1980s by means of an unparalleled slowdown in real wage growth. But this is only part of the explanation for the resulting great boom, for at the same time there was an extraordinary fall in the interest rate that greatly increased the net rates. Figure 16.6 tracks the 3-month T-bill interest rate in the United States, as well as the GDP deflator depicted as a dotted line, right scale. In the first phase from 1947 to 1981, the interest rate rose 24-fold, from 0.59% in 1947 to 14.03% in 1981. In the second phase, from 1981 onward, it fell equally dramatically, going from 14.03% to a wispy 0.06% in 2011. Note the co-movement until the 1980s between the price level and the interest rate, Gibson's law, whose connection was theoretically derived in Chapter 11, Section 6, and displayed in Figure 11.6. This relation held until monetary policy severed the connection and forced the interest rate to fall beginning in the early 1980s. The Volcker shock is often credited with ending inflation by sharply raising the short-term interest rate from 10% in 1979 to a peak of 14% in mid-1981, and the prime rate from 11.2% to of 20%. 4 things are relevant here. First of all, we can see from the dotted line representing the price level that the interest rate shock may have slowed inflation but did not end it. Second, although U.S. Federal Reserve Chairman Volcker did indeed raise interest rates sharply for a short time, these rates had been rising along with the price level for the prior 3 decades. Third, he himself reversed the direction of interest rates and initiated the downward trend that was continued by his successors. Finally, the same long post-war swings in interest rates obtained in most major capitalist countries. Figure 16.7 shows the U.S. interest rate to alongside a weighted average of major OECD countries from 1960 to 2011, demonstrating that from the 1980s onward policy-induced decreases in interest rates were characteristic of the whole capitalist center. With short-term interest rates hovering around zero, there is no further room to maneuver on this front. As of 2011, the U.S. rate stood at 0.0006, i.e., 0.06%, and the Federal Reserve attention shifted to attempting to lower longer-term rates through quantitative easing operations QE1 and QE2. Given that the wedge between long and short terms is the basis for banking sector profits, Chapter 10, Section 2, such initiatives are constrained within profitability limits. 6. The rate of profit of enterprise and the great boom after the 1980s. We can now put these elements together. The real net rate of profit is the central driver of accumulation, the material foundation around which the animal spirits of capitalists frisk, with injections of net new purchasing power taking on a major role in the era of fiat money, Chapter 15. Figure 16.5 showed that the real average and incremental rates of profit were pulled out of their secular decline by neoliberal policies in force from the early 1980s, which slowed the rate of growth of real wages relative to productivity and raised the profit share. Figures 16.6 and 16.7 showed that U.S. and global interest rates fell sharply after 1982. Combining the two gives us the net rates of profit displayed in figure 16.8. We now see two things. First, that the stagflation crisis of the late 1960s was precipitated when both rates sank to unprecedented lows. The whole behavior of the system changed at this point, growth slowed, bankruptcies and business failures soared, unemployment rose sharply, real wages fell relative to productivity, and the stock market fell by over 56% in real terms, about the same as it did in the worst part of the Great Depression. In proper Keynesian response, the federal budget deficit increased by 40-fold compared to its average level in the preceding portion of the post-war period, Shaikh 1987a, 120 to 123. And we know, of course, that inflation rose hand in hand with unemployment, Chapter 12, Figure 12.6. The historical solution to this crisis was an attack on labor and a great reduction in the interest rate. Both of these worked to substantially increase profitability, making the real average and incremental rates rise dramatically. This is the real secret of the great boom that began in the 1980s, cheapened labor and cheapened finance. The great boom was inherently contradictory. The dramatic fall in the interest rate set off a spree of borrowing, and sectoral debt burdens grew dramatically. Households, whose real incomes had been squeezed by the slowdown in real wage growth, were offered ever cheaper debt in order to maintain growth in consumer spending. In consequence, as shown in figure 16.9, the household debt-to-income ratio grew dramatically in the 1980s, which added fuel to the boom. Higher debt loads normally imply higher debt service, principal and interest, burdens. But for 2 decades falling interest rates offset rising indebtedness, so that even in 2000, the household debt service ratio was no higher than it was in 1985, figure 16.10. However, as the debt load accelerated, the debt service ratio began to rise sharply. The average net rate of profit shown in figure 16.8 fell from 2004 to 2007, and the net incremental rate, shown lagged by 1 year, fell even more sharply from 2005 to 2009. In the interim, the collapse of the subprime mortgage sector in 2007 triggered a general crisis that spread rapidly across an already fragile global economy. Then debt loads began to fall, and given that falling interest rates were still falling, debt service ratios fell dramatically, figure 16.10. Finally, it is striking that in the midst of a major global crisis, profit rates have risen, figure 16.5, and net rates have risen even more, figure 16.8. This is due not only to the ongoing reduction in real wages relative to productivity, but also to the fact that governments all over the world have infused staggeringly large sums of newly created money into the coffers of banks and businesses. 3. The global effects of the current crisis. 1. United States. The global crisis took most academic economists and central banks by complete surprise. In the United States, the Fed's track record is out and out abysmal, Isinger 2013. It actively inflated the credit bubble between 1982 and 2007, figure 16.9, and then utterly failed to anticipate its consequences. And when it did step in to flood the market with money, its principal concern was to keep banks and big businesses afloat through public bailouts and interest-free loans. Inflation in commodity prices was checked, but inflation in asset prices continued apace. The net worth of the top 7% of U.S. households actually rose in the first 2 years of the recovery, while that of the bottom 93% declined. Unemployment rose and median income fell back to the level of 1999. And, of course, a passive Justice Department let banks and top executives escape penalty, Isinger 2013. Taking care of business, one might say. Financial markets, unrestrained and unpunished, are naturally returning to their old ways. The alchemists of Wall Street are at it again, according to a recent report in the New York Times. The banks that created risky amalgams of mortgages and loans during the boom, the kind that went so wrong during the bust, are busily reviving the same types of investments that many thought were gone for good. Once more, arcane-sounding financial products like collateralized debt obligations are being minted on Wall Street. With interest rates on ultra-safe treasury bonds near zero, investors are attracted to the higher returns promised by risky assets, so banks are turning out some types of structured products as fast or faster than they did before the bottom fell out, and supposed protections against a repeat of the previous disaster are already dwindling, allowing some of the old excesses to creep back into the market. Thanks to the lax penalties imposed on previous offenders, the players in the business are generally the same as they were before. And they know how to push the boundaries, Popper 2013. 2 other developed countries. Countries like Norway and Canada had been circumspect in their treatment of financial markets and have therefore avoided some of the same difficulties. But they still face unemployment due to the contraction in world exports. Canada's household debt ratio was high before the crisis and had risen to 160% by 2012. According to the IMF, Canada's economic prospects are tilted to the downside. 6. Iceland was hit very hard by the global financial crisis because its bankers had run up foreign debts that were many times its national income. The 3 largest banks collapsed, as did the currency, and the economy plunged into recession. Iceland was not yet in the Eurozone, so it was able to sharply devalue its currency, which raised exports and cut imports, and most importantly, sharply reduce real wages, Krugman 2011. Most important, by letting its bank default and making their foreign creditors absorb large losses, the country took a lot of foreign debt off its national books. As a result, it has fared comparatively well. By contrast, the Irish government stepped in to protect its banks, shifted their debt to the state, and imposed its burdens on the population, Krugman 2011. The number of unemployed in Ireland rose from 106,100 in the third quarter of 2007 to 324,500 in 2012. Jobless households increased from 15% to 22%, and the number of underemployed rose from 4,100 in 2006 to 145,800 in 2012. Poverty shot up, and nearly 25% of households had fallen into arrears on bills or loans by 2010.7. Unlike Iceland, Ireland was already in the Eurozone, so it could not seek any relief from currency devaluation. 8. Britain joined the European Union but retained its own currency. At the time of the crisis, its sovereign debt stood at around 36% of GDP, and by 2012 this had climbed to 65%. The economy contracted by more than 6% in that first year, and after 4 years it remains in the longest slump in more than a century, worse than the 70s, more severe than the Great Depression of the 1930s. 9. The unemployment rate soared from just over 5% to over 8%, where it remains. Consumer debt remains high, and credit card debt is widespread. Greece, Spain, and Cyprus experienced even more severe economic problems. The creation of the Eurozone gave all of its members equal access to international credit despite their evidently unequal economic status. By the middle of the 2000s, Greek bonds, Irish bonds, Spanish bonds, Portuguese bonds, all traded as if they were as safe as German bonds. The aura of confidence extended even to countries that weren't on the euro yet but were expected to join in the near future. In 2005, Latvia, which at that point hoped to adopt the euro by 2008, was able to borrow almost as cheaply as Ireland. As interest rates converged across Europe, the formerly high interest rate countries went, predictably, on a borrowing spree, which was largely financed by banks in Germany and other traditionally low interest rate countries. In Ireland, it was private banks that borrowed heavily, while in Greece the big borrower was the government. In Cyprus, the banking sector was also allowed to expand beyond all proportion, lending heavily to Greece and become a refuge for hot Russian money. Cheap debt led to huge real estate booms, particularly in Ireland and Spain, and money even flooded into Estonia, Latvia, Lithuania, Bulgaria, and Romania, milm 2013. In turn, Germany's economy, which was actually in the doldrums in the late 1990s, experienced an export boom driven by its European neighbors' spending sprees, Krugman 2011. And then the bubble burst in 2007. Unemployment and poverty shot up in all major countries. Governments reduced state employment and cut programs designed to help people even as they expanded programs to help banks and big businesses. The Eurozone has now become a zombie zone. People are being held to ransom by banks, bondholders, and corporations determined to ensure that it's not they who bear the costs of the crisis they created, and politicians who regard it as their job to oblige them. milm 2013. George Soros has warned that the continuing crisis is pushing the EU into a lasting depression. 10. In post-war Japan, the state worked closely with big business to manage growth and enhance international competitiveness. In the 1980s, while Western capitalism was suffering through the Great Stagflation, the Japanese economy was racing ahead at almost double the rate of growth. But its rate of profit was also falling steadily throughout. Shaikh 1999, 110, figure 111, and its export surplus provoked the ire of the United States. Forced to accept a sharp revaluation of its nominal exchange rate in 1985 under the so-called Plaza Accord, which however did not have a lasting effect on its real exchange rate or export surplus, Japan unleashed the floodgates of bank liquidity. Real estate prices shot up to such a point that at their peak in 1991, all the land in Japan, a country the size of California, was worth almost 4 times the value of all property in the United States at the time. Hackler 2005. In the process, the net worth of Japanese companies became higher than the net worth of US companies, and the Japanese stock market doubled. And then in the 1990s, the bubble began to deflate. Harman 2010, 211 to 216. But it was not allowed to burst. Instead, the Japanese interest rate was steadily reduced until it was 1% by 1998, 5 years before the United States was to make the same move. The economy never collapsed, but also never recovered. It remains mired in debt and trapped in stagnation. In what was conceded as a radical gamble, the Bank of Japan announced in mid-2013 that it planned the world's most intense burst of monetary stimulus, promising to inject about $1.4 trillion into the economy in less than 2 years, Kiera and White 2013. And then there are India and China, who shot into view with growth rates similar to Japan's early ones, only to slow down in the face of commodity inflation and housing bubbles. India now struggles with sharply slowed growth, high interest rates, a weakening job market, and rising prices. Bowler 2013. China resorted to a massive credit stimulus in 2008 and now contends with rising prices, overextended credit, and a collapsing housing bubble manifested in huge excess capacity in many key industries and ghost cities, empty apartment buildings and unused convention centers, Chandrasekhar 2013. Adding insult to injury, the official reserve managers of central banks, the most conservative of souls, have started buying gold as a way to offset their existing reliance on the US dollar. 11 Indeed, economics Nobel laureate and godfather of the euro Robert Mundell has endorsed a return to a kind of Bretton Woods type of gold standard where the price of gold was fixed for central banks and they could use gold as an asset to trade central banks. 12.3 Global scale. In the neoliberal era, cheap finance became a way to expand employment through finance-related activities like real estate booms, export-led growth, foreign remittance growth, and so on. The crisis put an end to most of that. It is estimated that there are now almost 200 million people in the world without jobs. Youth unemployment is particularly high, comprising almost 74 million young people at an unemployment rate that stood at 12.6% in 2014 and is expected to increase. These are official unemployment rates, which greatly understate the true state of affairs since they do not properly account for part-time employment and the discouraged. Correcting for this would imply a true global unemployment rate of almost 23%. 13 Finally, on a world scale almost 900 million workers live in dire poverty, ILO 2013. 4 Policy lessons and possibilities, austerity versus stimulus. All advanced countries have automatic stabilizers such as unemployment compensation and welfare expenditures that kick in during a downturn. But these were meant for recessions, not depressions. So as the current crisis has unfolded, governments all over the world have scrambled to save failing banks and businesses, often creating staggeringly large sums of new money in the process. They have been far less enthusiastic about creating new forms of spending to directly help workers. And even on the issue of deficit spending there exists a deep policy divide between those who focus on the employment effects of fiscal deficits and those who focus on their, theoretical, inflationary consequences. In the United States, the employment effects were central to policy in the 1930s while inflation became central in the 1970s. In Germany, hyperinflation hit first in the 1920s and the employment boost came later through Hitler's massive national armament in 1930s. European central bankers tend to be averse to deficit spending because they fixate on the searing memory of the German hyperinflation of the 1920s and of its devastating social and political consequences. These policy divisions were clearly visible at the G20 meetings in Toronto in June 2010. On one side was the orthodoxy, which pushed for austerity, which is a code word for cutbacks in health, education, welfare, and other expenditures that support for working people and their families. Jean-Claude Trichet, head of the European Central Bank, said at these meetings that the idea that austerity measures could trigger stagnation is incorrect. Governments should not become addicted to borrowing as a quick fix to stimulate demand. Deficit spending cannot become a permanent state of affairs, said German Finance Minister Wolfgang Schäuble. Their theoretical stance is rooted in a vision of near-perfect markets quick to recover from a shock and quick to provide employment to all who desire it, while their practice is aimed at protecting and preserving big business. After 2007, corporate rates of profit not only recovered but even rose to new heights. And for some investment banks, money has been like oil spilled in the Gulf of Mexico, just waiting to be schemed off the top. In 2010, Goldman Sachs' first quarter earnings were $3.3 billion, double of that the year before, making that the second most profitable quarter since they went public in 1999. Happy days are here again. Finally, there is the practical question of the potential benefits for European capital of austerity programs. European labor survived the neoliberal era in better shape than US and British labor, which is to say that its wages were not driven down to the same extent. From this point of view, the global crisis provides the perfect cover for a renewed push to make Europe more competitive by reducing unit labor costs, wage share. The possibility that austerity may make things much worse for the bulk of the population becomes an acceptable risk if it weakens a hitherto resistant labor force. The American side at the G20 meetings expressed a different set of concerns. In the United States alone, household wealth had already fallen by trillions of dollars and new housing sales were below 1981 levels. Moreover, the International Labor Organization had warned that a prolonged and severe global job crisis was in the offing, something which would have to be taken very seriously by an imperial power already tangled in multiple wars and global police actions. Finally, there was a critical matter of historical differences between the Germans and the Americans. President Barack Obama urged EU leaders to rethink their stance, saying that they should learn from the consequential mistakes of the past when stimulus was too quickly withdrawn and led to renewed economic hardships and recession. 14 The consequential mistakes to which Obama refers had to do with events in the 1930s. The Great Depression, triggered by the stock market crash in 1929, led to a sharp fall in output and a sharp rise in unemployment from 1929 to 1932. But over the next 4 years output grew by almost 50%, the unemployment rate fell by a third, and government spending grew by almost 40%. Indeed, by 1936 output was growing at a phenomenal 13%. The rub was that federal deficits rose to almost 5% of GDP. So in 1937, under pressure from conservatives, the Roosevelt administration increased taxes and sharply cut back government spending. 15 Real GDP promptly dropped, and unemployment rose once again. Recognizing its mistake, the government quickly reversed itself and raised government spending and government deficits substantially in 1938. By 1939, output was growing at 8%. The United States began a military build-up in anticipation of a possible war only after that, and was not fully engaged until 1942. There are several lessons that can be learned from these episodes. First, cutting back government spending during a crisis was a consequential mistake. This is Obama's point. Second, it is absolutely clear that the economy began to recover in 1933, and except for the administration's misstep in cutting government spending in 1937, continued to do so until the U.S. build up to World War II in 1939 and its full entry in 1942, Pearl Harbor being December 7, 1941. It is therefore wrong to attribute the recovery, which had begun 9 years before the war, to the war itself. The war further stimulated production and employment. Third, it is nonetheless correct to say that even during peacetime, government spending played a crucial role in speeding up the recovery. Fourth, the government spending in question did not just go into the purchase of goods and services. It also went toward direct employment in the performance of public service. In the United States, the Work Projects Administration, WPA, alone employed millions of people in public construction, in the arts, in teaching, and in support of the poor. On the German side, Hitler's large rearmament program quickly attained full unemployment, partly centered on a huge expansion of military employment, Wapsha 2011, 189. Both the Germans and Americans now choose to forget these direct employment measures. We know that government spending can greatly stimulate an economy for a considerable length of time. This is evident during times of war, which are most often accompanied by massive deficit-financed government expenditures. In World War II, for instance, from 1943 to 1945 the U.S. budget deficits averaged 25% of GDP. By contrast, the federal budget deficit in the United States in 2014 is less than 3%. The important point is that war is a particular form of a social mobilization which serves to increase production and employment. In such episodes, some part of the resulting employment is derived from the demand for weapons and other supporting goods and services and the induced demand which this in turn engenders. But another part is direct employment in the armed forces, government administration, security, maintenance, and repair of public and private facilities, and so on. So even during a war we have to distinguish between two different forms of economic stimuli, direct government demand which stimulates employment provided that businesses do not hold on to most of the money or use it to pay down debt, and the direct government employment which stimulates demand provided that the people so employed do not hoard the income or use it to pay down debt. The same two modes could equally well be applied to peacetime expenditures through a social mobilization to tackle the crisis. In the first mode, government expenditures are directed toward businesses and banks, with the hopes that the firms so benefited will then increase employment. This is the traditional post-war mode: stimulate business and let the benefits trickle down to employment. In the second mode, the government directly provides employment for those who cannot find it in the private sector, and as these newly employed workers spend their incomes, the benefits rise up to businesses and banks. The requirement that monies received be respent is a crucial one. Huge bailout sums have been directed in recent times toward banks and non-financial businesses in every major country of the world. Yet these funds have most often end up being sequestered. Banks use them to shore up their shaky portfolios and industries use them to pay off debts. Quite correctly, neither sees any point in throwing this good money after bad in a climate in which there is little hope of adequate return. Thus, while the bailouts have shored up the existing structure, not much has trickled down as additional employment. But if the second mode were to be employed, the matter is likely to be very different. The income received by those previously unemployed has to be spent, for they must live. The second mode therefore has two major advantages: it would directly create employment for those who need it the most, and it would generate a high trickle-up effect for businesses who serve them. What then prevent governments from creating programs for direct employment? The answer is that such actions would subordinate the profit motive to social goals, which is seen as a threat to the normal capitalist order. Direct employment would also interfere with the neoliberal agenda of lowering wages relative to productivity wages through actual and threatened unemployment. The latter pressure has been central to maintaining profitability from the 1980s into the crisis itself. The state could, of course, try to maintain a balance between employment and profitability by intervening to directly augment productivity growth. This would not be new, as the history of any developed country will attest, Chang 2002a. But as a means of supporting labor, it is likely to get significant resistance from national capitals and from international agencies such as the IMF and the World Bank, who are currently aligned against interference in business operations. The laissez-faire tradition lies at the other end of the current policy spectrum. For instance, David Stockman, formerly the director of the Office of Management and Budget for Ronald Reagan, believes that while the Fed's relentless campaign to keep interest rates artificially low may have deferred the day of reckoning, we cannot escape it forever. According to Stockman, cheap money is the heroine of the modern economy, and financial markets have become debt-driven engines of speculation. In his view, the big crash is yet to come, so investors should get out of the markets and hide. Stockman acknowledges that unregulated markets are prone to periodic purges of excess and error, but he feels that intervening to modulate these intrinsic patterns only makes matters worse. Surowiecki 2013. He proposes a return to the gold standard because it limits the money creation options of central banks, and he advocates the enforcement of biennial balanced budgets and an end to Keynesian efforts to maintain desirable levels of employment. In the latter case, the free market would be in charge of job creation, and if there weren't enough jobs, wage rates would tend to fall until there were enough jobs to balance supply and demand. Notice the explicit commitment to orthodox economic theory here. He would also eliminate the minimum wage and abolish health insurance, social insurance, business subsidies, and bailouts. On the other hand, he would have the state maintain a watch over a proper banking system, to be completely separated from investment banks which would be put out in the cold to compete as enterprises on the free market, and over a means-tested safety net, in which any citizen wanting aid from the state would be subject to a strict and intrusive means test, including the spend-down of all assets to some minimum level. Stockman 2013, 706, 712. The discussion of the policy spectrum raises certain key issues. Demand stimuli can permanently elevate the levels of output and employment even if they only temporarily increase the growth rate, Chapter 13, Section 4. They may also increase the growth of real wages. In normal times, the upward pressure on unit labor costs gives employers an economic incentive to speed up productivity growth and to increase immigration and labor participation rates. Hence, the wage share will generally rise to a lesser extent than real wages, Chapter 14, Section 3. But in times of crisis, things are different. What matters most to workers is remunerative employment even at somewhat reduced real wages, and what matters most to businesses is profitable sales even at somewhat reduced profit margins. Stockman is right to say that the market would eventually handle these matters, but Keynes is right to say that this is not good enough because the process would take too long, could be hugely destructive, and would not in any case guarantee full employment. Post-Keynesians are correct to say that in a period in which there is excess capacity, additional demand can raise both employment and profitability. Thus, in a time of crisis, there is need for the state on both sides of the equation, maintenance of the business structure and maintenance of the employment structure. Neither can be done without interfering in the normal activities of businesses and unions, or without penalty for the misdeeds of any of the sides, including, of course, the state. This is politically difficult, needless to say. But it is hardly impossible. Indeed, it is typically the agenda in a time of war. Normal times are different, because then capacity utilization is regulated by its normal level. Then the inverse relation between the wage share and the profit rate comes to the fore. This is not merely a classical argument, for even Keynes rejected the notion that capacity utilization could be a free variable over the long run and conceded that unemployment would erode real wages, which was relevant precisely because the consequent rise in profitability would spur growth and reduce unemployment. Point 16. The classical argument differs from the Keynesian one on the ground that in normal times the unemployment rate also ceases to be a free variable, being now regulated by a normal rate of involuntary unemployment, a normal reserve army of labor. This arises from the workings of competition itself, not from imperfections to which neoclassicals point. Keynesians claim that the unemployment rate is a free variable that can be brought to a socially desired level, albeit at the expense of some inflation. The classical argument is that a given structural balance of power between labor and capital will lead to some normal rate of unemployment. Pumping up aggregate demand will certainly reduce the actual rate of unemployment, but as this falls below the normal unemployment rate, the wage share will start to grow and the profit rate will fall relative to the trend imposed by the maximum rate of profit. At some point, this will slow down growth, and the unemployment rate will rise again. Hence, it would take an increasing growth stimulus to maintain an unemployment rate below the normal rate, Chapter 15, Section 7. This need not translate directly into inflation, let alone into the hyperinflation whose specter haunts central bankers. But it will tend to raise the wage share and lower the rate of profit. The accumulation rate depends on the difference between the profit rate and the interest rate, and insofar as the profit rate, which is also the maximum sustainable growth rate, falls relative to the growth rate, the growth utilization rate will rise and the economy will become more inflation-prone, other things being equal. Whether or not this gives rise to actual inflation will depend on the rate of creation of new purchasing power. Finally, the normal rate of unemployment can itself be lowered by changing the wage share Phillips type curve, as was done in the United States in the 1980s. So in addition to the standard list of fiscal and monetary policies, we might add the following. First, policies that lower the interest rate relative to the rate of profit will increase the growth rate and reduce the unemployment rate, while at the same time reducing the inflation potential by lowering the growth utilization rate, effectively what central banks did across the developed world for more than 3 decades in the wake of the stagflation crisis. Of course, while this kept inflation low, it also spawned a global financial bubble. Second, increases in the wage share can be kept in check. This could take the form of restraining wage growth and/or enhancing productivity growth, as was done in a variety of countries during their development process. Such direct interventions might also shift the wage curve toward a lower normal rate of unemployment. Alternately, a state-led attack on labor combined with accelerated globalization as undertaken in the United States and the United Kingdom in the 1980s would have same effect, albeit with different social consequences. In this regard, one might say that the state acted to support labor in the Great Depression but to attack it in the Great Stagflation. And now the issue has surfaced once again. Depressions recur. By the same token, recoveries also recur. So it is useful to end with the consideration of some longer-term implications of a return to normal times. I have focused in this book on the dynamics of the advanced countries in the strong belief that this is a necessary starting point for the analysis of development and underdevelopment on a world scale. For instance, the analysis of international competition provides a direct pathway to the latter issue, as does that of the macroeconomic relation between growth, aggregate demand, profitability, and inflation. The theory of unemployment is particularly relevant. I have argued that national relations between wages, productivity, and profitability lead to a persistent national rate of unemployment. From the point of view of the system as a whole, these national pools of unemployed workers add up to a global reserve army of labor. Businesses have always known this. Even before the crisis, it was estimated that in 2005 there were 192 million people unemployed in the world. This is an official measure that fails to adjust for part-time employment and ignores all those that are discouraged to participate in labor markets for whatever reason, ILO 2006, 2 Text and N4. As noted earlier, a spaced adjustment for the missing components would raise this 1.8 times to roughly 350 million people. A similarly corrected pool in the midst of the crisis stands at 360 million, in large part because robust employment growth in China and India has so far offset employment slowdowns in the West. So the question becomes, will a recovery substantially diminish this pool of unemployed labor? I would argue that it will not, because even as the demand for labor is increased by output growth, it is simultaneously decreased by ongoing productivity growth. The whole point is that individual capitals must increase productivity in order to lower their unit labor costs so that they compete effectively and continue to grow. The pre-crisis pool is a testament to this combined effect. On the role of economic theory. I end by returning to the main theme of this book, which is that theory is important to an understanding of the economy. Modern orthodoxy and post-Keynesian heterodoxy share an imperfectionist approach to the workings of capitalism. Orthodox economics starts from perfect competition, Say's law, and full employment and then arrives at the real effects of money and aggregate demand by throwing a bucketful of grids into the machinery of perfect competition, Snowden and Vane 2005, 365. Post-Keynesian economics starts directly from Keynes's law and underemployment and uses imperfect competition to provide a foundation. I have taken a different path. I start from the theory of real competition and use it to ground theories of aggregate demand and persistent unemployment with profitability playing the dominant role at micro and macro levels. I have argued that this is in fact the appropriate foundation for Keynes's theory. And at each step, I have tried to address the relevant empirical evidence so as to keep the attention focused on the real patterns of this turbulent and dynamic system rather than on theoretical debates. 17. Summary and conclusions. Introduction. The simple purpose of this book has been to demonstrate that many of the central propositions of economic analysis can be derived without any reference to hyper-rationality, optimization, perfect competition, perfect information, representative agents, or so-called rational expectations. These include the laws of demand and supply, the determination of wage and profit rates, technological change, relative prices, interest rates, bond and equity prices, exchange rates, terms and balance of trade, growth, unemployment, inflation, and long booms culminating in recurrent general crises. In every case, the theory developed in the book is applied to modern empirical patterns, and contrasted with neoclassical, Keynesian, and post-Keynesian approaches to the same issues. The object of analysis is the economics of capitalism, and economic thought on the subject is addressed in that light. This, I believe, is how the classical economists, as well as Keynes and Kalecki, approached the issue. Keynes sought to create a new foundation for macroeconomic analysis because the world he observed was so at odds with the economic orthodoxy of his day. Yet he famously rejected the theory of imperfect competition as a basis for his theory of effective demand. Kalecki first developed his own approach to aggregate demand under the assumption of pure competition, Chapter 12, yet moved to a different theory of pricing based on his observations of actual processes, Chapter 8, Section I.9. In this book, I maintain that the theory of effective demand and even Kalecki's theory of pricing are better posed in terms of what I call real competition, the motor force behind many of the patterns identified and tested here, Chapter 13. This puts me at odds with the dominant traditions in orthodox and heterodox economics, both of which have come to rely heavily upon an imperfectionist view of the system. To my many Keynesian and post-Keynesian friends, I propose that we reject the claim that perfect competition was ever appropriate and refuse the notion that observed outcomes should be attributed to historically arisen imperfections. The economic dynamics of capitalism arise from competition itself. There was never any Garden of Eden, and our current condition does not stem from its loss. 1. Perfection and imperfection. The same can be said about hyper-rationality, which is bizarre as a description of economic behavior and insulting as a cultural ideal. Households and businesses certainly make choices, and choices matter. But their foundations are various and shifting, influenced by a complex web of forces rooted in, but not dictated by, gender, race, nationality, community, religion, and personal history, Chapter 3. Behavioral economics has become a great industry for the discovery that individual behavior does not accord with the prescriptions of hyper-rationality, just as in earlier times the theory of imperfect competition repeatedly found that the behavior of firms did not fit the prescriptions of perfect competition, Chapter 8. What does it matter if we now realize that the wolf does not actually dwell with the lamb, nor the rose grow without thorn? If the issue is to study economic behavior, rather than its deviations from some heavenly ideal, let us go to it. Then the question becomes one of how we accommodate genuinely new information of this sort. We can seek to repair and modify the existing paradigm so as to accommodate disagreeable facts, thereby struggling to preserve it. Or we can move to an altogether different foundation in which the world around us is understandable in its own right. Modern economics is still largely confined to the first mode. 2. Internal critiques. For these reasons, I have paid relatively little attention to purely internal critiques of standard theory, such as those that focus on reswitching in capital theory or the effects of increasing returns to scale on perfect competition. While these may be important ventures, an internal critique requires one to accept the bulk of a theory in order to concentrate on attacking the weakest link. Even if successful, and acknowledged as such by the orthodoxy, which is an entirely different matter, this would not tell us how to build an alternative out of the shards. Indeed, such a strategy all too often binds us to the very framework being criticized, entangled in the very propositions that were initially accepted on strategic grounds. Ciotti and Dida 2008, Introduction, 9-12. 2. Implications and applications of classical competition. Since the underlying theory has already been summarized in the introductory chapter, I would like to comment here on some applications and extensions which could not be addressed in the book itself. 1. Lawful patterns despite heterogeneous behaviors. A central finding is that lawful patterns can emerge from the interaction of heterogeneous units, individuals or firms, operating under shifting strategies and conflicting expectations because aggregate outcomes are robustly indifferent to microeconomic details. Hyper-rationality is not necessary, since one can derive observed patterns without it, or useful because it does not capture the underlying motivations. For example, the Lotka-Volterra equations were originally developed in the early 20th century to model predator-prey interactions among plants and animals and subsequently modified to model moose and wolf populations, and so on. Berryman 1992, Jost, De Volder, Vucetich, Peterson and Arditi 2005. Goodwin, 1967, used the same equations to model Marx's theory of persistent unemployment arising from dynamic interactions between wages, profit, and unemployment, Chapter 14. Neither plants nor animals nor competing social classes were presumed to have made rational choices with or without rational expectations. Benmar, 2007, 2, argues that rational choice theory is nonetheless valid because even mindless animals such as spiders and fish can end up behaving as though they were rational. But if we can model the aggregate interactions without having to make any such assumption, and if we know full well that individual actions do not conform to the prescribed ones, should we not instead say that we have no need of that hypothesis? The task of integrating the findings of various disciplines ranging from neurobiology to business advertising may be arduous, but it is surely the scientifically appropriate one. And in the meantime, we do know that many familiar economic patterns can be understood in their own right, Chapter 3. In an illuminating essay, the mathematician and physicist J. Doyne Farmer offers the following comment on a fundamental difference between orthodox economics and physics. Although it is often said that economics is too much like physics, to a physicist economics is not at all like physics. The difference is in the scientific method of the two fields. Theoretical economics uses a top-down approach in which hypothesis and mathematical rigor come first and empirical confirmation comes second. Physics, in contrast, embraces the bottom-up experimental philosophy of Newton, in which hypotheses are inferred from phenomena, and afterward rendered general by induction. If economics were to truly make empirical verification the ultimate arbiter of theories, this would force it to open up to alternative approaches. Farmer 2013, Abstract. The classical tradition began by observing actual patterns and outcomes. The neoclassical tradition began by idealizing them. Abstraction plays a different role in each, abstraction as typification in the first, abstraction as idealization in the second. In the former, the goal is to get back to actual patterns by successively introducing concrete factors. In the latter, reality stands in the dock from the start, found guilty of failing to live up to the ideal. Concretization is a familiar issue in science. All Newtonian masses fall at the same rate in a vacuum, but in a fluid such as air they fall at different rates depending on their shapes, masses, and material compositions. Moving from the abstract to the concrete strengthens the explanatory power of the law of gravity. The ideal vacuum outcome is certainly simpler, but it is neither desired nor perfect. And from a scientific perspective, the difference between the airborne paths taken by cannonballs and feathers is the more interesting issue. Consider long waves. Figure 17.1 depicts the HP-smoothed long-wave data previously displayed in Chapter 16, Figure 16.1. From 1897 to 1983, the smoothed data shows two clear long waves, 1897 to 1939, 42 years, and 1939 to 1983, 44 years, trough to trough. General crises break out 8 to 9 years after each peak in the smoothed data and last to roughly 18 years past it. In 2003, I began to display the average wave, the dashed line, lined up with the actual data peak in 2000 which had become visible by then, thereby projecting the next crisis as beginning in 2008 to 2009 and lasting until 2018. For such a crude procedure, it was remarkably effective. The issue is to explain the timings of long waves from the classical perspective in which profitability drives accumulation, Shaikh 1992. Two equalization tendencies as a basis for stable distributions of wage and profit rates. Classical theory postulates that competition turbulently equalizes prices for equivalent types of products, wage rates for equivalent types of labor, and profit rates for equivalent risks. Take prices. At the highest level of abstraction, technological choice results in a common method of production in any given industry, and competition among the producers results in a roughly common price. Two things are notable at this point. First, that even under these simplest of conditions, The equalization of prices involves perpetual fluctuations as prices constantly over and undershoot their marks. Second, this does not specify the particular level of the common price. For that, we must turn to competition between industries in which the mobility of capital creates a specific price in each industry, its price of production, which will ensure equal profit rates across industries once again as centers of gravity of fluctuations in actual prices. Once we recognize that technical change is ongoing, the continual retirement of older technologies and continual introduction of newer ones will create a distribution of technologies across firms. The firms with the newer technologies will be in a position to cut prices to gain market share, and incumbents will be forced to respond. If they fully match the price cuts, they reduce profit margins but retain market share. If they do not change their prices, they retain profit margins but lose market share. Their various responses stemming from their own concrete conditions will create a spectrum of selling prices in which lower prices are correlated with lower costs. Given that costs and prices vary across firms, there will also be a spectrum of profit margins and profit rates. In this context, new capital entering an industry will focus on the lowest cost methods of those generally available, and the mobility of capital across industries will turbulently equalize the profit rates of these best practice, regulating, capitals. While at the highest level of abstraction, competition appears to lead to a common technology and common price within an industry, that is, to single point for each variable. At a more concrete level, it can be shown to create and maintain a distribution for each variable. Chapter 7. The analysis of wage rates follows a similar logic. If real wages are higher in some firms and lower in others, the supply of labor seeking jobs increases in the first set and decreases in the second. At this level of abstraction, wage rates will be turbulently equalized across firms and hence across industries. As in the case of selling prices of commodities, this tells us that there will be a common wage rate but does not tell us its level. This is where the difference between other commodities and labor power, the human capacity to work, becomes paramount. In the case of an ordinary commodity, which is both produced and used by capital, there will be a particular price which will ensure a normal rate of profit on its production. But while labor capacity is used by capital, it is not produced by capital. Moreover, this capacity is an attribute of an active subject, the worker. So the capitalist employer must always reach outside the sphere of capitalist production to acquire it and must always contend with the reactions and sometime open resistance of workers to its use. Chapter 4. At a more concrete level, the mobility of labor will tend to equalize wage rates for any given occupation. Since firms differ in their mix of occupations, the average wage will be different across firms. Within each firm, the struggles over wages and working conditions will bring about a particular division of the money value added and hence a particular amount of profit, with capital pushing downward on wages and labor pushing up. Hence, even occupational wage struggles are contained and limited by their own aggregate feedback on profitability, which in turn affects their levels of employment. Chapter 14. Other limits also become relevant at a more concrete level. Workers are bound to their locations by family, community, and culture, so wage differentials must surpass significant thresholds in order to function as incentives to move. Workers must also factor in the risks and costs involved, each in their own specific manner. This alone would sustain persistent wage differentials for a given type of labor. A different set of factors becomes relevant at the shop floor level. In his path-breaking book Persistent Inequalities, Wage Disparity Under Capitalist Competition, Botwinick, 1993, chs 6-8, shows that the concrete limits for wage bargaining under real competition can create persistent wage differentials. He notes that since the profit rates of regulating capitals, the price leaders, are equalized across industries, regulating capitals in industries with higher capital, labor ratios must have higher profit margins. This makes it easier for them to absorb wage increases in the interval during which competitive forces react to higher costs and adjust relative prices and restore equal profit rates. Capital-intensive industries will also tend to have high levels of fixed costs, which will make them more susceptible to the effects of slowdowns and strikes. At the same time, because labor costs are likely to be a smaller portion of their total costs, such industries are more able to tolerate wage increases. On these grounds alone, capital-intensive regulating capitals will tend to have higher wage rates for any given strength of labor organizations. Non-regulating capitals are generally more vulnerable because their prices are determined by the prices of production of the regulating capitals, so that increases in their labor cost have more serious effects on their profitability. Therefore, their wage rates will tend to be lower. 1. These considerations lead us to ask about the shapes and forms of wage distributions. This is a familiar question in biology and physics, and has indeed been part of economics since Pareto's 1897 studies of wealth and income distribution, Pareto 1964, 299-345, Johnson, Kotz, and Balakrishnan 1994, Kleiber and Kotz 2003. 3. From wage and profit rate distributions to the overall income distribution. At a concrete level, competitive wage rates differ across occupations and differ to some extent within occupations due to their particular situational conditions, just as competitive profit rates will differ across firms due to their locations in industry hierarchies. Persistent competitive differentials in wage and profit rates in turn have direct implications for the distribution of personal incomes. Wage rates provide the foundation for the distribution of labor incomes, while profit rates, through their influence on interest rates and returns on equities and bonds, Chapter 10, provide the foundation for the distribution of property incomes, Shaikh and Tonak 1994, 35-37, 56, 220. The study of income distribution in capitalist societies can be traced back to Pareto's 1897 finding that property-based incomes seem to follow the power law we now call the Pareto distribution. Modern evidence confirms that this law applies to the upper tail of income distributions but not to their lower bulk. The physicist Yakovenko and his co-authors have recently broken new ground in this area with their Econophysics 2 class theory of income distribution, EPTC. They argue on theoretical grounds that labor incomes approximately follow an exponential, thermal, distribution while property incomes follow a Pareto, superthermal, distribution. Individual personal incomes may, of course, encompass both types of income, but it makes sense that the former dominates at lower income levels and the latter at the highest levels. The EPTC group marshals substantial empirical evidence that the bottom 97%, 99% of the distribution of personal incomes in the United States is roughly exponential while the top 1%, 3% is roughly Pareto. They also provide an ingenious method for combining the two types of distributions, thereby creating a powerful and parsimonious approximation to overall income distribution. Dragulescu and Yakovenko 2001, 358, Silva and Yakovenko 2004, 2, Yakovenko and Barclay Rosser 2009, Jagielski and Kuttner 2013. An exponential distribution has the property that the natural log of its cumulative probability from above is linear with respect to bin size, which means that if we plot the former on a log scale and the bin size on an arithmetic scale we should get a straight line. Figure 17.2 displays 2011 U.S. Internal Revenue Service, IRS, personal income data on a log linear scale, and we see that incomes up to $200,000 representing the bottom 97% of the population are close to the theoretical exponential distribution represented by the dashed line, data appendix 17.1.2 at the other end. A Pareto distribution has the property that the natural log of its cumulative probability from above is linear with respect to the natural log of bin size, and figure 17.3 shows that incomes above $200,000 do indeed follow a linear path on a log-log scale. The EPTC group shows that the same patterns obtain in all years in the United States from 1983 to 2001, and in Japan and the United Kingdom, Yakovenko 2007, 13-15. The EPTC argument has several other striking features. Let y equals the observed income of an individual and the mean income of the distribution. Then for an exponential distribution the cumulative probability of incomes above y is, which makes it parameter-free in normalized income. 3 In that case, normalized labor income data from all years should essentially fall on the same probability distribution curve, which it does to a remarkable extent. Silva and Yakovenko 2004. Second, an exponential distribution has a Gini coefficient equals 0.50, and it turns out the actual distribution of labor incomes in various years exhibit Ginis close to this theoretical value. Indeed, the 2011 IRS data depicted in Figure 17.2 has a Gini of 0.492. More recently, Shaikh, Papanicolaou, and Wiener, 2014, have tested the EPTC hypothesis from 1996 to 2008 on the labor incomes of U.S. subgroups categorized by gender and race. Males have higher average incomes than females and whites have higher average incomes than African Americans, BLS 2008, and we know that social policies can affect these income gaps. It is therefore quite surprising to discover that the pre-tax distribution of labor income within each group is nonetheless fairly close to an exponential in all years. The question is, why? Yakovenko et al. Propose an analogy to the collisions of particles under the conservation of energy, in which the transfer of money among those engaged in sales and purchases of goods and services leads to an exponential distribution of money holdings, Yakovenko 2007, 3-9. While this may well provide a fruitful approach to the treatment of money stocks in social reproduction, it does not really address the distribution of labor income flows. An alternate framework can be developed by combining the effects of real competition on the production conditions of firms with those on the wages and working conditions of worker. On the former dimension, the effect of a perpetual stream of lower-cost production conditions coming from newer firms creates persistent differences between newer and older firms and between regulating and non-regulating capitals, Chapter 7, Section V. On the latter dimension, the mobility of labor will turbulently equalizes wage rates of any given occupation. Since firms differ in their mix of occupations, the combined effect will be an average wage that differs across firms subject to its impact on profitability. If we were to construct a matrix wage rates in which the rows represented occupations and the columns represented firms, then any given entry which would represent the money wage rate of the th occupation in the wage industry. The question is, what factors determine the distribution of these wage rates? In keeping with the argument in Chapter 14, Section 2.3, we can link at any time t to the corresponding money value added per worker of the th firm yet through a linkage parameter that represents the combined effects of labor strength and occupational characteristics, all variables being expressed relative to their own means in any given year. From this we can derive the corresponding percentage change in relative wages over time. In the preceding equations, and yet are all positive, and since they are all relative to their own means, in each time period they are distributed around 1. Then if the linkage and value added distributions are slow to change, in equation 17.2, we might have where represent zero mean random variables, or alternately in equation 17.3, we might have then with representing the sum of either of the two sets of random variables, we get from equations 17.2 and 17.3, respectively. It is well known that the first relation would imply an exponential probability distribution of money wages, while the second would imply a gamma distribution that can be well approximated by an exponential, Yakovenko 2007, 4-9, and figures 1-7, 5-13. Both of these can be easily simulated in a spreadsheet. Point 4. The important point is that these outcomes can be derived as general structural propositions within the classical tradition. A striking empirical confirmation is that BLS data on employee compensation by 819 detailed occupations in 2013 shows a near exponential gamma distribution with even though the data is highly aggregated, http://www.bls.gov/oes/current/oes_nat.htm number sign 00-0000. This is important because we would expect that aggregation would reduce the degree of inequality, since in the limit at the aggregate level there is only a single wage and hence no variation at all. For rising inequality and the class distribution of income. Income inequality has greatly increased since the 1980s, and in this regard the United States is a leader among rich countries. From 1982 to 2012 the portion of total income going to the top 10% of the U.S. population rose from 35% to 51%, while that going to the top 1% rose from 10% to 23%. In other words, the income share going to the top 10% went up almost 50% and that accruing to the top 1% went up 130%. Over the 2 decades from 1993 to 2012, the average income of the top 1% rose 13 times faster than that of the bottom 99%, says 2013, figures 1-2, Table 1. Moreover, despite politically popular claims about upward mobility, the probability of staying in the top 1% wage income group from one year to the next has remained remarkably stable since the 1970s, 5 and 6. High incomes include profits, dividends, interest, rents, and capital gains, and it seems that a significant fraction of the surge in these incomes since 1970 is due to an explosion of top wages and salaries of highly paid employees or new entrepreneurs, says 2013, 2. The bonuses and stock options which play an important role at this end of the salary scale, Siskin and Parker 1998, M8, may be viewed as shares in the profits of companies these individuals own or in which they work. So the dramatic rise in the ratio of profits to wages beginning in the 1980s, chapters 14 and 16, provides a material foundation for the sharp rise in the overall income inequality. This is actually implied by the EPTC argument. If labor income is exponentially distributed, its Gini coefficient is fixed at 0.50. Then, a rise in the Gini of the overall income distribution must come from a rise in property income relative to labor income. Indeed, the EPTC group explicitly links the rise in property income with the rise in stock market prices, Silva and Yakovenko 2004, 3. Shaikh and Ragab, 2007, demonstrate that the overall Gini depends solely on the proportion of property income to total income. It follows that the overall degree of income inequality ultimately rests on the ratio of profits to wages, that is, on the basic division of value added. This is a fundamentally classical result. 17.6. 3. Wages, taxes, and the net social wage. Bringing the state into the picture adds yet another dimension to the analysis of income distribution. The state can intervene directly in the balance of power between capital and labor, as it did so decisively in the neoliberal era initiated by Reagan and Thatcher. The resultant breaking of real wage growth lowered the wage share and raised the profit share, Chapter 14. Inflation can also erode real wages, all the more so if labor is already weakened, Chapter 15. On the other hand, fiscal policy can pump up output and employment, while austerity policies can deflate them, Chapter 16. All of these can change the distribution of income by affecting the absolute and relative levels of profits and wages. We know that taxes, transfers, and subsidies have a direct impact on the post-tax distribution of income. But there is also a less addressed effect on workers' standards of living. Workers bargain for nominal wages in light of some target for their standard of living. Taxes directly reduce disposable income, but social expenditures offset these losses insofar as they provide desired goods and services. This is an important aspect of the welfare state, whose rise and fall I have chronicled elsewhere, Shaikh 2003b. Here, I am concerned with the impact of social expenditure on the standard of living of workers. Benefits received by wage and salary earners, defined here as excluding top management such as CEOs, consist of social expenditures on health, education, welfare, housing, transportation, parks and recreation, and transfer payments, while taxes consist of those directly paid by this group in the form of income, social security, property, and other direct taxes. The difference between social expenditures and taxes is called the net social wage. The surprising finding is that across major OECD countries the net social wage is between 3% and 5% of GDP in almost every year from 1960 to 1987, with the United Kingdom averaging 5.4%, Canada 4.8%, Germany 3.9%, and Australia 3.7%. Sweden, that paradigm of the welfare state, averages a mere 1.2%, while that paradigm of the anti-welfare state, the United States, comes in at 0.16%. For the group of 6 countries, the average was only 1.8% of GDP and only 2.2% of employee compensation. These surprising results tell us that even in the best welfare states, social expenditures and taxes serve more to redistribute the living standard of labor than to change its average level. As a whole, labor largely pays for its own social benefits. Shaikh 2003b, 543 to 545. 4. Piketty. The foregoing considerations provide a framework for studies of inequality, including that in Piketty's influential bestseller Capital in the 21st Century. My purpose here is to indicate how the arguments made in my book can be applied to Piketty's questions. A fuller discussion of his work is in the works elsewhere. Piketty's book is based on the path-breaking work by himself, Atkinson, Sayes, and other researchers. Piketty 2014, 17-18. The data made available in their World Top Incomes database has already changed the way we see the world. http://topincomes.g-mon.parisschoolofeconomics.eu/#. Their project represents a return to the tradition of grounding economic analysis in actual patterns so as to identify structural properties of capitalism. Piketty himself rejects market worship, for the price system neither knows limits nor morality, and excoriates the orthodoxy's childish passion for mathematics and purely theoretical and often highly ideological speculation, at the expense of historical research which disposes the profession to churn out purely theoretical results without even knowing what facts needed to be explained. 6, 31-32. I would add that the problem is not in the use of mathematics per se, but of the vision in whose service it is employed. Piketty's book has 3 logical parts. First, the presentation of its empirical findings on the distribution of income and wealth, leading to the central claim that capitalism has a tendency toward increasing inequality, only occasionally interrupted by great shocks such as world wars, revolutions, and depressions. The key mechanism is the tendency for the rate of profit to exceed the rate of growth, because then those who live off income from wealth are able to accumulate faster than the rest and further widen the gap. He is careful to say that he is not denouncing capitalism or inequality per se, but rather pointing to a tendency toward unsustainable inequality that undermines the meritocratic values which he sees as fundamental to democracy. Piketty 2014, 26, 31. Second, there is his theoretical argument about the underlying causal structure. Here he relies quite a bit on orthodox economic theory, including the notion of an aggregate production function, its associated claim that the profit rate is determined by the marginal product of capital and the obvious fact that the latter falls as the capital stock increases. 5 But for him the key question has to do with the profit share, alpha in his notation, since we can write the latter as, it seems to him that a falling rate of profit can be offset by a rising capital income ratio, so in the end everything depends on the vagaries of technology. 212-217. Third, there are the policy implications derived from the empirical patterns interpreted through this theoretical lens, the central one being a progressive global tax on capital, coupled with a very high level of transparency that would help democracy regain control over globalized financial capitalism. 34-35, 515-521. On the empirical side, Piketty's concern is about the achieved final distribution of personal incomes, labor incomes including wages and salaries as well as unemployment benefits and transfers, bonuses and stock options, and so on. Piketty 2014, 477 and 9, 602, and property incomes, consisting of rent, interest, profits, capital gains, royalties, and other income from ownership of land, real estate, financial instruments, and so on. 18, 477 and 9, 602. I have already pointed out in section 2.3 of the present chapter that within personal income, wages, and salaries in advanced economies are characterized by an exponential distribution and property incomes by a Pareto distribution, the latter being first noted for France in 1897 by Piketty's compatriot Vilfredo Pareto, as illustrated for the United States in 2011 in figures 17.2 and 17.3, respectively. Then the overall degree of inequality depends fundamentally on the ratio of property income to labor income, equation 17.6.6. On the theoretical side, within the classical framework the wage share, and hence the profit share, is determined by the degree of unemployment and the balance of power between labor and capital. The capital capacity ratio is determined by the choice of technique arising from the cost-cutting imperative imposed on individual firms by competition, Chapter 7, Section 7, and the rate of profit is jointly determined by the two. Aggregate production functions and pseudo-marginal products, insofar as they appear to exist, are mere statistical artifacts, Chapter 3, Section 2.2. In Piketty the profit share is the product of a profit rate and the capital income ratio. The former falls over time because the marginal product of capital falls as the capital stock grows, so it would take a rise in the capital income ratio to prevent the profit share from being dragged down. In the classical argument the profit rate is the ratio of the profit share and the capital capacity ratio, so that a rise in the latter can be a major cause of a falling rate of profit, Chapter 6, Section 8. Finally, in the classical case the rate of profit determines the rate of interest, Chapter 10, Section 2, and the difference between the profit and interest rates determines the rate of growth, Chapter 13, Section 3, and Chapter 14, Section 7. Piketty places a great deal of emphasis on the fact that the rate profit R can be larger than the rate of growth, which would permit wealth to accumulate more quickly from property income than from labor income and accumulate more rapidly among the top decile and centile. Thus, the inequality is the fundamental force for divergence, Piketty 2014, 26. This is odd on two levels. From a classical perspective the normal rate of profit is always greater than the normal rate of growth, the former being the ratio of the surplus to the capital stock and the latter the ratio the reinvested portion of the surplus, investment, to the capital stock, Chapter 15, Sections 4, 6. Then if Piketty's logic held, capitalism would give rise to constantly rising inequality of income and wealth. The second problem lies in Piketty's empirical measure of the rate of profit. His data indicates that while average profit rates in Britain and France have no long-run trend in the 19th century, they double in the early 20th century, rising sharply in the Great Depression and then falling equally sharply in the Great Booms from 1950 onward, 202, Fig 6.3 to 6.4. The profit rate is the ratio of the profit share, alpha, to the capital income ratio, beta, with the former having a mild downward trend. Hence, the large fluctuations in Piketty's rate of profit evidently stem from fluctuations in the capital income ratio. One would expect the latter to rise in a depression as incomes and profits collapsed in relation to the existing capital stock, thereby driving the profit rate down. The opposite would be expected in booms. Piketty's data shows just the converse. The puzzle is resolved once we realize that Piketty's measure of the rate of profit is logically inconsistent. His definition of profit as the excess of value added over wages, i.e., as net operating surplus, excludes capital gains on land and financial assets, as well as actual interest payments, Chapter 6, Section 8, and rental payments, both of which are treated as intermediate inputs by NEPA. Yet his measure of capital stock includes plant and equipment and also land, residential real estate, and net financial assets including the current value of equities, Piketty 2014, 41-43, 48-49, 123. His measure of capital as income-producing assets arises from his need to keep track of the immediate sources of property incomes. But then his failure to count all the returns to these same assets produces a sharply lower level of the rate of profit. It also makes it highly susceptible to fluctuations in the market values of these assets. In a bust, these fall in value more rapidly than fixed capital, which would raise apparent profit rate, with the opposite in a boom. This is why his rate of profit rises in the Great Depression and falls in the booms of the latter half of the 20th century. Piketty indicates some awareness of the problem when he says that he would have confined his measure of capital stock to equipment and infrastructure had he been able to separate out the elements. 47. Yet he does not discuss the grave consequences of failing to do so. On the political side, Piketty proposes to track and tax international capital flows so that global capital may be brought back under the rule of democracy. It is striking that he restricts his attention to post-on-tax income. We know that in practice that the overall inequality of pre-tax income was reduced in the first half of the post-war period as the wage share rose, and this inequality increased in the neoliberal era beginning in the 1980s because labor lost ground. Equation 17.6. From this point of view, overall pre-tax income inequality is evidently responsive to social processes and is therefore the proper place to begin policy analysis. The second striking aspect is his expressed hope for political institutions that might regulate today's global patrimonial capitalism justly as well as efficiently. Piketty 2014, 471. One could easily well argue that the inequality and lack of democracy on a global scale is aided and abetted by the political institutions and interests of the democracies of patrimonial capitalism. V. Development and underdevelopment. All concrete factors become enhanced when one considers the global economy. Transportation costs, taxes, and tariffs have a greater influence on the mobility of commodities and capital, while history, culture, and national restrictions have a far greater role in channeling the mobility of labor. The context itself is very important. Globalization involved colonization, force, pillage, slavery, slaughters of native peoples, the targeted destruction of potential competitors, and a huge transfer of wealth into the rich countries. The economic orthodoxy and its allies in international institutions offer visions of perfect competition and ideal macroeconomic outcomes to justify a greater reliance on markets, increased flexibility in labor markets created by curtailing unions and strengthening the powers of employers, greater privatization of state enterprises so that their assets and employees will be available to foreign and domestic capital, and the opening up of domestic markets to foreign capital and foreign goods. Friedman 2002. In reaction, the heterodox tradition generally argues that free competition no longer obtains, so that free trade theory on which neoliberalism is predicated is not relevant. The heterodox response to the discrepancies between orthodox theory and economic reality makes the mistake of thinking that perfect competition and comparative advantage were ever applicable. I have argued at length that modifying the perfect competition by incorporating various imperfections only binds heterodox theory to the framework it seeks to overthrow. There is no imperfection without perfection, and there is no perfection at all. Chapters 7-8, 11. Engagement in the world market has become an increasing feature of economic development. Between 1965 and 2006, the share of developing country, DC, exports in world trade went from 14.4% to 34.1%, while DC imports went from 14.1% to 29.4%, both much higher than DC share in world GDP, Nayar 2009, 14. At the same time, there has been a dramatic increase in the DC share of world industrial production, which trebled from 1970 to 2005. Yet this is not due to the magic of markets but is rather attributable, in important part, to development strategies and economic policies in the post-colonial era which created the initial conditions and laid the essential foundations in countries that were latecomers to industrialization. The much maligned import substitution-led strategies of industrialization made a critical contribution in this process of catch-up. The role of the state was critical in the process. Industrialization was not so much about getting prices right, as it was about getting state intervention right. Indeed, even in the small East Asian countries, often cited as the success stories, the visible hand of the state was much more in evidence than the invisible hand of the market. Moreover, the use of borrowed technologies, an intense process of learning, the creation of managerial capabilities in individuals and technological capabilities in firms, the nurturing of entrepreneurs and firms in different types of business enterprises, were the major factors underlying this catch-up in industrialization. Nayar 2009, 22-23. In this sense, successful modern development has followed a path similar to the earlier times in which the currently developed countries relied on trade protectionism and state intervention to support their ascent. Agassiz and Tussey 1993, Roderick 2001, Chang 2002a. The important point here is that protection and state intervention only lead to success in the world market if they end up creating internationally competitive producers. Amsden 1992, Chibber 2003. And for this to work, it must be understood that international competition operates in much the same way as national competition, absolute cost advantage rules, because international competition favors low-cost producers. Chapter 11. The inverse relation between wages and profit, Chapter 14, is the foundation for the mobility of capital in search of lower wages and cheaper resources, and for its continual recourse to local authorities, kinship and religious networks, and even nation-states to further its interests. None of this would be necessary without the competitive pressure emanating from the gravitational field of global competition. Failure to understand the concrete manifestations of these capitalist universals can lead to serious misunderstandings of the development process. Chibber 2003, CHS 5, 9, 11, Chatterjee 2013, Chibber 2014. The second major divide in the development literature is between orthodox and heterodox theories of macroeconomics. Faced with the absurdities of full employment rational expectations models, it seems sensible to turn to monopoly markup models of demand-constrained unemployment, Baghirathan, Rada, and Taylor 2004. In post-Keynesian theory, firms are insulated from competition and individual demand pressures can create the profits they desire through an appropriate markup. The aggregate corollary is that appropriate fiscal and monetary policies can enable the state to create something close to full employment. Yet we have seen that such policies failed even in the advanced countries. Chapter 12. Indeed, the classical argument is that competition creates and maintains a normal pool of unemployed workers, so that efforts to pump up the economy in order to eliminate unemployment will not succeed unless they are accompanied by policies that raise productivity faster than real wage so as to offset any negative effects on profitability, that is, unless they prevent real unit labor costs from rising. Chapter 14. The criterion for international competitiveness is the same, except that here unit labor costs must generally be reduced fast enough to stay ahead of international competitors, precisely as past and present successful development has demonstrated. This leads to a related point. Modernization aimed at increasing productivity and lowering costs has two potential effects: the extension of the market through cheaper products and the displacement of labor through mechanization. For the overall employment effect to be positive, the former effect must dominate the latter. Countries that are small in relation to the world market, such as Japan and then South Korea, may benefit so much from an expansion of exports that they can maintain tight labor markets for quite some time despite rapid productivity increases. But in large countries such as China and India, growth in the internal market must eventually play the main role. Under modern fiat money, this can be greatly enhanced through the creation of new purchasing power based on domestic and foreign, public and private, debt in which international capital flows play a big role. Indeed, Cheap finance as a means of growth has been the signature of the neoliberal era, chapters 14 to 15. But the crisis put an end to much of that, not just in the developing world but even the center, chapter 16. India now struggles with inflation, slowed growth, high interest rates, and a weakening job market, Bowler 2013, and China with rising prices, overextended credit, and a deflating housing bubble, Chandrasekhar 2013. Even Japan, the avatar of modern industrialization, has been mired in stagnation since the 1990s, Kiera and Y2013. Official unemployment measures indicate that even without adjusting for part-time and discouraged workers, there are currently almost 200 million people in the world without jobs, and almost 900 million workers live in dire poverty, ILO 2013. Even if capitalism recovers soon from the crisis, can it grow fast enough to offset the steady march of mechanization of all sorts of labor activities? Can it even absorb the new labor coming from population growth, let alone the already existing large pool? Whatever form it may take, capitalism will remain bound by the laws of real competition on which it rests. 1. Length, intensity, and productivity of labor, figures 4.1 to 4.4. The first order of business, so to speak, is to examine the production possibilities of a given technology. The ultimate limit of daily production time is the maximum time that a machine can be operated, which for the sake of illustration is taken to be 20 hours per day. Without labor time, there is no material input and no output, so the starting point is always zero input and zero output. Even in this state, there is a fixed cost corresponding to the depreciation of fixed capital. The productivity of labor is modeled in keeping with the empirical evidence in section 4 of chapter 4. It is assumed to rise at a slowing rate, peaking at some point below the machine limit of 20 hours. A quadratic function was used to represent the relation between labor productivity and hours worked, in order to allow for a decline in productivity after some labor exhaustion point, 12 hours of work in this illustration. To keep matters simple, the intensity of work was treated as a shift parameter for the productivity curve. For cumulative daily output, cumulative daily labor hours, the length of the working day of labor, the intensity of labor, and parameters, the average hourly productivity of labor is given by 4.2.1. The slope of this function at any given intensity is, which becomes zero at the overwork point. After this point, the productivity of labor decreases with hours worked. In the case of a single shift, the cumulative length of the working day is the same as the shift length, so the productivity relation implies that total output. The output curve turns down at, that is, the productivity of labor becomes negative after this point due to the absolute overextension of the working day. For n parameters, the overwork, exhaustion of labor, point is and the point of absolute overextension is. Finally, raising the intensity of labor raises the productivity of labor at any given number of hours of work, thereby shifting the productivity and output curves upward. The labor coefficient is the inverse of the productivity of labor. For materials A and a given stock of machines, materials coefficient, assumed to be constant, the machine coefficient, which varies inversely with output, and marginal product of labor, we get the following data points and curves. It will be noted that the labor and machine coefficient curves reverse themselves at some point because output actually drops when the working day is extended too far. Overexhaustion leads to damage and destruction. Appendix Table 4.2.1 displays the numerical values associated with the maximum level of intensity. Values for other intensity levels are not shown because they can easily be derived per equation, 4.2.1. Figures 4.1 to 4.4 in the text depict the main variables for intensities. Two shift combinations and the production possibilities frontier, figures 4.5 to 4.6. By definition, the neoclassical production possibilities curve is the frontier curve of output as the variable input, labor hours, is changed. This would seem to be the non-decreasing portion of maximum intensity output curve in figure 4.2 of the text, i.e., the curve up to the point at which output peaks. Since machines could be used for a full 20 hours, the firm could increase total daily output by truncating the first shift at 17 hours and adding a second 3-hour shift to yield a new monotonic frontier curve. But it turns out that the resulting 17:3 curve is not a frontier curve. Indeed, there is no combination that dominates throughout, so that the output frontier consists of changing shift combinations. Even the shift combination which produces the highest cumulative daily output, 10-10, is below the frontier for the first 10 hours of labor input and does not possess the typical monotonic shape required of a well-behaved production function. Varian 1993, 307-308. These matters are illustrated by calculating daily output from various shift combinations operated at maximum intensity. The output corresponding to a single 20-hour shift is the same as calculated in Appendix Table 4.2.1. One can then use this reference shift to construct all other shift combinations which total 20 hours, the machine limit, by cumulating the output of successive shifts. Thus, a 17:3 shift will have the same daily cumulative output as the 20-hour reference shift until the 17th hour. But in the 18th hour, the additional output will come from the first hour of the second shift and will therefore be the equal in magnitude to the output of the first hour of the reference shift. This same procedure can evidently be repeated for any shift combination. Appendix Table 4.2.2 maps out these quantities, with the switch points of shifts being highlighted, for shift combinations 20:0, the reference shift, 17:3, 317, 12:8, and 10:10, the combination which yields maximum output at the end of 20 hours. Figure 4.5 is based on this data. The average and marginal products of labor for the 10-10 shift are also calculated and used to derive figure 4.6. 3 production function graphs, data for figures 4.7 to 4.8. The neoclassical production function charts are derived from a Cobb-Douglas function, where real net output equals real gross output, intermediate input. Gross output was derived as and plotted against labor hours in figure 4.7, while gross output per labor hour was plotted against the machine labor hour ratio in figure 4.8, for a machine stock, the materials coefficient and production function parameter. 4 production patterns for socially normal shift lengths and intensity, figures 4.9 to 4.14. This section traces the production patterns arising from the full, 20-hour, utilization of a reference plant and equipment operated at normal intensity for 2.5 standard, 8-hour, labor shifts, as previously developed in text tables 4.1 to 4.2. The machine stock and the materials coefficient are the same as in all previous examples, and each machine is assumed to require a fixed complement of workers. Thus, the cumulative daily hours of labor time, H, is the cumulative time spent on successive shifts, from 1 to 8 hours on the first shift, from 9 to 16 hours on the second shift, and from 17 to 20 hours on the final shift. Cumulative machine hours therefore vary from 14 to 280. Finally, the cumulative daily output of these successive shifts is where XR is the labor productivity corresponding to equation 4.2.1, in this appendix calculated for normal intensity. These basic variables are then used to calculate output per worker, machines per worker, output per worker hour, equals machines per worker hour, machine hours per worker hour, the machine coefficient, the employment coefficient and the labor coefficient. Appendix Table 4.2.3 lists the data, highlighting the start of each shift. 5 cost curves and profits, figures 4.16 to 4.18. Appendix Table 4.2.3 allows us to derive cost curves and profit for 2 separate cases, 1, when wages are paid per worker, and 2, when they are paid per hour. In addition to the previously used values of MK and A, the depreciation rate, machine price, P materials price, wage per worker equals 100, hourly wage rate, and output price. Output, XR, in Appendix Table 4.2.4 is taken from Appendix Table 4.2.3. Fixed cost equals the amortization on the stock of machines, which yields average fixed cost for any positive output, i.e., once the first shift starts, where the machine coefficient from Appendix Table 4.2.3. The subsequent calculations come in two sets. In the case of wages paid per worker, unit labor cost, where the employment coefficient in the previous table. Average variable costs, where the latter term is the unit materials cost, while average, total, cost. Total cost equals fixed cost alone when there is no output, the shaded entry, but otherwise can be derived from as marginal cost. In the case of wages paid per hour, where the labor coefficient previously derived in Appendix Table 4.2.3. The calculation steps for the other corresponding costs are the same as those in previous case. Finally, total profit for each type of wage payment is derived as total revenue, minus the corresponding total costs, or Appendix Table 4.2.4 summarizes this data from which figures 4.16 to 4.18 are derived. Appendix 5.1. Citations of key points in Marx's theory of money. These quotes from Marx are intended to highlight certain key arguments in his theory of money, using solely his later writings, a contribution to the Critique of Political Economy, Capital Volumes 1-3. The only exception is one quote from the Grundrisse referring to the stimulus given by an increase in gold supply to the level of output and employment, since this does not seem to have been directly addressed in the two later works. The arguments are grouped in an order paralleling that of Chapter 5, the recognition that the term gold is a stand-in for a general money commodity, the particular types of money Marx says he is dealing with, and the types, credit money and some types of fiat money, he excludes because they have different laws and belong to a planned later stage in his argument, which he does not live to complete, the fact that circulation itself gives rise to tokens of gold, the argument that counterfeiting and debasement of currency are further developments of inherent tendencies within circulation, the basic operations of money insofar as it is commodity-based, endogenous, with a variable velocity of circulation and a variable level of total production, and the question of why tokens are accepted at all and what limits this implies. 2. The scope of Marx's theory of money. 1. The analysis excludes credit money but includes some forms of fiat money issued by the state. During the following analysis it is important to keep in mind that we are only concerned with those forms of money which arise directly from the exchange of commodities, but not with forms of money, such as credit money, which belong to a higher stage of production, Marx 1970, 64. The state which issues paper money with a legal rate of exchange, and we speak only of this type of paper money, Marx 1970, 119. The term legal rate of exchange in the preceding quote refers to legal tender, that is, to tokens having a legal conventional existence, Marx 1970, 116. Credit money belongs to a more advanced stage of the social process of production and conforms to very different laws, Marx 1970, 116. 2. The analysis is concerned with tokens which represent a money commodity. The token of value, say a piece of paper, which functions as a coin, represents the quantity of gold indicated by the name of the coin, and is thus a token of gold. The gold token represents value insofar as a definite quantity of gold, because it is materialist labor time, possesses a definite value, Marx 1970, 115. 3. A token which represents a money commodity is directly a token of price. The token of value is directly only a token of price, that is a token of gold, and only indirectly a token of value of the commodity. The token of value is effective only when in the process of exchange it signifies the price of one commodity compared with that of another, or when it represents gold with regard to every commodity owner, Marx 1970, 115-116. Many kinds of tokens were simple tokens of value. These include the provincial banknotes of the British colonies in North America from the beginning to the middle of the 18th century, as well as the legally imposed paper, the Continental Bill issued by the American government during the War of Independence and the French assignats, Marx 1970, 169. 4. Even inconvertible paper can be a token of a money commodity. Only insofar as paper money represents gold, which like all other commodities has value, is it a symbol of value. Marx 1967a, 128, emphasis added. The intervention of the state which issues paper money with a legal rate of exchange, and we speak only of this type of paper money, seems to invalidate the economic law of convertible tokens. The state, whose mint price previously provided a definite weight of gold with a name and whose mint merely imprinted its stamp on gold, seems now to transform paper into gold by the magic of its imprint. Because the pieces of paper have a legal rate of exchange, it is impossible to prevent the state from thrusting any arbitrarily chosen number of them into circulation and to imprint them at will with any monetary denomination such as 1, 5, or 20. Once the notes are in circulation, it is impossible to drive them out, for the frontiers of the country limit their movement, on the one hand, and on the other hand they lose all value, both use value and exchange value, outside the sphere of circulation. Apart from their function they are useless scraps of paper. But this power of the state is mere illusion. It may throw any number of paper notes of any denomination into circulation, but its control ceases with this mechanical act. As soon as the token of value or paper money enters the sphere of circulation, it is subject to the inherent laws of this sphere. Marx 1970, 119. 5. The excessive issue of inconvertible tokens of value merely depreciates them in relation to the money commodity. Let us assume that 1/4 million is the amount of gold required for the circulation of commodities, and that the state throws 210 million notes, each called 1, into circulation. These 210 million would then stand for a total of gold worth 1/4 million. The effect would be the same as if the notes issued by the state were to represent a metal whose value was 1/15 that of gold, or that each note was intended to represent 1/15 of the previous weight of gold. This would have changed nothing but the nomenclature of the standard of prices, which is of course purely conventional, quite irrespective of whether it was brought about directly by a change in the monetary standard or indirectly by an increase in the number of paper notes issued in accordance with a new lower standard. As the name pound sterling would now indicate 1/15 of the previous quantity of gold, all commodity prices would be 15 times higher, and 210 million pound notes would now be indeed just as necessary as 14 million had previously been. The decrease in the quantity of gold which each individual token of value represented would be proportional to the increased aggregate value of these tokens. The rise of prices would be merely a reaction of the process of circulation, which forcibly placed the tokens of value on a par with the quantity of gold which they are supposed to replace in the sphere of circulation. Marx 1970, 120. 3. Circulation itself creates tokens of gold. The circulation of money is an external movement, and the sovereign, although non-olet, it does not smell ed, keeps mixed company. The coin, which comes into contact with all sorts of hands, bags, purses, pouches, tills, chests and boxes, wears away, leaves a particle of gold here and another there, thus losing increasingly more of its intrinsic content as a result of abrasion sustained in the course of its worldly career. While in use it is getting used up. Marx 1970, 108. The transformation of gold sovereigns into nominal gold cannot be entirely prevented, but legislation attempts to preclude the establishment of nominal gold as coin by withdrawing it from circulation when the coins in question have lost a certain percentage of their substance. According to English law, for instance, a sovereign which has lost more than 0.747 grain of weight is no longer legal tender. Between 1844 and 1848, 48 million gold sovereigns were weighed by the Bank of England, which possesses scales for weighing gold invented by Mr. Cotton. This machine is not only able to detect a difference between the weights of two sovereigns amounting to 1/100th of a grain, but like a rational being it flings the lightweight coin onto a board from which it drops into another machine that cuts it into pieces with oriental cruelty. Marx 1970, 111. The process of circulation converts all gold coins to some extent into mere tokens or symbols representing their substance. Various commodities can thus serve as coin alongside gold, although only one specific commodity can function as the measure of value and therefore also as money within a particular country. These subsidiary means of circulation, for instance silver or copper tokens, represent definite fractions of gold coins within the circulation. The amount of silver or copper these tokens themselves contain is, therefore, not determined by the value of silver or copper in relation to that of gold, but is arbitrarily established by law. Marx 1970, 112. The weight of metal in the silver and copper tokens is arbitrarily fixed by law. When in currency, they wear away even more rapidly than gold coins. Hence their functions are totally independent of their weight, and consequently of all value. The function of gold as coin becomes completely independent of the metallic value of that gold. Therefore things that are relatively without value, such as paper notes, can serve as coins in its place. This purely symbolic character is to a certain extent masked in metal tokens. In paper money it stands out plainly. In fact, CENSTKLE Premier Paki Kut, Marx 1967a, 126-127. Our exposition has shown that gold in the shape of coin, that is tokens of value divorced from gold substance itself, originates in the process of circulation itself and does not come about by arrangement or state intervention. Marx 1967b, 116. 4. Counterfeiting and debasement. The longer a coin circulates at a given velocity, or the more rapidly it circulates in a given period of time, the greater becomes the divergence between its existence as a coin and its existence as a piece of gold or silver. What remains is magna nominis umbra, the body of the coin is now merely a shadow. Whereas originally circulation made the coin heavier, it now makes it lighter, but in each individual purchase or sale it still passes for the original quantity of gold. As a pseudo-sovereign, or pseudo-gold, the sovereign continues to perform the function of a legal gold coin. Although friction with the external world causes other entities to lose their idealism, the coin becomes increasingly ideal as a result of practice, its golden or silver substance being reduced to a mere pseudo-existence. This second idealization of metal currency, that is, the disparity between its nominal content and its real content, brought about by the process of circulation itself, has been taken advantage of both by governments and individual adventurers who debase the coinage in a variety of ways. Marx 1970, 109. When the decline of the metal content has affected a sufficient number of sovereigns to cause a permanent rise of the market price of gold over its mint price, the coins will retain the same names of account, but these will henceforth stand for a smaller quantity of gold. In other words, the standard of money will be changed, and henceforth gold will be minted in accordance with this new standard. This accounts for the phenomenon mentioned earlier, namely that, as the history of all modern nations shows, the same monetary titles continued to stand for a steadily diminishing metal content. Marx 1970, 110-111. V. Basic operations of commodity-based money. 1. Money is endogenous. If the velocity of circulation is given, then the quantity of the means of circulation is simply determined by the prices of commodities. Prices are thus high or low not because more or less money is in circulation, but there is more or less money in circulation because prices are high or low. Marx 1970, 105. The law regarding the quantity of money in circulation as it emerged from the examination of simple circulation of money is significantly modified by the circulation of means of payment. If the velocity of money, both as means of circulation and as means of payment, is given, then the aggregate amount of money in circulation during a particular period is determined by the total amount of commodity prices to be realized plus the total amount of payments falling due during this period minus the payments that balance one another. Marx 1970, 147. The total quantity of money in circulation must therefore perpetually increase or decrease in accordance with the changing aggregate price of the commodities in circulation, with the volume of their metamorphoses, and with the prevailing velocity of their transformation. This is only possible provided that the proportion of money in circulation to the total amount of money in a given country varies continuously. Thanks to the formation of hoards, this condition is fulfilled. Marx 1970, 136. In advanced bourgeois countries, hoards are concentrated in the reservoirs of banks. Marx 1970, 137. Hoards must not be confused with reserve funds, which form a constituent element of the total amount of money always in circulation, whereas the active relation of hoard and medium of circulation presupposes that the total amount of money decreases or increases. Marx 1970, 137. 2. The velocity of circulation can vary. In periods of predominant credit, the velocity of the circulation of money increases faster than commodity prices, whereas in times of declining credit commodity prices drop slower than the velocity of circulation. Marx 1967b, 448. As concerns the circulation required for the transfer of capital, hence required exclusively between capitalists, a period of brisk business is simultaneously a period of the most elastic and easy credit. The velocity of circulation between capitalist and capitalist is regulated directly by credit, and the mass of circulating medium required to settle payments, and even in cash purchases, decreases accordingly. It may increase in absolute terms, but decreases relatively under all circumstances compared to the expansion of the reproduction process. On the one hand, greater mass payments are settled without the mediation of money; on the other, owing to the vigor of the process, there is a quicker movement of the same amounts of money, both as means of purchase and of payment. The same quantity of money promotes the reflux of a greater number of individual capitals. Marx 1967b, 447. 3. The quantity of output can also vary. It is extremely important to grasp these aspects of circulating and fixated capital as specific characteristic forms of capital generally, since a great many phenomena of the bourgeois economy, the period of the economic cycle, which is essentially different from the single turnover period of capital, the effect of new demand, even the effect of new gold and silver producing countries on general production, would otherwise be incomprehensible. It is futile to speak of the stimulus given by Australian gold or a newly discovered market. If it were not in the nature of capital to be never completely occupied, i.e. always partially fixated, devalued, unproductive, then no stimuli could drive it to greater production. At the same time, note the senseless contradictions into which the economists stray, even Ricardo, when they presuppose that capital is always fully occupied, hence explain an increase of production by referring exclusively to the creation of new capital. Every increase would then presuppose an earlier increase or growth of the productive forces. Marx 1973, 623. 6. On the acceptability of token money. 1. A token can only function if it is guaranteed by the general intention of commodity owners. Custom turns a certain, relatively worthless object, a piece of leather, a scrap of paper, etc., into a token of the material of which money consists, but it can maintain this position only if its function as a symbol is guaranteed by the general intention of commodity owners, in other words, if it acquires a legal conventional existence and hence a legal rate of exchange. Marx 1970, 116. 2. Even fiat money must be voluntarily accepted outside national borders. One thing is, however, requisite: this token must have an objective social validity of its own, and this the paper symbol acquires by its forced currency. This compulsory action of the state can take effect only within that inner sphere of circulation which is coterminous with the territories of the community, but it is also only within that sphere that money completely responds to its function of being the circulating medium, or becomes coin. Marx 1967a, 128-129. Appendix 5.2. Sources and methods for Chapter 5. For the UK, gold prices from 1780 to 1785 are available in Jastrom, 1977, and were estimated for the United States over the same interval using the 1786 ratio of US, UK gold prices, which is essentially constant until 1800. For 1786 to 2010, the US gold price is the official price for 1786 to 1790, available from measuringworth.com at http://www.measuringworth.com/gold, and the market price thereafter. The same source has the UK market gold price in UK from 1786 to 1949, and in US dollar thereafter, so the latter segment was converted to UK British using the US dollar, UK exchange from the same site. Sources and methods appear in 1786 to 1945, Lawrence H. Officer and Samuel H. Williamson, The Price of Gold, 1257, 2010, http://www.measuringworth.com/gold, and in Lawrence H. Officer, dollar, pound exchange rate from 1791, http://www.measuringworth.com/exchange pound, respectively. The UK Wholesale Price Index, WPI, is available in Jastrom, 1977, Table 2, from 1560 to 1976, 1930 equals 100, except for missing values in 1939 to 1945, which were filled in using implicit annual growth rates in the NBER monthly for the UK PPI, all commodities variable ID equals M04053.dat, at http://www.northbyestar.org/databases/macrohistory/recdata/04. This was extended for 1977 to 2010 using the implicit growth rates of the UK Producer Price Index available from http://www.statistics.gov.uk/statbase, variable named PLLU, Price Index of UK Output of Manufactured Goods. US WPI is available in Jastrom, 1977, 145 to 146, Table 7, for 1800 to 1976. Data for 1706 to 1799 was interpolated using the US CPI, see sources for Figure 2.5, rescaled by the 1800 ratio of WPI/CPI. The series was extended to 1977 to 2010 using implicit growth rates of US PPI available from the BLS as variable WPS 0000000 at http://www.bls.gov/ppi/data.htm number sign. UK and US WPI expressed in gold were then calculated as the ratio of WPI to the price of gold, 1930 equals 100. The timing of various Great Depressions is discussed in the introduction to Chapter 16. Data and charts are available in Appendix 5.3. Data tables for Chapter 5, available online at http://www.anwarshikhecon.org, with each chart linked to the appropriate variables in the sheet equals DATAL reprices. The same data was used to derive two additional charts displayed in Chapters 16 and 17, respectively. Figure 16.1 US and UK Golden Waves, 1786 to 2010, 1930 equals 100, deviations from cubic time trends, as in Figures 5.5 and 5.6, now detrend by removing a fitted cubic time trend. Figure 17.1 The global crisis of 2007 in light of past long waves, smoothed via the HP filter, parameter equals 100, averaged over two clearly visible long waves 1897 to 1939 and 1939 to 1983, and then placed between the subsequent actual waves as a means of anticipating their path and the possible outbreak of the next crisis projected for 2008 to 2009. The actual global crisis broke out in 2007 to 2008. This procedure was used in classroom and public lectures beginning in 2003. Each country's smoothed data exhibited two long waves, the first from 1897 to 1939, 42 years, and the second from 1939 to 1983, 44 years, trough to trough. These 4 waves in all were averaged to produce a single representative wave, and the average wave was displayed between the next 2 actual waves beginning in 1983 with its peak located so as to match theirs, in 2000. As noted in the introduction to Chapter 16, general crises and Great Depressions typically begin around the middle of long downturns. As indicated in Figure 17.1, in the 2 prior waves from 1897 to 1983, Great Depressions occurred between 8 and 9 years of the peak of each wave. On this basis, the first Great Depression of the 21st century was projected to begin around 2008 to 2009. I first displayed these charts and projection beginning in 2003 and have repeated them every year since. Note that the latest long wave trough to trough from 1983 to 2007/2008 encompasses 44 to 45 years, very much in keeping with the 42 to 44 years of its predecessors since 1897. If the peak to trough duration of 18 years for the average of past waves, which are not symmetric, is any indication, the trough will be 2018. Appendix 6.1. Algebra of profit and surplus labor. The relations between surplus labor time, surplus product, and profit discussed in Chapter 6 are formalized here, first for a single composite commodity and then for the multi-sector case. Single composite commodity case, corn. We begin with production requirements per labor hour. As shown subsequently, these can be translated into input-output coefficients. Corn seed planted per hour of labor. Corn harvested per hour of labor. Labor, time required per unit corn harvested. Net product per hour of labor. Daily corn real wage per worker. H equals intensity adjusted length of the working day. N equals number of workers employed per day. Total number of intensity adjusted hours of employed labor. Total corn seed planted per day. Total corn, real gross output, harvested per day. Real net output of corn harvested per day. Then the aggregate daily surplus product, omega, varies directly with total daily employment, that is, the intensity adjusted length of the working day, h, and total number of workers employed per day, n. This can be expressed in terms of the daily real wage, WR, or in terms of hourly real wage. We can see in equation 6.1.1 that the surplus product falls as the length of the working day is decreased, until at some length h0 the surplus product is 0. Thus, necessary labor time is defined by the condition that the daily net product equals the daily real wage, or equivalently by the condition that the hourly real wage equal the hourly real net product as noted in See Chapter 6, Table 6.1. Surplus labor time is then the difference between the actual working day and necessary labor time, and the surplus product varies directly with the amount of surplus labor performed. In conjunction with equation 6.1.1, this translates into the proposition that the surplus product per employed labor varies directly with surplus labor time. Monetary aggregate profit/loss from production is the difference between the money value of gross output and costs of production. Let P equals a given price of corn, PR equals daily real profit, and WR equals the daily real wage bill. Then from equations 6.1.1, 6.1.4, we get that aggregate production profit is the money value of the aggregate surplus product, and for given production conditions, and price level, P, aggregate real production profit varies directly with surplus labor time. Similarly, the aggregate profit-wage ratio varies directly with the rate of exploitation, that is, with the ratio of surplus to necessary labor time, for any given set of relative prices. Hence, with a given daily wage, profit is positive only if surplus labor time, which from equation 6.1.3, requires that the hourly wage is below the hourly net product. In the case of a given hourly wage, this condition must apply directly. For positive surplus labor time and hence positive profit, the hourly real wage must be less than the hourly real net product, since otherwise employment would not be profitable. As previously, total production profit will then vary with total labor hours, L. 2 mapping into input-output form. In preparation for the multi-sectoral case, and for the subsequent analysis in Part 2 of this book, it is useful to translate the preceding relations into input-output form. The first step is to note that in this one commodity case, we must divide total daily flows by total daily outputs to arrive at the corn and labor input coefficients per unit output. On the assumption that both corn input and corn output vary in proportion to the length of the working day, their ratio, which is the input-output coefficient, will be given independently of H. But this is not true for the labor coefficient nor the wage per unit output, because at a given level of employment and real wage, the ratio of these variables to output will vary inversely with the level of output and hence inversely with the length of the working day. Then since total employment, real net output and surplus product can be expressed as where total input coefficient is the real cost of production, abstracting from depreciation here, the sum of the unit real material cost and the real unit labor cost, the product of the real hourly wage, and the hourly labor coefficient, L. Note that when the daily wage, WR, is given, the real hourly wage varies inversely with the length of the working day. The profitability condition in equation 6.1.7 amounts to the requirement that 3 multi-sectoral case. One more step is required to make the transition from the Sarafa type quantity and money flows as in equations June 1st, 13, and June 1st, 14, to input-output form. The illustrative flows are taken from the text and describe the basic production structure in Sarafa form for a 4-hour working day and then for an 8-hour day, with a given daily real wage, WR. These are mapped into a Leontief type flow matrix in Appendix Tables 6.1.1 and 6.1.2 with the lightly shaded area encompassing the standard transactions matrix. It is apparent from the two tables that the ratio of input flows to output flows is not affected by the length of the working day. Dividing the column entries in the transaction matrices, which represent the use of each commodity in the industry represented by that column, by that industry's gross output gives us the Leontief input-output coefficients matrix A. Matrices and vectors are denoted in bold type in order to distinguish them from scalars, and I is the identity matrix. Corresponding vectors for a 4-hour working day are sectoral real gross output, real net output, employment, real wage basket, total wage basket, where n equals 15 is the total number of workers employed, a scalar, and surplus product. All of these vectors depend on the levels of sectoral employment, that is, the length of the working day and total number of workers employed since. If input-output coefficients are stable, changing the length of the working day changes inputs and outputs proportionately, so the input-output coefficients matrix is unaffected. But with given levels of employment and a given daily wage, ratios of employment and wage basket items to output flows do change with H. Since the hourly labor time coefficient is invariant to H, we can characterize the other two in a simple manner which in turn yields a familiar expression for the surplus product vector, where now represents a matrix. Since A and are both semi-positive, the positive elements of B, H, decline with H. Given that so, this allows us to rewrite expression for the surplus product as where is the matrix of consumption goods required directly and indirectly per hour of labor time. The condition for a zero surplus product vector then becomes the zero surplus product condition is satisfied by a specific length of the working day, which is the positive dominant characteristic root of the matrix and a specific set of strictly positive output proportions year 0 associated with the corresponding characteristic vector point 1. Surplus labor time is. If we begin from a zero surplus product at the working day length, then as we raise h the net output vector year will expand in direct relation to while remaining in the same output proportions as year 0, so from equations, June 1st, 18, and June 1st, 19, the resulting surplus product will be which like year 0 will be strictly positive and an increasing function of surplus labor time HS. All of this holds directly for a net output vector, which has the same proportions as the strictly positive vector year 0. Now suppose we were to move to a semi-positive 2-vector year with a different set of proportions. Then the surplus product may contain some 0 or negative elements. Even so, we can see from equation, June 1st, 13, that raising the length of the working day, i.e., raising surplus labor time, will raise the individual elements of the matrix and hence raise the elements of the surplus product. Aggregate profit is the difference between the money value of gross output and that of material and labor inputs. Fixed capital is addressed in detail in Appendix 6.2. Alternately, since value added is the difference between the money value of gross output and that of material inputs, profit is also the difference between value added and labor costs. Letting P be any strictly positive price vector, negative prices having no meaning, we see that aggregate profit P is the price vector of the surplus product. Then it is clear that when surplus labor time and the surplus product are 0, aggregate profit will also be 0. Raising the length of the working day above necessary labor time, i.e., extracting surplus labor time, will then generate a positive surplus product and positive aggregate profit in proportion to surplus labor time. Changing the proportions of net output will change the level of profit, but not its positive relation to surplus labor time. Point 3. Finally, we have already noted in Chapter 6, Section 4, that once there is a surplus product, different sets of relative prices will yield different amounts of aggregate profit. This is the basis for the transformation problem which obtains in all schools of thought. Appendix 6.2. The rate of profit as a real rate. The theory of capital is one of the most difficult and contentious areas of economic theory. From Karl Marx to the Cambridge controversies, there has been an ongoing disagreement among economists as to what capital is and how it should be measured. Hulton 1990, 119. I. Concepts of Capital. It was noted in Chapter 6, Section I, that the concept of capital varies considerably across economic traditions. In the classical tradition, capital consists of those things which are used to make a profit. Appendix 4.1 established that expenditures on labor and raw materials show up in national accounts as changes in the inventories of circulating capital, raw materials and work in process, and expenditures for plant and equipment show up as changes in the stock of fixed capital. Personal or public wealth is different from capital. A self-employed mechanic may employ tools to earn a living, use her income to acquire and furnish a house, and work her way through college to enhance her skills. Her tools and her furnishings are part of her wealth, and her education is part of her abilities from which her income may derive. None of these are capital. But if she works instead as an employee in a repair shop, she labors to make profit for her boss. Then her wages, which may depend on her skills, and the tools and machinery with which she works are part of his capital. Within the category of capital itself, the distinction between circulating and fixed capital depends on the relation of a particular item to the production cycle in which it operates, not on the length of its economic life with respect to some arbitrary temporal period such as a year. Thus, a clay mold is circulating capital if it gets used up in the process of production, whereas plastic and steel molds are fixed capital if they can be used for more than one production cycle. Yet a plastic mold may not last longer than, say, 6 months of production cycles, while a steel mold may last several years. If we took a month as the reference time period, both would be classified as durables. If we took a year, the former would be reclassified as a perishable, and with a decade as the reference period, both would be classified as perishables. None of this would change the fact that clay molds remain circulating capital and plastic and steel molds fixed capital throughout. The distinction is functional, not temporal. Shaikh and Tonak 1994, 13-17. In a capitalist economy, capital includes business assets such as money, inventories, and plant and equipment. Wealth, on the other hand, also includes land, national resources, and government buildings and equipment. Public wealth, as well as private homes and other durable consumer goods, private wealth. Neoclassical economics conflates the distinction between wealth and capital because it simply defines capital as wealth that lasts more than 1 year. This subsumes business capital and personal and public wealth, as well as intangible wealth such as knowledge and skills, human capital. Modern-day national accounts embody the neoclassical approach. Capital is anything that is durable, and wages, dividends, and profits are treated as equivalent categories of income, so that the circuits of revenue and capital are conflated. From this stems the accounting convention that all flows are part of the income accounts and all additions to stock part of the capital accounts. See Appendix 4.1. Keynesian economics stays within the conventional framework. Sraffa's treatment of prices and profit rates, upon which I rely extensively, focuses entirely on the circuit of capital, so the need to distinguish between wealth and capital does not arise. He also presents a very sophisticated means of calculating depreciation allowances, which is an important issue in the measurement of the stock of capital. But in so doing, he carries over 3 conventional notions taken from orthodox economics: the definition of fixed capital by its durability, 1. The physical definition of capital, in which only commodities, but not money, appear as capital, and a corresponding definition of capital as net, rather than gross, stock, which defines the particular manner in which he treats fixed capital as a joint product. I have already argued against the first 2. I contend in Appendix 6.3 that gross stock is the appropriate classical measure of capital, and I show that this considerably simplifies the treatment of fixed capital as a joint product. But first, we focus on a great virtue of Sraffa's treatment of prices and profits, which is that the ratio of current profits to the current cost of capital defines a real rate of profit. 2. The current price rate of profit as a real rate of profit. The classical rate of profit can be defined through a system of prices of production. Point 2. In what follows, matrices and vectors are delineated in bold type. Where P equals the current price vector of commodities, the matrix of input-output coefficients, the diagonal matrix of capital goods depreciation coefficients 3, and the matrix of capital coefficients, which we will specify in more detail in the next section, W equals the 1 vector of wage goods per worker, and vector of labor requirements per unit output. An important feature of this system is that the uniform rate of profit does not depend on the output scale, although the total amount of profit and the total capital stock does. Thus, from equation 6.2.1, we can write: let the vector of gross outputs. Then we can define the NX1 net output vector, the surplus product vector, and the total capital stock. Then the money value of the surplus product aggregate profit, a scalar, and from equation 6.2.2, we can write the uniform rate of profit R as the ratio of money value of the surplus product to the money value of the capital stock. It should be noted that although we derived this in terms of prices of production, we could equally well do so in terms of market prices. In the latter case, P would represent the total profit in the economy and R the corresponding average rate of profit. An important feature of the preceding expressions is that the same price vector applies to all quantities. This means that the proper calculation of the rate of profit requires that the elements of the matrices and are valued at their current price. A scalar rise in the price vector, pure inflation, would have no impact on this measure of the rate of profit, since it would affect the numerator and denominator equally. Neither would the rate of profit be affected by deflation of its numerator and denominator through any common price index. In other words, when the capital stock is expressed in terms of its current price, the rate of profit is actually a real rate of profit. This latter point deserves some elaboration. The current price rate of profit in equation 6.2.3 is a real rate because the current dollar amount of profit, P, is divided by the current, i.e., inflation-adjusted, price of the capital stock, K. But there are also 2 distinct ways of expressing this ratio of current price magnitudes as a ratio of real magnitudes. Classical theory sees profit as the self-expansion of capital value. From this point of view, real profit is measured by its purchasing power over capital goods. Thus, for some capital goods price index PK, the rate of profit can be expressed as the ratio of real profits to real capital. This is a classical real rate of profit. Neoclassical theory sees things in the opposite way. It views investment as foregone consumption, so that capital is the accumulation of foregone consumption. Point 4. From this point of view, the real measure of capital is its purchasing power over consumption. If PC equals the price index of consumption goods, then at the same time, income is seen as a fund for potential, current or future, consumption. Point 5. Since profit is viewed as the factor income of the owners of capital, real profit must then be measured in terms of its purchasing power over consumption. This means that the neoclassical real rate of profit is the three real rates of profit represented by equation 6.2.3, 6.2.5 are equal in magnitude 6, but their interpretations are different and the individual components in the two versions of the ratio can behave very differently. 3. The rate of profit, profit shares, and output, capital ratio. The rate of profit can also be expressed in terms of various sub-ratios, in which theory once again plays a critical role. We begin by dividing the numerator and denominator of the expression of the rate of profit by current dollar net output, Y, and writing the profit share as and the output, capital ratio as. We can use the national income identity, with the wage bill, the nominal wage, current dollar net output per worker, and the wage share, to express the profit share and hence the profit rate in terms of the wage share. Suppose we were to deflate all terms in the first expression on the right-hand side of equation 6.2.6 by the price index of capital. The corresponding meaning of real profits and real capital is clearly within the classical tradition. But what possible meaning could be given to the term Y/K? The answer is contained in the price of production system of equation 6.2.1, because when the wage vector is 0, W equals 0, then profit becomes. Thus, within the classical system, the value of net output, Y, also represents the maximum amount of profit, P. On this reading, the term the ratio of actual profit to maximum profits, while the term the maximum rate of profit, Srafa 1960, 17. Deflating all terms by the price of capital gives us classical real ratios, and as before, these are equal to the corresponding current price ones. The corresponding path from a neoclassical point of view would be to deflate all terms in equation 6.2.6 by the price index of consumer goods. With capital seen as accumulated foregone consumption and income and its components such as wages and profits, as a fund for potential consumption, net output Y represents maximum current consumption. This gives us a neoclassical decomposition of the real profit rate. Each of the preceding transformations succeeds because all current price terms in an expression for the rate of profit are divided by the same deflator. By the same token, we cannot express the rate of profit solely in terms of some profit share and the traditional real output, real capital ratio. We have already noted that the nominal profit share, P/Y, can have both sides deflated by either PK or PC, according to the tradition involved. But if we decompose the nominal output, capital ratio into its price and quantity, constant dollar, components, so that, then we cannot get rid of the relative price term. Point 7. This is another way of saying that it is a common unit output, capital ratio that enters the rate of profit, not some ratio of different physical quantities. Similar issues arise in the case of the wage share, with Y, which is the ratio of the money wage, W, to nominal net output per worker hour, Y. We could deflate both of these terms by the price of consumption goods. The resulting real wage represents the purchasing power of wages over consumer goods or qualities, while the corresponding real output per worker hour would represent the maximum real consumption per worker hour within a given technology. This is a decomposition of the wage share from the point of view of workers. An alternate procedure would be to deflate both terms by an output price index, which gives us measures of the product wage, and labor productivity, respectively. This is the employer's perspective. Both views are relevant in any general analysis of the wage bargaining process, which is conducted in terms of money wages, with the labor side concerned about potential purchasing power and the business side concerned about potential costs. However, if we attempt to express the wage share in terms of real wages and productivity, we would be once again left with the relative price term, whose dangling presence serves to remind us that it is the current price wage share, not the real wage productivity ratio, which enters into the determination of the rate of profit. Appendix 6.3. Gross and net capital stocks. It was noted in Chapter 6, Section I, that the notion of capital value is quite different from that of capital as physical goods. This difference has important implications for the appropriate measure of the capital stock. Consider a computer costing $2,000 which lasts 4 years, and suppose annual depreciation is calculated as $700, $505, $432, and $365 over the 4 years. I will return to the method by which depreciation was calculated, but for now it should be noted that the numbers shown are rounded off from more detailed calculations, so that adding them may occasionally give small differences from the listed numbers. Then over the 4 years, the beginning of year capital tied up in the machine itself will be $2,000, $1,300, $796, and $365, while the accumulated depreciation will be $700, $1,205, $1,635, and $2,000, respectively. At any moment of time, the sum of the corresponding flows in these two streams is always $2,000. From the point of view of an ongoing business, which Marx adopts, the capital value initially invested in plant and equipment, $2,000, returns gradually to its money form as the fixed assets depreciate. These accumulated depreciation allowances may be held in the form of cash or financial assets, or even reinvested. But, in either case, they count just as much as part of total capital value as does the depreciated value of the machines, for it is the recovery of the sum of the two which allows for the continuation of the enterprise. Thus, for each year of the life of the machine the capital value invested in it is $2,000.1. In national accounts, this concept is known as the gross capital stock. It is independent of the manner in which depreciation allowances are allocated, which is precisely its virtue. As noted in the OECD Manual on Capital Stock Estimation, in this case a capital good is valued at as new prices, i.e. at the prices for new assets of the same type over its whole useful life. These as new prices are obtained by revaluing assets acquired in earlier periods using price indices for the relevant type of assets. The resulting measure has several analytic uses in its own right. Since it is widely used as a broad indicator of the productive capacity of a country, is often compared with value added to calculate capital, output ratios, and is used to give measures of profitability for a sector or the economy, OECD 2001, 31. The depreciated value of a machine, on the other hand, corresponds to the net capital stock. In general, both the unit value added and the unit profits on a machine will decline as it ages, due to loss of efficiency, more frequent repairs, and so on. Point 2. Suppose gross unit value added is $1,200, $900, $700, and $500, and unit profit $1,000, $700, $550, and $420. Over the lifetime of the machine. Point 3. Subtracting depreciation from each of these will give the corresponding net outputs and net profits, as shown in Appendix Table 6.3.1. The first row shows the initial investment, which is carried on the books for the lifetime of the machine. Hence, this is the beginning of year gross stock. The second row is depreciation, whose calculation will be addressed shortly. The third row is beginning of year net capital stock, which in the first year is the same as the gross stock, and in subsequent years is the previous year's net stock minus the previous year's depreciation. For, the numbers shown are rounded off, so they do not add exactly to the whole numbers shown. The next two rows are gross value added, output minus cost of materials, and gross profits, that is, cash flows, gross value added minus labor costs. The remaining four rows are the output, capital ratios and profit rates for gross and net stock measures, respectively. Note, gross and net stocks are for the beginning of the year. The table illustrates a case in which the gross stock measures of the output, capital ratio and the rate of profit fall as the machine ages. Yet the corresponding net stock measures show a rising output, capital ratio and an exactly constant profit rate, 15%, because in this example the rule used to calculate depreciation happens to yield a net value for the machines which declines in proportion to its mass of profit. This is precisely the manner in which fixed capital is treated in both neoclassical theory and Sraffian theory. It follows that over the lifetime of a single capital good the net stock output, capital ratio and rate of profit will generally be biased upward relative to their gross stock counterparts. The neoclassical rationale for calculating a net capital stock whose movements are tied to those of profits rests on the claim that under the assumptions of equilibrium, perfect competition, and perfect foresight, Harper 1982, 38, the price of any capital good is equal to the present value of its future income stream. 5 Given a particular stream of profit, the machine's useful life is determined by the point at which its profit drops to zero. The corresponding internal rate of return on the capital good is defined as that constant rate of discount which would make the present value of the profit stream equal to the price of production of the machine. 6 Thus, in Table 6.3.1 the initial investment, $2,000, and the gross profit, cash, flow defines the internal rate of return as that constant which would make the present value of this cash flow equal to the initial investment. It should be noted that there is absolutely no reason to assume a constant rate of return. If one were to instead settle on any particular pattern of depreciation over the asset's lifetime, say a constant fraction of the initial investment as is often assumed in business accounting, then in conjunction with the given gross profits flow this will define net profits and a generally variable annual rate of return. One might argue that the appropriate depreciation pattern is one that reveals the asset's declining viability as it ages, not one that covers it up. In any case, in the present example the putative constant internal rate of return happens to be 15%. With this in hand, one can calculate the net present value of the profit flows in each year, which is the net depreciated value of the machine, i.e., the net capital stock. The first year net stock calculated in this manner is $2,000, simply because the internal rate of return of 15% was itself derived so as to make the first year present value equal to the initial investment, the initial gross stock of $2,000. Finally, depreciation is defined as the difference between the net capital stock as the beginning of the year 1, $2,000, and the net capital stock at the end of the year 1, which is the same as that at the beginning of year 2, $1,300, and so on. Note that depreciation is endogenous here, arising as it does as the difference between successive present values. In this illustration, the maximum and actual rates of profit, net output, gross capital ratio and net profit rate, are shown to be declining as the machine ages. Yet on the net stock calculation, the very same machine will appear to have a rising net output, capital ratio as it ages, as well as a perfectly constant profit rate, the internal rate of return, up to the very moment of its demise. Appendix 6.4. Marx and Sraffa on fixed capital as a joint product. Sraffa derives the price of new machines like that of any other product, through the price of the production system of the type displayed in equation 6.2.1. Moreover, following Torrens, Ricardo, Malthus, and Marx, he provides an elegant general treatment of fixed capital in which used machines appear alongside output as a joint product in any given year, Sraffa 1960, 94, Very 1987, 380. Within the neoclassical tradition, a similar treatment of fixed capital as joint product has been called the Walras, Hicks, Malinvad recursive approach to production. Point 1 Sraffa makes it clear that his procedure is a generalization of the usual way of calculating the depreciation and interest on a fixed asset, Sraffa 1960-64. And by the usual way he means exactly that the present value, net capital stock, method used by the neoclassicals. In what follows I will argue that Marx's notion of capital value, which corresponds to the gross capital stock method, can also be cast in terms of fixed capital as a joint product. Indeed, Sraffa cites Marx as one of his sources. But the two treatments are different, for precisely the reasons discussed in Appendix 6.3. To clarify the issues involved, I will use Sraffa's own example and notation, albeit in a somewhat modified form. Point 2 Let us then consider industry G, whose inputs consist of a new machine Mk with a price Pmk and a 2-year useful life. As in Sraffa, total material inputs in the GTH sector consist of goods of types whose costs are in the first year and in the second, with corresponding labor costs and output values. The machine Mk has a price Pmk at the beginning of the year. At the end of the first year, it is a 1-year-old machine with a price. This used machine then appears as an input into production in the second year, and since it only lasts 2 years, it is used up in that year. Depreciation is always a measure of the extent to which a machine has declined in value. Hence, in the first year of its life, the depreciation on the machine is, while in its second year depreciation is simply because the machine is entirely used up. Since the whole point is to distinguish between Marx and Sraffa on the treatment of fixed capital as a joint product, we will begin with a general system in which the determinants of depreciation and fixed capital remain to be specified. Where, and so that over the 2-year life of the machine, total depreciation the total value of a new machine. It is now straightforward to delineate the difference in the two approaches. In both Marx and Sraffa, in the first year the capital stock is equals the value of a new machine. But in the second year, Sraffa follows the usual method and lists the capital stock as the net stock, so that the value of the used machine alone. Substituting the expressions for depreciation and capital stock into equation 6.4.1, gives us exactly Sraffa's treatment of fixed capital as a joint product. Conversely, in Marx the second year capital stock is the total capital value, that is, the sum of the depreciated machine and the cumulative total depreciation held in financial form. Substituting the expressions for depreciation and this one for capital value into equation 6.4.1, gives us the equivalent to Marx's treatment of capital value with fixed capital as a joint product. Notice that the first equation, which determines the price of new machines, is identical to Sraffa's. But the prices of used machines, and hence the endogenous pattern of depreciation, are now different. The difference in depreciation patterns is striking. In Sraffa's treatment, even in the case of constant efficiency, i.e., when inputs and outputs are the same in both years, the price of the used machine is a nonlinear function of the rate of profit, Sraffa 1960, 68-72. The one exception is when, in which case the price of a used machine will fall by equal steps of 1/nth of the original value for each of the n years of its life, Sraffa 1960, 68. Since the steps in question represent the amount of depreciation in any given year of its life, depreciation will follow a straight line pattern only when there is no profit. To examine the corresponding pattern in Marx's treatment, we subtract the second line in equation 6.4.3, from the first. On the assumption of constant efficiency, all input and output terms are the same in both lines, save for those associated with the value of the machines. Hence, we get, from which it follows that this is exactly a linear fall in value, with a corresponding linear depreciation profile in the case of constant efficiency. But unlike in Sraffa, this linear pattern holds at all rates of profit, not just at. A second important difference follows from the first. Sraffa shows that with his method, even in the case of constant efficiency, the reduction of a durable instrument to a series of dated quantities of labor will in general fail, Sraffa 1960, 67. This is not a problem in Marx's method because if we substitute the expression for the value of a used machine into the first line of equation, 6.4.2, we get a straightforward expression in which only half the value of a new machine appears, and this can be reduced to a stream of profit weighed direct and indirect labor times without difficulty, just as in the manner previously developed for circulating capital, Srafa 1960, 34-35. When efficiency follows some other pattern, i.e., some other age efficiency profile, the age price profile will vary with the rate of profit. To see this, note that if we once again subtract the second line from the first in equation, 6.4.2, and rearrange terms, we get, where the term represents the difference in the gross profits of the 2 years. If efficiency declines over time, which means that when we substitute this expression into the first line of equation, 6.4.2, and move these terms over to the left-hand side, we have only positive terms in which the price of used machines does not appear. Unlike Srafa's method, Srafa 1960, 67-68, the reduction to direct and indirect labor quantities poses no problem even in the case of fixed capital. Third, since the price of new machines can be reduced to an expression in which only the value of the first machine appears, it follows that the price of new machines can be derived independently of the price of used machines. This is not so in Srafa, since he shows that in his formulation the equations for both new and used capital goods will enter into the standard product, Srafa 1960, 72-73. Finally, in the Srafian notion of net capital, aging capital goods are priced in such a way that the rate of profit on net capital value is equalized on all vintages. But in Marx's notion of gross capital, pricing of vintages merely determines the division of total gross capital value into depreciation and the value of used machines, so that it has no effect on the rate of profit of each vintage. The latter then reflects the decline in the profit margin as a capital good nears the end of its economic life, a point determined by the loss of efficiency with age, by the prices of materials and wages, and by price-cutting competition from newer methods of production. Chapter 7, Sections I, 2. Appendix 6.5. Measurement of the capital stock. The physical stocks and current prices of commodities are sometimes directly observable. This happens to be true for most commodities entering into gross national product because they generally appear on the market at their current prices. But in the case of inventories and capital goods, the physical stocks represent a variety of items acquired at different dates and prices. Even if we had information on the original purchase prices of these items when they were new, we would still need to know the vintages of the individual items in the stock in order to estimate their probable current market prices, which in turn depends on the implicit theory of the competitive prices of used assets, Appendix 6.4, and the putative degree of competition in the relevant markets. In principle, information on vintages could be gleaned through national surveys or through administrative records. For instance, Japan and Korea have previously carried out national wealth surveys which cover fixed assets, inventories, and net foreign financial assets. But Japan's survey was discontinued in 1983, leaving only Korea still in the field, so to speak. In all other countries, we generally only have company-based information on the total historical cost of the stock, i.e., on the running sum of historical costs of the items in the stock. Since neither acquisition dates nor acquisition prices are generally available, we cannot transform company book value data into either current or real values. However, as shown in Appendix 6.7, Section V.4, we can use book value data to calibrate these other values. Strengths and weaknesses of the perpetual inventory method. Almost all nations utilize the perpetual inventory method, PIM, to estimate capital stocks. The PIM builds up a dated version of the items in stock through information on observed investments in these items in different periods, on the basis of particular assumed patterns of retirements, for gross stock, or depreciation, for net stock. The PIM is relatively inexpensive and easy to implement. but these advantages come at a significant cost because the results depend heavily on a chain of assumptions for which there is admittedly little empirical basis. OECD 2001, ch. 8, 75-81. Actual capital stock estimates begin by converting annual nominal gross investment, in the th type of capital good to its constant price equivalent, through a quality-adjusted investment price index. Retirements are estimated on the basis of some assumed patterns and starting from some initial estimate of the real gross stock, and the subsequent end-of-year stocks are created by adding each period's real gross investment and subtracting the estimated retirements. OECD 2001, 39. Equivalently, the change in the real gross stock over any given period is the difference between real gross investment and retirements in that period. The current price gross stock is then created by multiplying the real stock by the investment price index. See section 6.5.v.1 for further details. Individual net stocks are estimated in two different ways. The traditional method is to assume some depreciation pattern for each type of asset. The total depreciation in any given period is the sum of the depreciation flows coming due in this period from all vintages of this type of asset which are still in the capital stock. Net stock is then gross stock minus total depreciation. This is the method used by France and most other OECD countries, and also the method used by the United States until 1997, OECD 2001, 43, 97-99. But an alternate procedure is to bypass the prior estimation of gross stocks, by taking advantage of the fact that once we specify the initial real value and depreciation pattern of any given asset, we can directly derive its net capital value at any moment over its lifetime. See Appendix Table 6.3.1. In recent times, the US BEA has also chosen to assume that each capital good depreciates at constant geometric rate over an infinite time period, on the grounds that the algebraic convenience of this assumption at a theoretical level outweighs its well-known empirical limitations. 1. The adoption of this assumption in turn makes it impossible to calculate gross stocks at all, because gross stocks depend on some assumed pattern of retirements, and if each asset lasts forever it never retires. This is why the BEA now only calculates net stocks. In the United States, estimates of the useful lives of broad classes of assets are largely derived from two venerable studies, the Winfrey, 1935, Distribution of Retirements, and the U.S. Treasury Bulletin F, 1942, on Asset Lives, Coburn and Frank 1992, 6. Other countries also rely on asset lives prescribed by tax authorities, as well as on company accounts, statistical surveys, administrative records, expert advice, and other countries' estimates. OECD 2001, 47. Given the paucity of the information, it is reasonably intuitive that the outputs of the PIM are bound to be inaccurate. Moreover, discrepancies between the PIM level of capital and the true level are cumulative, so that even small departures in the asset life assumption from the true life can result in large departures in capital stock levels within a short time period. Australian Bureau of Statistics 1998, 2. This weakness in the underlying data is one of the most serious problems in capital measurement. Coburn and Frank 1992, 6. A further difficulty arises because we generally only have point estimates of useful lives, which must then be applied for long intervals before and after the sample dates. 2. The standard PIM procedure takes these useful lives to be given for all time, which implicitly assumes that retirements are unrelated to changes in real costs or to events such wars, booms, and busts. Powers 1988, 27. But we know that retirements do reflect economic conditions. Capital goods are retired, scrapped or mothballed, even when they are often still physically productive because a rise in wage rates or energy prices has raised their costs, or because competition from newer capitals has lowered their market prices. Either way, it is the cost relative to the price, that is, the profitability, which is crucial. Powers 1988, 29, Coburn and Frank 1992, 20-21. Fermini 1997, 8. Thus, in practice, retirements are quite sensitive to market conditions, Coburn and Frank 1992, 4. All of this is ignored in national account estimates of the capital stock, even in cases such as the Great Depression of 1929. 2. Improvements on the perpetual inventory method assumptions. An obvious refinement of existing procedure would be to allow for some sensitivity of retirements to economic fluctuations. It would be useful, for instance, to adjust for the fact that scrapping of plant and equipment jumped during the Great Depression in reflection of the wave of business failures and the greatly reduced prospects for production, and then fell sharply when production went into overdrive during World War II. We could then assess how the level and trend of capital stock estimates responded to changes in the assumed service life, Appendix 6.7, Section V.2.2. The trouble is that any modern attempt to provide alternate capital stock estimates runs into the apparently intractable difficulty that there appears to be no way to work directly with aggregate chain-weighted stocks. As noted previously, individual real stocks are created via the PIM, in which the level of the real stock is the sum of net investment in that item, gross investment minus retirements, and the past level of real stock. Before the 1990s, aggregate capital stocks were created by means of periodically adjusted, fixed weights, and these aggregates follow the same PIM rule as their individual components. This meant that one could directly generate new capital stock aggregates by adjusting the assumed average service life. However, after the 1990s, capital stock aggregates, revised back to 1925 as is generally the case with any changes in methodology, have been based on the chain weighting of individual real stocks, about which we will have more to say. The difficulty is that chain-weighted aggregates of individual stocks do not follow the PIM rule. Indeed, there is no known rule that they do follow. It would seem therefore that the only way to track the effects of changes in useful lives would be to re-estimate the stock of each individual capital asset in each year, and then create chain-weighted aggregates from this huge mass of individual stocks. This is a task which even the national account agencies of a single country find onerous, and it would definitely strain the resources of private researchers. On an international scale it would be truly daunting. But there is another way of looking at the matter. Even though chain-weighted aggregates do not follow the PIM rule, it might be possible to discover which rule they do follow. In that case, the way would be once again open to assessing the impact of particular changes in the assumptions employed by national account agencies. The secret lies in the fact that current cost capital stock measures can be aggregated directly. It turns out that the resulting current cost aggregates follow a specific rule, from which the corresponding rule for real aggregates can then be easily derived. The discovery of these generalized PIM, GPIM, rules breaks the impasse concerning alternate measures of chain-weighted aggregates. I derive these new rules in Appendix 6.5, Section V, and demonstrate their high accuracy. These are utilized in Appendix 6.7, Section 2, to derive new measures of gross and net capital stocks under more plausible assumptions about retirements and depreciation. The impacts of the Great Depression and World War II turn out to be particularly important for the level and trend of the post-war capital stock. 3. Impact of quality adjustment on capital stock measures. It was established in Chapter 6, Section 8, and in Appendix 6.2 that the classical rate of profit, which is the ratio of current profits to current capital value, is a real rate, that is, it is inflation adjusted. This is true in terms of both gross and net stock. The key is that capital goods must be measured in current prices. This appendix investigates the impact of widely used quality adjustments on measures of capital goods prices and real stocks. Current cost capital stocks are not affected because they can be directly measured in current prices. But the greater the imputed degree of quality change, the lower the rise, or more rapid the fall, in corresponding quality adjusted prices, and the higher the rise in corresponding real, quality adjusted, capital stocks. This is of particular interest because within neoclassical theory the theoretically appropriate measure of quality adjustment is one which makes the real rate of profit, the ratio of real profit to real capital, exactly constant. The conventional real profit rate, PR/KR, can be written as the product of the real profit share in output, PR/year, and the ratio of real output to real capital, year/KR, the so-called productivity of capital. It follows that if quality change is appropriately estimated from the point of view of neoclassical theory, the productivity of capital will be stationary when the profit share is stationary. This means that we cannot treat the ratio of real output to real capital as a measure of technical change. For this reason, it will be argued that the appropriate measure of technical change is the ratio of current GDP to current cost capital stock, which is SRAF's maximum rate of profit R. To appreciate what is involved in this type of capital valuation, consider a particular type of desktop computer. In period 1, there are 2 desktops of this type, each of which sells for $2,000, but in period 2 there is only one which now sells for $1,000. If the computer in question was a capital good, then the market value of the stock in period 1 is $4,000 and in period 2 it is $1,000. These market values are the current cost values 3 of the capital stock, which along with the corresponding current profits is all that would be needed to calculate the classical rate of profit in each period, Very 1987. We noted in Appendix 6.2, Section 3, that it can be useful to express the same rate of profit in terms of constant price variables in order to analyze its determinants. The theory behind the construction of price and quantity indexes becomes critical here because the more rapid the rise of the price index, the less rapid is the rise in the quantity index. In this section, we will focus on the treatment of individual price and quantity changes, leaving the treatment of aggregate indexes for a subsequent section. 1. Observed versus quality-adjusted price indexes. There are only 2 basic approaches to the treatment of individual price or quantity changes, the traditional observed price approach, and the more recent quality-adjusted price approach. These have entirely different purposes and will yield very different price indices and hence very different real patterns. Consider our previous example of 2 desktops selling for $2,000 each in period 1 and a single desktop of the same type selling for $1,000 in period 2. In the observed price method, if period 1 is taken as the base period, then $2,000 is the base period price of a desktop of this type. This represents the real value of a desktop in either period. Thus, the real value of the capital stock in period 1 is desktops, while in period 2 is at desktop, both real measures being expressed in period 1 dollars. Price indexes provide an alternate path to the same end. The price index for a desktop in a given period is defined as its present period price divided by its base period price. 4 Hence, in period 1 the price index of a single desktop of this type is, while in period 2 it is. The real value of the stock in period 1 is then its current value divided by its price index. We noted earlier that the current value of the stock was $4,000 in period 1 and $1,000 in period 2. Dividing these by the corresponding price index yields exactly the same measures of real stock as just derived previously, in period 1 a real stock value of and in period 2 a real value of. As Dennison notes, this traditional methodology is both coherent and useful, Dennison 1993, 99-101. The equivalence of the 2 methods of calculating real machine value can be easily formalized. In what follows, the subscript I refers to the ith type of capital good, the observed price of a single machine, in dollar, the stock, number, of machines, K equals the current capital value, the real capital value of the total stock, and the subscript T refers to the time period. It is then evident from the combination of equations, 6.5.1, and 6.5.2, that the real capital value of the stock is simply its quantity multiplied by its base year price. Thus, the base period price method and the price index method give the same measure of real stock. 2. Quality adjustment to price indexes. The quality adjusted price approach, which has become increasingly prevalent in national accounts, has an entirely different purpose. It seeks to redefine prices so that they refer not to actual commodities but rather to the putative user benefits associated with these commodities. In our preceding example, the price of older desktops falls from $2,000 in period 1 to $1,000 in period 2. Suppose that in period 2 there is also a new type of desktop, twice as powerful as the older Model 5, available at a price of $2,000. If we define the quality of older desktops as 1 and that of newer ones as 2, then from the point of view of the user benefits we have the following result. In period 1, an older desktop representing 1 unit of quality has a price of $2,000 per desktop, which works out to $2,000 per unit quality. On the other hand, in period 2 a single older desktop representing 1 quality unit sells for $1,000, while a single newer one representing 2 units of quality sells for $2,000, so that the price per unit quality is $1,000 in each case. 6 In period 1, the price per machine and the price per unit quality is $2,000, since each old machine also represents 1 unit of quality, whereas in period 2 the price of an average machine is $1,500, 1 old at $1,000 and 1 new at $2,000, while the price of an average unit of quality is $1,000. Triplet 1990, 223 to 224, 2004, 19. The two methods of measuring average price therefore give different estimates of how prices have changed from one period to another. Prices per machine fall by 25%, while prices per unit quality fall by 50%. The current cost of the capital is not affected by quality adjustment because we can calculate it directly from market prices. It is $4,000 in period 1, representing 2 older types of machines each selling for $2,000, and $3,000 in period 2, representing 1 older type selling for $1,000 and 1 newer type selling for $2,000. Since the real stock is the current cost stock divided by the particular type of price index in use, equation 6.5.3, insofar as a quality-adjusted price index falls more rapidly, or rises less rapidly, than an observed price index 7, the corresponding index of real, quality-adjusted, capital stock will rise more rapidly. 8 The two approaches generate different readings of the evidence because they provide different definitions of real capital. The observed price approach defines real capital as the constant dollar value of the stock of machines, while the quality-adjusted approach defines real capital as the constant dollar value of the quality embodied in these machines. Gordon 1990, 55, 59. This last point is important because within neoclassical theory, the relevant quality of a capital good is its real profit. The correct theoretical concept of capital is to consider two capital goods as equivalent if they generate the same real gross profit, defined as gross revenue minus variable operating costs measured at a fixed set of output and input prices. Gordon 1993, 103.9 within the classical price of production framework represented by equations 6.2.1, 6.2.3, previously developed in Appendix 6.2, the neoclassical approach therefore amounts to defining real capital as proportional to the current price of the gross surplus product vector evaluated at base period prices where equals some constant of proportionality, and it follows that if the neoclassical definition of real capital were universally implemented, the resulting real gross rate of profit over time would be equal to the constant. Moreover, to the extent that ratio of real profits to real output was empirically stable, the real maximum rate of profit, the real output, capital ratio, would also appear to be stable. This highlights the points made previously that the neoclassical measures are different in principle from the classical definitions of the actual and maximum rates of profit. Consider the classical rate of profit, which is defined as the ratio of nominal profit to the current value of capital. In order to make the requisite neoclassical adjustments to prices of capital goods, we must first derive measures of real profits. But this can only be done in terms of prices of other than capital goods, because the latter is precisely what we are trying to construct. Hence, aggregate nominal profits must be deflated by some price index, different from that used to deflate the current price of the capital stock. But then, as noted in Appendix 6.2, Section 3, the resulting ratio of real profits to real capital is merely one of the components of the rate of profit, the other component being a relative price whose presence we cannot abolish. The overall rate of profit is unaffected by any such partition. This means that if we were to define real capital to be proportional to real profits, where some constant of proportionality, then all the dynamics of the profit rate are thereby transferred onto the price ratio. The very same conclusion applies to the real output, capital ratio insofar as real output is used as a proxy for quality. Whatever the meaning of such a ratio, it would not represent the maximum rate of profit. Rather, it would only serve to partition the maximum rate into two components, one of which would be constant by construction, so that all of the dynamic would be loaded onto the other, the residual price ratio. A different issue arises with the Sraffian treatment of used capital goods, Appendix 6.4. In this case, the current capital value, current price, of used machines is imputed from their current profitability through a given uniform rate of profit. This makes the current rate of profit on used machines equal to that on new machines. But it does not imply that this common rate of profit is thereby rendered constant. Any deflation procedure that attempted to make the real capital value of used machines proportional to their real profits would then run into the previously noted difficulties. For assessing the effect of technical change on the rate of profit, it should be obvious that if a definition of real capital renders it roughly proportional to real output, Appendix 6.5, Section 3, the resulting real output, capital ratio cannot be interpreted as an index of technical change. Its constancy would be merely definitional, rather than being evidence of, say, genuine Harrod-neutral technical change. How then should we assess the effects of technical change? Suppose we consider a price of production system and express the uniform rate of profit in terms of the wage share and the maximum uniform rate of profit, as in equation 6.2.8. The maximum uniform rate of profit, R, can be derived from the expression for the uniform rate, R, by setting the wage goods vector, equal to 0 in equation 6.2.1. Sraffa, 1960, 29-31, demonstrates that R is unique for any given technology. He also shows that it can be interpreted as the standard output, capital ratio, that is, as the output, capital ratio at standard output proportions, which are also unique to a given technology, no matter which price vector is applied to standard net output and the standard capital stock vectors. Therefore, any base period price vector would also give us the same ratio for any given technology. It follows that we can treat the movements of R as an index of technological change. Since R is the maximum uniform rate of profit, we can directly measure it in those years for which we have input, output tables and capital stocks. However, it is demonstrated in Chapter 9, Table 9.19, that the empirical aggregate output, capital ratio measured in terms of market prices is a good proxy for R, a point that Sraffa himself suggests in his unpublished notes, Bellofiore 2001, 369. It is therefore reasonable in practice to treat the actual current value ratio as an index of technical change, Chapter 16. In the case of the wage share, with Y, we noted at the end of Appendix 6.2, Section 3, that this can be expressed in two useful ways, as the ratio of the real wage, and maximum consumption per worker hour, which is most relevant to workers, and as the ratio of, and labor productivity, which is central to business concerns. Hence, we now have two different indicators, the changes in maximum consumption per worker hour and the changes in labor productivity, each expressing a particular aspect of technical change. V. Overcoming the problem of chain-weighted aggregates. Attempts to modify modern capital stock data immediately run into the intractable difficulty that there appears to be no way to work directly with aggregate chain-weighted stocks. Individual real stocks are created via the perpetual inventory method, PIM, in which the level of the real stock is the sum of net investment in that item, gross investment minus retirements, and the past level of real stock, Appendix 6.5. Before the 1990s, aggregate capital stocks were created by means of periodically adjusted, fixed weights, in which case aggregates follow the same PIM rule as their individual components. This meant that one could directly generate new aggregate capital stock estimates by changing some underlying assumption, say about the assumed service life. However, beginning in the 1990s, capital stock aggregates, re-estimated back to 1929, have been based on the chain weighting of individual real stocks. The difficulty here is that chain-weighted aggregates do not follow PIM rules. Indeed, there is no known rule that they do follow. Even so, it turns out that they do follow what I call the General Perpetual Inventory, GPIM, rules. The secret lies in the fact that current cost capital stock measures can be aggregated directly. 1. Stock flow accumulation rules for individual capital stocks. The actual construction of capital stock estimates involves several steps. First, observed annual data on nominal gross investment, IGI, by the ith type of capital good is converted to its constant price equivalent, IGRI, through a quality-adjusted investment price index. Second, some assumption is made about the useful life of this capital good, and this information is used to estimate how many of the goods of this type purchased in the past will be retired in any given period, RETRI. In the simplest case, if the ith capital good lasts periods, then periods after its purchase it is deemed to be retired, removed, from the gross stock. Starting from some initial estimate, the real gross stock, at the end of the period is then created by adding each period's real gross investment and subtracting the estimated retirements, OECD 2001, 39. Equivalently, the change in the real gross stock over any given period can be calculated as the difference between real gross investment and retirements in that period. The current price gross stock, KGI, is then created by multiplying the real stock by the investment price index. Individual net stocks are estimated in two different ways. The traditional method is to assume some depreciation pattern associated with a given type of asset. For each asset, this implies a pattern of depreciation flows over its assumed life. The total depreciation in any given period is the sum of the depreciation flows coming due in this period from all vintages of this type of asset which are still in the capital stock. Net stock is then gross stock minus total depreciation. This is the method used by France and most other OECD countries, and also the method used by the United States until 1997, OECD 2001, 43, 97-99. An alternate procedure is to bypass the prior estimation of gross stocks by taking advantage of the fact that once we specify the initial real value and depreciation pattern of any given asset, we can directly derive its net capital value at any moment over its lifetime. See Appendix Table 6.3.1. The point of departure for the PIM is the observation that we can always write the total physical stock of machines of given type I at time as the sum of the net change in the stock and its value in the past period. The traditional procedure is to multiply through by the price of this machine in the base period 0 to get a corresponding relation in real terms, in which the real value of the stock at the end of period T equals the real net investment in this type of machine during the period plus the initial real value of its stock. Net investment corresponds here to the value of the physical increment in the stock of machines, i.e., to the gross additions minus the retirements. This is the concept behind gross capital stock, but the basic stock flow accumulations rules derived in this section are subsequently extended in Appendix 6.5, Section V.3, to the slightly different concept of net investment, gross investment minus depreciation, which underlies net capital stock. Equation 6.5.9 is the PIM stock flow accumulation rule for the ith machine, Liu, Hamalainen, and Wang 2003, 34-36, which allows us trace the time path of the total real stock of the ith capital good commodity given some estimated initial value. The current stock of the ith capital asset is then estimated by multiplying each individual real stock by the actual or potential current price, i.e., its price as a current investment good, which we can see is equivalent to multiplying the quantity of the ith type of machines by their current market price. Since this is the price that must be paid for new purchases of the machine, new investment, we will designate it by and the corresponding price index by current cost stocks can be aggregated directly since they are all expressed in current units of currency. As indicated in equation, June 5, 10, at the individual level of current cost stocks the price of new machines, investment, is the same as that of the whole stock. We will see that this principle carries over to fixed weight aggregates but not to chain weighted ones. In the latter case, the price index of aggregate capital defined by the ratio of current cost aggregate stock to real aggregate stock can be markedly different from the price index of aggregate investment. Hence, for chain-indexed aggregates we need to designate the price index of the aggregate capital stock separately through the relation. 2. Stock flow accumulation rules for fixed-weight aggregate stocks. When quantity aggregates are created by means of fixed-weight indexes, the weights being the relative prices of the commodities in the base year, the aggregate real capital stock is created as the sum of the individual real capital stocks, Whelan 2004. Since individual real capital stocks are actually estimated via the PIM rule of equation 6.5.9, it follows that fixed-weight aggregate real stocks, designated by the superscript FW, also obey the PIM rule, Whelan 2014, Liu, Himalayanan, and Wang 2003, 36, 53. A necessary consequence of the fixed-weight procedure for creating aggregate stocks is that the aggregate capital stock, POSC, price index must be equal to the price index of aggregate new investment. While this is true for individual assets because the current money price of a machine of a given type is the price which must be paid for new purchases of the machine, new investment, it happens to also hold at the aggregate level for fixed-weight aggregates. To see this, note that equations, June 5, 10, and June 5, 13, taken together imply that. In the preceding expression, the term is simply the POSC price index of investment goods, that is, the prices of individual new machines weighted by the share of their real capital stock in the sum of the real stocks, THIRD 1987, 779. On the other hand, in the case of fixed-weight indexes, the sum of real stocks is the aggregate real stock, equation, June 5, 13. Hence, the last set of terms in the preceding expression simplify into. It follows that in the case of fixed-weight aggregates the investment and capital stock price indexes are the same. The fact that fixed-weight stocks follow the same rules as individual stocks means that in the case of fixed-weight estimates we can work directly with aggregate stocks to estimate the effects of some change in the underlying assumptions. For instance, in equation, June 5, 13, the real net investment term is the difference between observed real gross investment and some estimated set of real retirements, in the case of gross stock, or real depreciation, net stock. The effects of different assumptions about aggregate retirements or depreciation can then be directly assessed by making use of the PIM rule. The trouble is that fixed-weight estimates are no longer in use in most national accounts. 3. New the perpetual inventory method rules for chain-weighted aggregate stocks. In recent years many countries such as the United States and Canada have replaced fixed-weight aggregates by chain-weighted aggregates, on the grounds that the former yield unreliable estimates of aggregate growth rates. 10 Chain-weighted quantity indexes first create real gross growth rates, example for each individual item, and then aggregate these into some desired aggregate real gross growth rate, example using the prices of the previous period as weights. Thus, as the period changes, the weights are automatically revised. The resulting gross growth rate is converted to an index of levels by defining the volume as 100 in some particular base period, and then calculating, chaining, other volumes backward or forward from this point by means of the previously derived aggregate growth rates. Real levels are created by rescaling the volume in the base period to make its equal the current cost value of the aggregate in that same period. We have already noted that current cost items can be aggregated directly. Finally, the price index of the real variable, which is its implicit price deflator, is defined as the ratio of its nominal value to its real value, example. This procedure makes it clear that the choice of the base period only affects the level of the real aggregate but not its growth rate, well in 2006 to 7. The fact that growth rates are invariant to the base period is the principal virtue of chain indexes. Unfortunately, they also have a long list of deficiencies. First of all, the meaning of the real level of a chain aggregate is not clear. In the case of fixed weight aggregates, the base period determines a reference set of prices, so that the level of, say, the real capital stock in period T represents its total cost in terms of those particular prices, i.e., its constant dollar value. But in the case of chain aggregates, the reference prices are continually moving, and the base period only serves to provide an arbitrary scale to the variable. Thus, there is no particular meaning to the level of real chain aggregates. Second, except in the base period these levels are themselves not additive 11 so that real capital stock is generally not equal to the sum of individual real capitals or to the sum of the stocks of real equipment and real structures stocks. Nor is real GDP generally equal to the sum of real consumption, real investment, real government spending, and real net exports. This non-additive property implies that subtracting any given subcomponent from an aggregate will not give us the correct aggregate for the remainder, which must instead be derived in a complicated roundabout manner. Finally, non-additivity also implies that the ratio of the components to the aggregate will not add up to 1. It follows that any given ratio, such as real investment/real GDP or real equipment capital/real total capital, can no longer be interpreted as a real share. Liu, Himalayan, and Wang 2003, 9. Indeed, ratios involving chain aggregates are generally suspect. For instance, it is perfectly possible that the chain aggregate for investment can grow faster than for the capital stock ad infinitum, with the level of aggregate real investment potentially becoming larger than the level of the aggregate real capital stock, well in 2016. Since chain-weighted aggregates do not follow PIM or any other known rules, it seems that we can only create alternate estimates of aggregate stocks by operating at the level of individual capital good and then chain aggregating these revised estimates. Even if the underlying data was available, such a calculation would be difficult even for single country and essentially impossible on an international scale. However, there is another way to approach the issue. Even though chain aggregate real stocks do not follow the same accumulation rule as individual real stocks, it remains possible that they follow some other accumulation rule. Hence, if we can discover this rule, we are free to proceed. The first step along this path is to note that since current price aggregates such as nominal GDP or the current value of capital are created as the sum of their respective nominal components, they always add up, and the ratios of their components to the total can indeed be interpreted as shares. This property is important when working with chain aggregates based on Fisher ideal indexes 12 because the growth rate of any such real variable is approximately equal to a weighted share of the growth rates of its components, the weights being the corresponding nominal shares averaged over the present and past periods. This is known as the Tornquist approximation to the Fisher index, well in 2010, and it will permit us to approximate chain aggregate by the Tornquist index. We begin by deriving the accumulation rule for individual current cost capital stocks by combining the physical accumulation rule for the ith machine in equation 6.5.7 with the definition of the current cost value of the machine in equation June 5, 10. The resulting rule for individual stocks says that the current price of a stock of machines of a given type is the sum of two terms: 1, real net investment, which is the difference between real gross investment and the current value of machines being retired, and 2, the initial real stock at the beginning of the year. 13. Dividing through by the base year price and taking into account of the definitions in equations 6.5.8 and 6.5.9, that the real capital stock, real net investment, the ith capital good price index is, and that the ratio, where the growth rate of the price index, gives us. Equation, June 5, 16, represents the general accumulation rule for individual current cost stocks. Since they are in current prices, the first three terms can be directly aggregated, which gives us the aggregate relation. The term in brackets in the preceding expression is the weighted average of the rate of change of the ith price index, the weights being the previous period share of the ith current value stock in the aggregate. As it turns out, when any aggregate such as the real capital stock is constructed as a Fisher ideal index, the corresponding price index is itself of the same type, Whelan 2000, 6, 7 and 6. But then, from the Tornquist approximation, the rate of change of the aggregate price index is well approximated by a weighted sum of the rates of change of individual prices, the weights being the corresponding current value capital stock shares averaged over the present and past periods. This is virtually identical to what we have in the square brackets, except that in our case the nominal shares are lagged one period rather than being averaged over two. Hence, the term in square brackets will be a good approximation to the rate of change of the aggregate price index of the capital stock. It follows that the general rule for chain-weighted current cost capital stock is given by. In the chain-weighted case, the price index of aggregate investment is not the same as the price index of aggregate capital stock, because in general, utilizing the definitions for real aggregate stock, equation, June 5, 12, and real aggregate investment, we can use the chain-weighted accumulation rule for current cost stocks in equation, June 5, 17, to get the corresponding chain-weighted accumulation rule for real stocks. Equation, June 5, 18, confirms that chain-weighted aggregate real stocks do not follow the PIM rule because the chain-weighted investment price index is different from the chain-weighted capital stock index. It will be recalled in the case of fixed weight indexes these two indexes are indeed equal, equation, June 5, 14, which is precisely why the fixed weight aggregate capital stocks do follow the PIM rule, equation, June 5, 13. However, equation, June 5, 18, also makes it clear that even though chain-weighted real stocks do not follow the PIM rule, they do follow a simple variant of it. This is sufficient to permit us to work directly with chain-weighted aggregates to produce alternate measures of current cost and real stocks, which is undertaken in the Data Appendix 6.7. It is useful at this point to recall that nominal net investment, in, can mean two different things. In the case of gross stocks, it represents the difference between nominal gross investment, IG, and the nominal value of retirements, RET, but in the case of net stock, it represents the difference between nominal gross investment and nominal depreciation. We can therefore write net investment in a general form as, where ZT equals the aggregate current value of depletions of the stock, with retirements in the case of gross stocks, and depreciation in the case of net stocks. With this, we can express the generalized PIM, GPIM, accumulation rules for aggregate historical, current, and constant cost stocks previously stated in equations, June 5, 17, and June 5, 18, as Appendix 6.6. Measurement of capacity utilization. The analysis of the rate of profit requires us to distinguish its structural trend from fluctuations arising from cycles and shocks. The key step here is to distinguish between economic capacity and economic output, the latter being linked to the former by the rate of capacity utilization. It is important at the outset to distinguish between engineering capacity, which is the maximum sustained production possible over some interval, and economic capacity, which is the desired level of output from a given plant and equipment. For instance, it may be physically feasible to operate a plant for 20 hours per day 6 days a week, for a total of 120 hours per week of engineering capacity. But it may turn out that the potentially higher costs of second and third shifts make the lowest cost point consistent with only a single 8-hour shift per day for 5 days a week, i.e., 40 hours per week. This lowest cost point defines economic capacity, the firm's benchmark level of output, which in this example would represent a 33.3% rate of utilization of engineering capacity, Chapter 4, Section V. Production persistently below this level would signal the need for a slowdown in planned capacity growth, while that persistently above it would signal the need for accelerated capacity growth, Foss 1963, 25, Coors 1986, 37-38, 43-44, Shapiro 1989, 184. 1. It is always the economically desired utilization rate which is the key. Economic capacity is also different from full employment output too. Since both measures have been labeled potential output, it is important to distinguish them. Even though standard economic theory typically assumes that full capacity and full employment occur simultaneously, in actual practice there is no reason to suppose that production at economic capacity would serve to fully employ the existing labor force. Indeed, within classical, Keynesian, and Keynesian traditions, the two are distinct even at the theoretical level. Garagnani 1979. Conventional measures of capacity utilization. It might be supposed that one could distinguish between actual output and capacity by identifying the latter as the long-run trend of real output. But because aggregate data may contain asymmetric shocks, multiple cycles, and even long waves, it becomes difficult to specify any such trend. One procedure is to specify the trend as some a priori function of time. But there is little reason to believe that growth trends are independent of actual rates of growth, and there is no real reason to prefer one time function over any other. Another procedure is to smooth the data, as with the Hodrick-Prescott filter, so as to bring out the trend. Here, one must have an a priori preference for the degree of stiffness to assign to the trend, example the size of the HP filter parameter. Moreover, some smoothing methods can give rise to spurious long cycles. Harvey and Yeager 1993, 234. In either case, the chosen trend need not represent the path along which capacity utilization is normal, so that the residual fluctuations in the data may be a combination of variations in capacity utilization and those of the normal capacity path itself. Finally, there is the problem that fluctuations brought about by depressions, wars, and various other major conjunctural events are not generally symmetric. Smoothing techniques tend to split the data evenly between ups and downs, which means they generally misrepresent the actual deviations from the trend. For instance, in the case of the Great Depression with its sharp collapse and protracted trough, the distortion would be quite significant. The oil price shocks of the 1970s would present similar difficulties. An alternate approach is to try to estimate economic capacity directly. This would be relatively simple matter if one could accept the widely held, neoclassical, assumption that, except for downturns associated with the short, 3 to 5 year, cycle, capitalist economies generally operate at normal capacity. Indeed, this is the premise of the well-known Wharton method, which defines capacity as the peak output achieved in each business cycle or conjunctural fluctuation. The implicit assumption that all short-run peaks in output represent the same level, 100%, of capacity utilization, Hertzberg, Jacobs, and Trevethan 1974, Schneider 1984, automatically excludes the possibility of medium and long-term variations in capacity utilization. A second group of capacity measures tries to get around this problem by relying on economic surveys of operating rates, as in those by the Bureau of Economic Analysis, BEA, and the Bureau of the Census. Here, firms are typically asked to indicate their current operating rate, i.e., their current rate of utilization of capacity. The difficulty with such surveys is that they do not specify any explicit definition of what is meant by capacity, so that the respondents are free to choose between various measures of capacity, and the analysts who use this data are free to interpret them in manners consistent with their own theoretical premises. A typical case in point is the widely used Federal Reserve Board, FRB, measure of capacity utilization in manufacturing. It begins with a preliminary estimate of capacity by using two different surveys, one by McGraw-Hill, recently discontinued, and one by the Bureau of the Census. The Federal Reserve first combines them in some manner whose details it does not make public. Yet it frequently concludes that the resulting estimates of capacity utilization are not plausible even from their own point of view, so it further operates on the combined capacity measures to smooth them out, using regressions on the capital stock and on time, Shapiro 1989, 185 to 187. Various other adjustments are also made so as to move the capacity estimate from a peak engineering concept toward an economic concept consistent with its underlying theory. It is one of the stated goals of these adjustments that the resulting measure of capacity utilization rate is not chronically below normal capacity utilization. Shapiro 1989, 187 to 188. In other words, just as in the case of the Wharton method, the central premise here is that the economic system generally operates at, or near, full capacity. A third procedure, as employed by the IMF and the OECD, estimates potential output by means of fitted production functions. As has been often pointed out, a production function represents the optimal output which can be produced given fully utilized capital and labor inputs, Fisher 1969. Since actual capital and labor cannot be assumed to be fully utilized at any moment, this being the problem under investigation, this method requires some adjustment of the inputs. Thus, potential output is estimated using a labor input defined by the natural rate of unemployment and a capital input defined by the trend level of total factor productivity for that particular labor input, de Macy 1997. Needless to say, this requires theoretical faith not only in the much criticized notion of an aggregate production function, McCombie 2000-2001, Felipe and Fisher 2003, Shaikh 2005, but also in the existence of a natural rate of unemployment, see chapters 12-14 for a critical view. A fourth type of measure sidesteps the difficulties inherent in the first two by attempting to directly measure the rate of capacity utilization. In a now classic study, Foss, 1963, showed that it is possible to estimate capacity utilization by measuring the utilization rate of the electric motors used to drive capital equipment. Foss's initial estimates for selected years were subsequently developed into an annual series by Jorgensen and Grill-Liches, 1967, and then improved and extended by Christensen and Jorgensen, 1969, to cover the period from 1929 to 1967, and by Shaikh, 1992, to cover the period from 1909 to 1928. But there exists a major obstacle to the forward extension of the series, namely, that the data on the installed capacity of electric motors, which is crucial to the construction of the series, was dropped after the 1963 census. Shaikh, 1987a, showed that direct survey data available from McGraw-Hill yielded a measure of capacity utilization that was very similar to that derived from data on electric motor use, in their periods of overlap. This allowed him to splice the two series together to create a complete capacity utilization series from 1947 to 1985, which differed significantly from the standard FRB measure, Shaikh 1987a, particularly in terms of longer run patterns such as the Vietnam War buildup during the 1960s, and post-Reagan profit boom from 1982 onward. Unlike the FRB measure, Sheikh's measure is neither symmetric nor stationary over the long run, and it exhibits much greater fluctuations. Conversely, the capacity-output ratio it yields has a much smoother trend than that derived from the FRB measure. Further detail is provided in Shaikh 1987a, 1992, 1999, and additional discussion can be found in Winston, 1974, Gabish and Lawrence, 1989, 26-40, and Salaki and Solfidis, 1999. 2. A new approach to measuring capacity utilization. The profit rate RP/K can be written as the product of the profit share, and the output, capital ratio, R, the observed maximum rate of profit. 3. The latter can in turn be expressed as the product of the capacity, output ratio, the normal capacity maximum rate of profit, and the capacity utilization rate, the ratio of actual output to normal capacity output. The normal rate of profit is the product of the normal profit share and the capacity, capital ratio, while the actual rate of profit is the normal rate times the rate of capacity utilization. Shaikh 1999, 108.4. As previously noted, R and R are inflation-adjusted measures when both the numerator and denominator are expressed in the same units, that is, both in current cost, or both in constant cost converted through the same price index, see Appendix 6.2. This is relevant when we make use of real output and real capital stock separately as in equations 6.6.3 and 6.6.4. Equation 6.6.2, for the output, capital ratio presents us with a simple means of estimating the capacity utilization rate if we expand it into its component parts displayed in equation 6.6.4. Given that output and capital stock are known, this becomes an unobserved component problem in two variables Rn, Uk. We can close the model through a technical progress function in which the capacity, capital ratio is considered to be a function of time, representing autonomous technical change, and a function of the capital stock, representing embodied technical change, subject to random shocks. The functional form depicted in equation 6.6.5 encompasses Harrod-neutral technical change, so that Rn is stationary, and capital biased technical change, such that Rn falls as the capital stock grows. Hahn and Matthews 1970, 371-372, Eltis 1984, 280-285, Foley and Michael 1999, 117-119. In growth terms, it allows for the possibility that the rate of change of the capacity, capital ratio may have an autonomous component and an embodied one which depends on the rate of capital accumulation. 5 Combining these yields a potential econometric relation. From a classical point of view, output gravitates around normal capacity so that and over some long-run process. Economic capacity as defined here refers to normal capacity, not engineering capacity. The intuitive idea is that economic capacity is that aspect of output which is co-integrated with the capital stock over the long run, subject to a trend in the capital capacity ratio due to technical change. But now the issue of inflation becomes relevant. Rising prices will raise Y and K and impart a common component to both sides of equation 6.6.6, independently of any structural relation between them. It was previously established that the proper economic measure must be unit-free, so that its numerator and denominator both be measured in current prices or alternately both deflated by a common price index. Calculated in that manner, it is a real measure. The same issue crops up in equation 6.6.6. To get rid of the inflationary effect, we can only subtract the log of a common price index, P, from both sides, i.e., deflate Y and K by a common price P, because otherwise we would introduce a spurious relative price term into the equation, Appendix 6.2, Section 3. Hence, the profit rate consistent method of estimating capacity utilization can be summarized as shown below. Once output and capital stock have been restated in common price terms, the problem is easily addressed through time series methods, as delineated in Data Appendix 6.7, Section 3. The general method is easy to implement and requires only widely available data on real output and real capital stock provided both are deflated by the same price index. The co-integration model developed there allows us to estimate capacity and hence capacity utilization, the speed of adjustment of between output and capacity, and the direction of technical change. For instance, Harrod-neutral technical change implies a constant capacity, capital ratio, while capital biased technical change implies a falling one, Michael 2002, 278. We will see that the post-war period in the United States is strongly characterized by capital biased change. When applied to U.S. manufacturing data, this method also closely replicates a previously developed independent measure of capacity utilization constructed from census and survey data, Shaikh 1987a, Appendix B. A further advantage of this procedure is that it does not require the assumption of an aggregate production function or some natural rate of unemployment as in the narrow or other hypotheses. It should be said that the question of capacity utilization could be approached without regard to a consistent treatment of the maximum or actual rate of profit. From that point of view, the appropriate relation is between real output and real capital stock, each defined in terms of its own price index. But then one runs directly into the issue of quality adjustment discussed in Appendix 6.5, Section 3. There are only two basic approaches to the construction of price indexes: 1, the traditional observed price approach, and 2, the more recent quality-adjusted price approach. Their purposes, and hence their outcomes, are very different. The current cost capital stock is simply the list of capital goods in the physical stock evaluated at current market prices. In the observed price method, we deflate this by a price index of capital goods relative to their prices in some base year. The traditional measure of real capital is therefore simply the physical stock evaluated at base year prices. The more recent quality-adjusted price approach seeks to redefine prices so that they refer not to actual commodities but rather to the putative user benefits associated with these commodities. What we end up with is a measure of quality of the physical stock. Hence, the observed price approach defines real capital as the constant dollar value of the stock of machines, while the quality-adjusted approach defines real capital as the constant dollar value of the quality embodied in these machines. The trouble is that within neoclassical theory the relevant definition of the quality of a capital good is its real profit. The correct theoretical concept of capital is to consider two capital goods as equivalent if they generate the same real gross profit. Gordon 1993, 103. It follows that a perfectly implemented neoclassical quality-adjusted capital stock would yield a constant real rate of profit. Moreover, any variations in the real output capital ratio would then reflect those in the profit share. Properly implemented quality-adjusted price indexes of capital goods would suppress any trend due to technical change, and the measure of capacity utilization would be correspondingly distorted. In practice, quality adjustment is not perfect, so some aspect of technical change may appear. But to read these results as valid indicators of technical change and capacity utilization would be erroneous, since they are artifacts of quality adjustment. One of the virtues of the profit rate consistent method of estimating capacity utilization developed in this book is that it avoids these problems. Appendix Figure 6.6.1, which is the same as Figure 6.4 at the end of Chapter 6, displays the measure of capacity utilization of U.S. corporations, which is quite different in trend from the conventional FRB measure of industrial capacity utilization. Appendix 6.7, Section 3. Note the great impact of the Vietnam War boom in the Johnson era of the 1960s, and the corresponding credit-fueled demand boom of the Reagan-Bush Sr. era of the 1980s to 1990s in the new measure. Such demand-pumping episodes turn out to play important theoretical and empirical roles in chapters 12 to 16. Appendix 6.7. Empirical methods and sources. National accounts 1 distinguish between the gross value added of domestic businesses operating at home and abroad from all businesses operating within a country, whether domestically or foreign-owned. The former is called gross national product, GNP, and the latter gross domestic product, GDP, see Appendix Table 6.7.1. For instance, U.S. GNP would cover all Ford plants operating in the United States and abroad, while GDP would cover both Ford and Toyota plants operating in the United States. The former might be relevant to the stock market valuation of Ford, while the latter would be relevant to the analysis of domestic employment and capital stock in the US-based auto industry. To go from GNP to GDP, we would have to subtract the gross value added of Ford plants operating abroad and add the gross value added of Toyota plants operating in the United States. Appendix Table 6.7.1 GDP versus GNP, United States, 2009. Aggregate operating surpluses. We are primarily concerned with GDP and its components because available employment and capital stock measures refer to the domestic economy. The next step is to break GDP down into its relevant components. National accounts typically measure aggregate output, gross value added, and corresponding aggregate income, wages plus taxes plus gross operating surplus, separately. The two sides should match in principle, but do not in practice. Since the product measure is considered more reliable, the two sides are reconciled by adding the difference between the two, called the statistical discrepancy, ST, to the income side. In the NEPA definition, NOS equals GDP SD plus compensation of employees within the country plus net indirect business taxes economic depreciation, i.e., the depreciation of capital goods valued at current cost, called consumption of fixed capital, CFC, 2. Notice that this procedure implicitly allocates the income side measurement error to the sum of employee compensation and / or net taxes, rather than to net operating surplus, NOS. Appendix Table 6.7.2 illustrates these calculations. Appendix Table 6.7.2 Derivation of domestic gross and net operating surplus. While the preceding calculation of net operating surplus is standard, it has three major deficiencies as a measure of the NOS of the for-profit business sector, which is my concern. It fails to remove non-profit sectors such as the government, non-profits serving households, and households. It fails to account for an important asymmetry in the NEPA treatment of corporate and non-corporate businesses, and it fails to adjust for the effects arising from NEPA's inclusion of fictitious, imputed interest flows. 2 business sector accounts. GDP, and hence goes an NOS, includes non-profit institutions serving households, NPIsh, the so-called household sector, HH, and government. NPIsh includes religious, welfare, social service, grant-making foundations, political organizations, museums, and libraries, some civic and fraternal organizations, medical care facilities, educational and research organizations, recreational, cultural, civic, and fraternal organizations, and labor unions, legal aid, and professional organizations. However, it does not include non-profit organizations such as chambers of commerce, trade associations, and homeowners associations because these are considered to serve businesses. Moreover, the definition of business itself includes tax-exempt cooperatives, credit unions, mutual financial institutions, and university presses, Mead, Macaulay, and Reinsdorf 2003, 13. Removing NPISHs is therefore an important, albeit not complete, correction. The household also includes persons who rent out part of their houses, which we can treat as a non-profit activity, and an entirely fictitious owner-occupied housing sector, that arises because NEPA treat private homeowners as businesses renting their own homes to themselves. The rationale for the is that the GDP component of housing services should be independent of whether a house is lived in by its owner or rented out. Thus, if you live in a home which you owned, you will be treated as a business renting your home to yourself. Even though you live in your home, the rental revenue that you would receive if you did rent it out is treated as the revenue of your owner-occupied housing, business. The household sector is derived by subtracting estimates of homeowner maintenance, repairs, employee compensation, property taxes, and mortgage interest from the actual and fictitious rental revenue of houses owned by persons. The resulting net income falls within aggregate GOES and NOS under the subcategories of rental income of persons and net interest paid by businesses, Ritter 2000, 18 and 17, Meyer-Hauser and Reinsdorf 2007, 1.3 NEPA defines the business sector as exclusive of NPIsh, HH, and general government, but the Bureau of Labor Statistics, BLS, also correctly excludes government enterprises because they are non-profit. Harper, Moulton, Rosenthal, and Washausen 2008, 1 and Table A.1. Appendix Table 6.7.3 displays the corrected measures for business NOS, which is 79% of the corresponding aggregate value. 3 Wage equivalent and non-corporate and corporate rates of profit. A second problem is that the NEPA measure of business flows embodies a curious asymmetry. Consider 2 firms, one a corporation and the other an unincorporated enterprise, proprietorship or partnership, each with a value added of $100 million out of which each pays $50 million to regular employees and charges $10 million as depreciation, leaving $40 million in each coffer. In the case of the corporation, NEPA accounts would record a further $10 million in salaries, bonuses, and certain stock option exercises by corporate officers as part of corporate employee compensation so that the corporate business NOS would be $30 million. But in the case of the unincorporated business, NEPA would record all of the value added in excess of regular employee compensation, i.e., all $40 million, as personal earnings of proprietors and partners officially designated as part of domestic personal income under the designation Proprietors' Income, Siskin and Parker 1998, M8. No allowance would be made for the fact that some part of this sum is really the profit of unincorporated enterprises. 5 Indeed, on this accounting, the profit of the unincorporated sector would be zero. Correcting for this would require us to split proprietors' income into two parts, a wage equivalent and a corresponding profit. One way to do this is to assign the average employee compensation of full-time equivalent employees to proprietors and partners, self-employed persons. 6, Shaikh and Tonak 1994, 112 to 113, 304 to 305, Gum and Rupert 2004, 4 to 5, premised on the assumption that proprietors and partners earn at least as much as private full-time employees. This generates the wage equivalent WEQ1. However, using the average private wage rate per worker does not capture the rapidly changing ratio of officers' salaries to wages since the 1970s. An alternate procedure, which is used by the U.S. Bureau of Labor Statistics, BLS, itself, would be to split proprietors' income into wages and profit in the same proportions as the corporate sector, Jorgensen and Landfeld 2004, 15. Corporate employee compensation includes the salaries of corporate officers, and corporate profit does not. But non-corporate employee compensation does not include the compensation of proprietors and partners, and proprietors' income implicitly does. To make the sectoral measures consistent, we need to add the salaries of proprietors and partners to the wage bill for their employees and subtract these salaries from proprietors' income to get non-corporate profit. Assuming that the full wage/profit share is the same in the two sectors then allows us to estimate the wage equivalent, WEQ2, which would make it so, see Appendix Table 6.8a.2. Also shown in Appendix Table 6.7.4 is the impact on non-corporate profits and rates of profit. Appendix Figure 6.7.2 displays two non-corporate rates of profit, Non-Corp 1 and Mon-Corp, corresponding to WEQ1 and WEQ2, respectively, along with the corporate profit rate and that of the overall business sector. WEQ1 yields a profit rate which is less than half the corporate rate for 1947 to 1990, after which it rises rapidly to become more than double the corporate rate at points in the 1990s. WEQ2, on the other hand, yields a much more plausible result. Its corresponding non-corporate rate of profit tracks the corporate rate quite closely, but is a bit smaller. Some part of the size difference may be due to the fact that the estimated non-corporate sector still includes a number of non-profit enterprises such as chambers of commerce, trade associations, homeowners associations, tax-exempt cooperatives, and so on, whose very low or even negative rates of profit pull down the average non-corporate rate. These sectors are difficult to remove due to lack of adequate data. I use WEQ2 in all subsequent calculations. Hence, the overall business rate of profit shown in Appendix Table 6.7.4 and Appendix Figure 6.7.2 is defined as the sum of corporate profit and the non-corporate profit corresponding to WEQ2, divided by the sum of corporate and non-corporate current cost capital stocks. Similarly, WEQ2 is the basis for the non-corporate components of the corrected business sector derived in Appendix Table 6.8.I.3. For actual versus imputed net interest. The estimation of non-corporate wage equivalent and profit is not the end of the story because we still have to deal with the third problem arising from NEPA's treatment of interest payments. This does not affect measures of profit which are net of interest payments, but it does affect measures of business GVA, VA, and NOS. For ordinary NEPA sectors, Net interest payments are generally treated as a distribution of income by businesses to investors who have provided them with funds, not as a payment for services. Fixer, Reinsdorf and Vallons 2010, 347. The trouble is that financial intermediaries such as banks receive more interest than they pay, since that is how they make their money. This means that their net interest payments are negative, so much so that a conventional treatment of their value added, the sum of employee compensation, taxes, net interest paid and profits, tends to yield a negative number. Net operating surplus, which in this case would be equal to profits and net interest paid, then also tends to be negative. The obvious solution is to recognize that banks are, after all, financial intermediaries who take a cut out of the money flows passing through their hands. Shaikh and Tonak 1994, 260-267. Indeed, something like this was done until recently by many European countries. Fixer, Reinsdorf and Vallons 2010, 347 and 7. However, NEPA insists on treating banks as if they were ordinary businesses. And since ordinary businesses must have positive value added and positive gross surplus, an imputation for implicit financial services produced by banks is included in the NEPA under the category of net interest paid. Fixer, Reinsdorf and Vallons 2010, 347. Since banks are corporations, corporate net interest ends up being largely composed of imputations. Ritter 2000, 18. For instance, in 2009 total net interest within aggregate NEPA NOS is $841.9 billion, of which $747.6 billion is imputed. NEPA Table 7.12, lines 43, 44. In the normal course of events, non-financial businesses, households, and so on pay a certain amount of money as net interest to banks. This money constitutes the net revenue of banks, interest received on loans minus interest paid on deposits, and is partitioned into bank costs and profit. In order to accomplish its desired transformation of banking accounts, NEPA makes two interventions to these foregoing accounts. It creates certain imputed quantities to be used in the accounts of non-financial business, household, and so on, and it creates a different imputed quantity to be used in bank accounts. On the side of non-financial business, NOS is reduced by this imputed quantity and total interest paid is reduced by the same amount by adding a negative item called imputed net interest paid. Since by definition profit equals NOS, total net interest paid, the reductions in the latter two cancel out, so non-financial profit is unchanged. On the side of banks, the second quantity is subtracted from bank NOS and is simultaneously listed as a negative item called bank total net interest paid, so bank profits are also unchanged. We can then see two things: that the adjustments reduce the NEPA measures of non-financial and bank NOSs, and that we can undo these effects by removing the two imputed quantities from NEPA accounts, thereby restoring non-financial and bank NOSs to their proper, classical, levels. In effect, we need to increase non-financial NOS by adding the magnitude of non-financial imputed net interest, and to increase bank NOS by adding the magnitude of bank total net interest paid. Readers who wish to skip the rather detailed presentation that follows may wish to go to the final appendix tables June 7, 10 and June 7, 11. To understand the exact procedures and their rationale, it is useful to elaborate on the examples in Chapter 6, Sections 2 and V, so as to highlight the differences between the business and NEPA treatments of net interest, operating in two steps: interest payment from the production sector to banking, finance, sector, and interest payments from the household sector to the banking sector. In the first case, suppose the production sector has a net operating surplus, NOS, of 400, out of which it pays 70 as net interest to banks, 80 interest paid on its loans minus 10 as interest received on its bank deposits, leaving 330 as production profit. On the side of banks, 70 is received as net interest on loans 7, from which are subtracted total banking costs of 40, intermediate input costs of 14, depreciation of 16, and wages of 10, leaving a banking sector profit of 30. Within the classical accounting depicted in Appendix Table 6.7.5, the production surplus of 400 has been split into production profit, 330, and net interest paid, 70, a portion of the latter then showing up as additional banking profit, 30. NEPA insists on treating banks in the same manner as the production sector, in which case the net monetary interest received by banks, 70, would have to be recorded as a component of NOS in the form of negative net monetary interest paid, 70. To balance out the banking sector accounts in such way as to leave banking profits unchanged, NEPA therefore adds various imputed receipts and payments. Since any imputed payment, receipt, by banks must show up as a receipt, payment, elsewhere in NEPA accounts, in the present case the imputations also show up in the production sector once again in such a manner as to leave production profits unchanged. The steps involved are, to put it mildly, somewhat complicated. Moulton and Siskin 2003, Fixer, Reinsdorf, and Villones 2010, point 8. The first step is to argue that since the interest rate charged by bank on their loans is higher than that charged in the money market, the reference rate, borrowers must be getting some hidden services from banks for which they are willing to pay. Notice that this empirical accounting procedure relies on the theoretical assumption that every market price is supremely correct and efficient, no monopoly power or asymmetric information here. On this basis, the monetary interest paid by production, 80, is split into smaller interest that would have been paid at the reference rate, 32, and imputed payments for implicit borrower services provided by banks, 48. The second step is to argue that since the interest rates banks pay on deposits is lower than the reference rate, the total deposit interest received by production, 10, must be split into the larger interest that would have been received at the reference rate, 15, and the implicit depositor services provided by banks without charge, the latter to be recorded as an implicit payment by production and hence a negative receipt, 5. The third step is to replace the actual monetary interest paid, 80, and received, 10, by the production sector by the corresponding reference rate amounts paid, 32, and received, 15. Note that the NEPA decomposition of production sector interest payments implies that the reference interest paid by production, 32, equals the monetary interest actually paid, 80, minus the implicit payment for borrower services, 48, so the replacement can be accomplished by adding in a negative imputed interest paid, 48. In a similar vein, the reference interest supposedly received by the production sector on its deposits, 15, equals monetary interest received, 10, plus imputed interest received in the form of free depositor services. Adding the former sum as imputed interest received serves to accomplish the necessary replacement. The net effect is to supplement the existing net monetary interest paid by the production sector, 70, with a new sum of imputed net interest paid, 53, representing imputed interest paid, 48, minus imputed interest received, 5. Then overall net interest paid, monetary and imputed, is 17, net monetary interest, 70, plus net imputed interest, 53, as summarized in the production column of Appendix Table 6.7.6. Comparing the classical and NEPA treatments in Appendix Table 6.7.5 and 6.7.6, respectively, the replacement of the actual production sector net monetary interest paid of by a reference net monetary and imputed interest paid of reduces production sector recorded net interest by an amount A equals 53. This is exactly the total of services supposedly provided by banks without explicit payment in the form of borrower services, 48, and depositor services, 5. Therefore the fourth step is to also treat these imputed purchases of banking borrower and depositor services as intermediate inputs for production, A equals 53, and also as corresponding total sales of banks, that is, their gross output, 53, shown in the highlighted areas of Appendix Table 6.7.6. On the side of production, increasing input costs by A equals 53 lowers GVA, VA, and NOS by that amount, but because net monetary and imputed interest has been lowered by exactly the same amount, production profit is unaffected. On the side of banking, replacing the actual net monetary revenue of banks, 80 interest received on loans minus 10 interest paid on deposits, by the imputed sales of banking services, 53, reduce the recorded bank GVA, VA, and NOS by the difference, which the amount B equals 17. But net banking interest paid is now because new recorded, monetary and imputed, net interest paid by production shows up as a net interest paid in the bank column of minus 17, i.e., a net receipt of 17. The logic of this is that each particular interest payments in the production column must be recorded in the banking column as a receipt, and vice versa, so the signs of the totals are reversed. Since banking revenue has been reduced by B and banking net interest reduced by the same amount, the NEPA measure of banking profits remain unaltered, Appendix Table 6.7.6. As noted in Chapter 6, Section 2, we must also consider a case in which the household sector pays interest out of its wage and dividend incomes, themselves derived from the production and banking sectors at this level of abstraction. Suppose the household sector pays 20 in interest on its loans and receives 2 on its deposits. From a classical perspective, since this is a net deduction from the circuit of revenue and the corresponding inflow into the banking circuit of capital gives rise to a net increase of 18 into total business revenue, which is in turn split into banking costs of 12 and new bank operating surplus and new profit of 6. Since this comes out of household flows, production sector operating surplus and profit is unchanged. Hence, aggregate NOS and profit are increased by 6. NEPA proceeds by first splitting monetary interest paid by households, 20, into reference interest paid, 7, and imputed payments for borrower services, 13, and splitting monetary interest received by households, 2, into reference interest received, 3, and implicit payments of depositor services and hence negative imputed interest receipts. In the present case, the replacement of actual net interest payments by reference payments takes place in the household accounts, so it does not affect the production sector. Banking sector gross output is now the total sales of borrower and depositor services by banks to households, which after costs of 12 yields a new banking NOS of 2. Total interest paid by banks to households consists of net monetary interest paid on deposits of 18, comprised of interest paid on deposits, 2, minus interest received on loans, 20, and imputed net interest paid of 14, comprised of imputed interest paid in the form of depositor services, 1, minus imputed interest received for loan services. Total net monetary and imputed interest paid by banks is therefore now. The whole procedure changes actual net receipts of banks from 18, 20 monetary interest received minus 2 monetary interest paid, to 14, for net reduction of C equals 4, which in turn reduces GVA, VA, and NOS by C equals 4. At the same time net monetary and imputed interest comes out to C, so bank profit equals NOS, net interest is unchanged. Appendix Tables 6.7.7 and 6.7.8 delineate this second case, first in classical and then in NEPA form. The combined case of interest payments by non-financial business and households is treated for classical accounts in Appendix Table 6.7.9 and for NEPA accounts in Table June 7, 10. The differences between combined classical accounts in Appendix Table 6.7.9 and the corresponding NEPA treatment in Appendix Table June 7, 10 are located in the columns of the latter as changes shown in parentheses. Only 2 items are needed to account for these differences: non-financial business net imputed interest paid, and bank net, monetary and imputed, interest paid. Consider the production column first. Intermediate inputs have been expanded by A equals 53, which lowers GVA, VA, GOES, and NOS by the same amount. But the negative of this same amount is introduced as imputed net interest paid, so that profits are unchanged. Next, consider the banking column, in which net bank revenues, which were previously at 88 in Appendix Table 6.7.9, interest received on loans of 100 minus interest paid on deposits of 12, are now at 67 in Appendix Table June 7, 10, which is a change of. This changes Bank GVA, VA, GOES, and NOS by the same amount. However, bank net interest paid was previously 0 in Appendix Table 6.7.9 and is now. Therefore, the reduction in recorded bank NOS is exactly equal to the reduction in its recorded bank net, monetary and imputed, interest, so bank profit is unchanged. Note that adding back the corrections indicated in the last column of Appendix Table June 7, 10 recovers the classical, and business, sums, total NOS, 436, in Appendix Table 6.7.9 equals NEPA total NOS, 362, plus the adjustment factor, in Appendix Table 6.7.10.9. The corresponding empirical calculations are presented in Appendix Table June 7, 11. The first two rows display the two items needed, and the third row displays the adjustment term. Items 4, 7, represent NEPA measures of for-profit business, while the next four lines display them after removal of the imputed interest effects. Item 8 is net imputed interest paid by the non-financial corporate sector, the corporate equivalent of Item 2, pertaining to all business, and Item 9 is the overall corporate imputed interest adjustment, the sum of Items 8 and 1, which is common to the adjustments for all business and corporate business. In 2009, the imputed interest adjustments raise business and corporate net value added measures by only 1% and 2%, respectively, but raise business and corporate net operating surpluses by 7% and 10%, respectively. But non-corporate operating surplus are also lowered by the transfer out of the wage equivalent of proprietors and partners, and this swamps the positive effect of the imputed interest adjustment so that the overall business sector NOS is lowered by more than 30%. Corporate measures do not have this problem, since the corporate sector already excludes nonprofits and has no need of a wage equivalent adjustment. Here the only effect is that of the restoration of net monetary interest into GOES/NOS, which raises these measures back to their business levels. A Corp Financial, Bank, net int paid equals, Corp Fin Mon int paid plus Corp Fin Imp int paid plus Corp Fin Borrower Services paid, Corp Fin Mon int Rec plus Corp Fin Imp int Rec plus Corp Fin Borrower Services received, line numbers in NEPA T7.11 downloaded March 14, 2011. B Non-Fin Business net imputed int paid equals, Non-Fin Corp Borrower Services paid plus Prop/Partners Borrower Services paid, Non-Fin Corp Imp int received plus Prop/Partners Imp int received. C Non-Fin Corp net Imp int paid equals Non-Fin Corp Borrower Services paid, Non-Fin Corp Imp int received. There is one last important point about profitability measures. Adjusted net operating surplus includes actual monetary net interest paid on business debt, which makes the appropriate foundation for the general rate of profit in the classical sense, the rate that is turbulently equalized by the intersectoral mobility of capital. The adjusted NOS is also conceptually similar to the financial accounting concept of earnings before interest and taxes, Mead, Moulton, and Petrick 2004, 3-4. This type of measure becomes important when we consider the classical and Keynesian arguments that investment is driven by the difference between the rate of profit and the rate of interest, Chapter 16, for that requires us to start with a measure of profit prior to payment of actual net interest, i.e., earnings before interest and taxes, EBIT, if we are to compare the rate of profit to the interest rate. The corporate measure is particularly apposite because the similarity of non-corporate and corporate rates of profit, Appendix Figure 6.7.2, makes the latter a good proxy for the overall rate of profit, and because it only requires an easily calculated adjustment for imputed interest. V. Capital stock. 1. Empirical accuracy of generalized perpetual inventory method rules for aggregated chain-weighted stocks. We can now demonstrate the considerable accuracy of the preceding accumulation rules for chain-weighted aggregate capital stocks developed in Appendix 6.5, Section V. In the case of net stocks, which are the only ones now officially calculated for the United States, the parameter ZT represents the average depreciation rate, in both nominal and real terms. Since individual depreciation allowances can always be written as the product of some individual depreciation rates and corresponding nominal capital stocks, we get where the weights are the shares of individual REF-elated values of past real stocks. Parenthetically, it is interesting to note that there is no consensus in the literature on the appropriate notion of an aggregate depreciation rate, precisely because up to now no solution has been found to the problem of an accumulation rule for chain aggregate capital stocks. Liu, Himalayan, and Wang 2003, 37 and 12. Various ad hoc rules have therefore been suggested, the most popular being the ratio of nominal depreciation to nominal capital, which is essentially a weighted average of individual depreciation rates with nominal capital stock shares as weights. Wellen 2016, Liu, Himalayan, and Wang 2003, 37-39. But now we have derived the accumulation rule for chain aggregate stocks, we also have the theoretical definition of the depreciation rate. The Wellen, Liu measure is an approximation to the correct rate because its weights are based on past current values rather than on REF-elated values of past real stocks. Appendix Figure 6.7.3 compares the Wellen, Liu measure to the theoretically appropriate depreciation rate, both for the corporate sector, Appendix Data Table 6.8.2.3. We test the accuracy of the proposed chain aggregate accumulation rules by first estimating the depreciation rate through equation, June 5, 20, and using it to generate each year's chain-weighted stock according to equations, June 5, 22, and June 5, 23, for current and real stocks, respectively. Recall that the actual aggregate BEA stocks are derived from the chain aggregation of individual stocks, and that no rule was previously known to characterize the behavior of the corresponding aggregates. In our calculations, each year's aggregate is derived from the preceding aggregate, using only current gross investment and the aggregate chain-weighted price index of capital. Since the accumulation rule for real stocks is just an algebraic transformation of the current value rule, the error is the same for both. Appendix Table June 7, 12 shows that the average error over 1947 to 2005 is a mere 0.5%. This establishes that we now have the tools needed to generate alternate measures even for chain-weighted capital stocks. 2 Effects on capital stock measures of alternate assumptions. For reasons discussed in Section 2 of this chapter and in Appendix 6.3, the classical measure of the rate of profit is defined in terms of current cost gross stock. In this case, an individual machine is kept on the books at the equivalent of its current market price until it is retired, whereas in current cost net stock calculations the same sum is reduced by accumulated depreciation. Therefore, gross stocks are always larger than net stocks and may have different trends. These differences will be reflected in the corresponding measures of the rate of profit, which could be important when we are comparing the profit rate to the rate of interest, for instance. In 1997 the BEA adopted the algebraically convenient assumption that all asset efficiencies decline geometrically over an infinite lifetime. This assumption has well-known empirical deficiencies, Harper 1982, 10, 30, Hulton 1990, 125. It also makes it impossible to calculate gross stocks at all because gross stock measures depend on the pattern of retirements, and infinitely lived assets never retire. Hence, the BEA can now only produce measures of net stocks. Chain weighting procedures have so far prevented researchers from producing alternate aggregate capital stock measures because there were no known accumulation rules which applied to chain aggregates. The derivation of generalized PIM accumulation rules in Appendix 6.5.v.3 removes this limitation. We will address the impact on the estimated path of the post-war capital stock of 3 types of modifications of the BEA assumptions, the effects of different initial values used in the generalized PIM accumulation rules, the effects of different retirement and depreciation patterns, and the effects of changes in scrapping rates in the face of the Great Depression of 1929 to 1939. As we will see, it is the latter which has the most dramatic effect on the trends and levels of the post-war capital stocks. Effects of alternate initial values. Appendix Table June 7, 13 lists 3 different 1925 values of current cost corporate net stock available in various BEA publications, with the latter two also expressed as percentages of the BEA 2011 initial value. Appendix Figure 6.7.5 illustrates the effects of alternate initial values, in 1925, for the GPIM accumulation rules, keeping the aggregate depreciation rate the same as in present-day net stock BEA estimates and sticking to the underlying BEA assumption that individual depreciation rates are entirely invariant to economic fluctuations. Only one-third of any initial difference in 19,225 remains in 1947, the 31% initial difference of the BEA 1993 starting point is reduced to a 10% difference by 1947, and the 21% initial difference of the SCB 1985 starting point is reduced to 7%. By 44 years, in 1969, both differences are less than 2%. This indicates that the starting point is not important for the long-run path of capital stock. But since all starting points end up on the same path in the long run, the lower initial values must grow faster to catch up with the common long-run path. In other words, lower starting points yield higher capital stock growth rates for a considerable length of time. This property turns out to have major consequences for the path of the post-war capital stock when we adjust for the effects of the Great Depression, see section 2.2.4. 2 Effects of alternate depreciation and retirement rates. Prior to 1997, the BEA assumed that different types of individual assets had different types of useful lives. This was superior to the current BEA assumption that assets are never scrapped. However, both methodologies suffer from the defect that depletion rates are assumed to be invariant to economic conditions, to which we will return in the next section. The earlier BEA data gives rise to aggregate useful lives and depreciation rates which vary somewhat over time, but since individual useful lives are assumed to be fixed, this aggregate variability is solely due to changes in the asset mix. We take these earlier aggregate retirement and depreciation rates up to 1997, project them into the present, and use them in equations, June 5, 22, and June 5, 23, to generate new estimates of chain aggregate gross and net stocks. In order to examine the pure effect of changes in depletion rates, all estimates begin from the initial value used by the BEA in its 2011 data set, Appendix Table 6.8b2. The starting point for the gross stock estimates is the same as for the net stock because we are interested here in the pure effects of changes in depletion rates. But in the final estimates presented in Appendix Table 6.8b, the gross stock initial point will be adjusted to account for the fact that gross stocks are larger than net stocks. Appendix Figure 6.7.5 compares corporate depreciation and retirement rates derived from the BEA 1993 data to the aggregate corporate depreciation rate implicit in current BEA data. We see that the earlier depreciation rate is higher than the present one. This is essentially because the earlier BEA calculations were based on finite useful lives for fixed assets, whereas the present BEA ones assume infinite useful lives. Of particular note is the fact that the earlier BEA retirement rate is far lower than either of these. It is in fact often lower than a particular critical value also shown on this chart. The significance of this value will be addressed in Appendix 6.7, Section 4. Appendix Figure 6.7.6 applies the new depreciation rate based on finite service lives to generate new current cost net capital stock measures for the corporate sector, all beginning from the initial value of the BEA 2011 corporate stock also shown in this figure. The new net stock estimates are generally lower than the current BEA ones, but the relative gap diminishes over time as the two converge. On the other hand, the new gross capital stock are larger than the modern BEA net stock estimates and grow faster over the post-war period. These two different patterns are clear when we look at the ratios of two new estimates to the present-day BEA stocks, as in Appendix Figure 6.7.7, the relative new net stock measure is fairly stable in the post-war period, while the relative gross stock measure continues to rise throughout. The analytical reason for this difference is addressed in the next section. 3. Digression on the algebra of the perpetual inventory method. The GPIM rules for current and constant cost capital stocks in equations, June 5, 22, and June 5, 23, are first-order difference equations. Since one can be derived from the other, it is sufficient to consider the properties of equation, June 5, 22, where in actual data, gross investment grows at a roughly constant rate, so we can take, where IG0 equals the initial value of gross investment at time t equals 0 and GI equals its average growth rate. In addition, at an empirical level constant and at first approximation we can take the depletion rate, as constant, which make constant. The GPIM rule for current cost stock then corresponds to a first-order difference equation with constant coefficients and an exponential forcing term, where such an equation has the general solution 11, in which both and are generally positive and constant for any given depletion rate z. The second term in the general solution rises exponentially because it is proportional to gross investment IGTY. But the first term is different, because it rises or falls according to weather. This is where the depletion rate plays a critical role, because as in the United States from 1947 to 2009, the average growth factor for the price of capital goods. From this point of view, any z 3.29% would make 12, in which case the first term in the general solution will decline continuously, leaving the second term to dominate the long path. Under these conditions, all initial values will converge to the same long-run path. This is the situation depicted in Appendix Figure 6.7.4 because the BEA 2011 depreciation used for that experiment lies between 5% and 8%. The BEA 1993 net stock depreciation rate is even higher, between 6.5% and 9.5%, so it would yield the same result. But the gross stock retirement rate is a different matter because it varies between 2.2% and 3.7%, so that it is below or near the critical value of 3.29% for most of the time, Appendix Figure 6.7.5. This, I would argue, is why the relative measure of the new gross current cost capital stock does not converge to the BEA net capital stock value within the 85-year time span from 1925 to 2009, whereas the relative measure of the new net current stock eventually does, Appendix Figures 6.7.6 and 6.7.7. The two corresponding long runs are different. Of course, empirical rates of depletion and of price change are variable, which makes the actual path somewhat more complicated. Nonetheless, the explanation for the difference in pattern lies in the structural parameters. With this in mind, we are ready for the final experiment, which is to allow for the impact of the Great Depression on the depletion rates of fixed capital. 4 effects on the capital stock of the Great Depression and World War II. Current BEA methodology assumes infinite service lives, which is why the earlier BEA methodology based on point estimates of actual useful lives is preferable. But both methodologies suffer from the fact that they assume that depletion rates are invariant to economic conditions. In this section, we examine the consequences of allowing for changes in depletion rates due to the cataclysmic events of the Great Depression and World War II. Here, we make use of the fact that historical stock estimates derived via the PIM are analogous to company book value data on capital stocks. The U.S. Historical Statistics of Income, Census 1975, Series V115, 924-926, contains data on the book value of net capital assets of all corporations derived from U.S. Internal Revenue Service, IRS, statistics. Net assets as defined there include land, but we can use them to estimate the path of the historical net capital stock. Appendix Figure 6.7.8 compares the movements of BEA 2011 historical net stock to that of IRS book value stock, each indexed to 100 in 1925. As one can see, the two behave very differently from 1925 to 1945, but move in similar ways thereafter. By 1947 the IRS book value index has risen by just 20%, whereas the BEA historical capital stock index has risen by 52%, Appendix Table 6.8.2.4. This difference is not surprising, given that the BEA measure is based on the assumption that scrapping of fixed capital is entirely independent of economic conditions. Since current and constant cost capital stocks are based on the same depreciation rates as historical stocks, we can adjust all three for the effects of the interwar period by multiplying them by the IRS book value index from 1925 to 1947 and reverting to the GPIM calculation in equations, June 5, 22, and June 5, 23, thereafter. This would bring the BEA historical cost measure into line with the IRS book value measure and would recalibrate the other two accordingly over the interwar period. In the latter case, this is the same as multiplying the adjusted historical cost capital stock by the ratio of current or constant cost capital stock to historical cost over this period. Appendix Figure 6.7.9 compares the official BEA 2011 measure of corporate net current cost to the adjusted measure. The latter starts out 28% lower in 1947 and hence grows faster until it ends up on more or less the same path as the official measure by 1977, see Appendix Table 6.8b.5. 5 final measures of U.S. corporate gross and net capital stocks. We can now create new estimates of gross and net capital stocks. The depletion, depreciation and retirement rates are taken from BEA 1993. So too are the initial values for each type of stock, because these are typically estimated on the basis of assumed depletion rates. The estimated capital stocks are then adjusted in the previously described manner to allow for the effects of the Great Depression and World War II. Appendix Figure June 7, 10 compares these final estimates to the corporate BEA 2011 current cost net stock. In comparison to official BEA net capital stock, KN Corp BEA, the new net stock measure, KN Corp, starts out lower in 1947 due to a combination of its lower initial value and the interwar effect, but then narrows the gap because it grows faster. The new gross stock measure, KN Corp, starts out higher than the official BEA net stock, but this is more than cancelled out by the interwar effect, so that by 1947 the former is 90% of the latter. However, the gross stock grows more rapidly than the official measure, so that by 2009 the former is 68% higher, see Appendix Table 6.8.2.5. 6 measures of corporate inventories. The remaining step is to estimate corporate inventories so as to add them to the adjusted gross current cost capital stock. NEPA has industry data on private industries, NEPA Table 5.8.5, but it is not by legal form. The Federal Reserve Board, FRB, flow of funds has current cost data on corporate inventories and capital stock but only for non-financial corporations. Point 13. However, the IRS publishes corporate balance sheets beginning in 1926 and these contain data on inventories, and from 1990 to 2011 also data on net historical capital stock. The IRS data is based on samples, so we cannot apply it directly to the NEPA corporate sector. The procedure therefore has 2 steps. First, estimation of the ratio of inventories to historical cost fixed capital for the whole period from 1947 to 2011. Second, rescale the implicit inventory levels to those of the corrected capital stocks in Appendix 6.8.2.5 by multiplying the preceding inventory by the ratio of adjusted historical to current cost fixed capital stock. On the first step, the ratio of the IRS net book value stock to the BEA net historical stock in 1990 to 2011 turns out to be essentially a linear function of time, so it was extrapolated back to 1949 to 1989 and then multiplied by BEA net historical stock to yield an estimate of the corresponding IRS book value stock. This is used to construct the IRS ratio of inventories to net book value over the whole period from 1947 to 2011, which completes the first step. Multiplying this ratio by the BEA corporate net historical stock essentially scales up IRS inventory levels to match NEPA data, which completes the second step. The resulting inventory stock is, like the original IRS data, a mixture of two valuation methods, at their historical cost at the time of acquisition, first in first out, FIFO, or at their current costs, last in first out, LIFO. Fixed capital, plant and equipment, is also an inventory, only of long-lived items. From that perspective, historical cost fixed capital corresponds to the FIFO methodology while current cost fixed capital corresponds to the LIFO one. But since inventory turnover is quite rapid relative to that of fixed capital, in comparison to fixed capital FIFO inventories as valued at fairly recent costs while LIFO ones are at current costs. In other words, inventories are closer to current cost than to historical cost capital stock, so we may directly add the estimated corporate inventory series to the current cost fixed capital stock derived in Appendix 6.8.2.6. 6. Measurement of capacity utilization. The autoregressive distributed lag, ADL, bounds testing approach developed by Pasaran, Shin, and Smith, 2001, was used to test for a long-run relationship between output and capital stock. Unlike the Engel, Granger co-integration method, the bounds testing approach is applicable regardless of whether the underlying regressors are purely I0, purely I1, mutually co-integrated or any combination of those. This is a considerable advantage given the low power of unit root tests and the relatively small size of our data for each country. The point of departure of the bounds testing method is an error correction model, ECM, to test for the existence of a co-integrating relationship between the lagged levels of the variables. Such a connection can be interpreted as a long-run relationship. It can be assumed to exist if one rejects the F statistic for the hypothesis that the coefficients of the lagged variable levels included in the ECM are jointly zero. Since the asymptotic distributions of both statistics are non-standard, Pasaran et al. 2001, provide two sets of asymptotic critical values for two polar cases which assume that all regressors are either purely I0, or purely I1. The critical values of all other possible cases fall between these two. If the estimated F statistic falls outside these critical value bounds, then a conclusive inference can be drawn without any need to know about the unit root properties of the regressors. On the other hand, if the estimated statistics fall within the critical value bounds, the inference is inconclusive and it would be necessary to establish knowledge of the unit root properties of the variables. The ECM to be tested explains the log of output, LNY, using its own and past values of the log of the capital stock, LNK, and can be written as where alpha is an unrestricted constant and t an unrestricted time trend that was included if its t statistics was significant at the 5% level. 14 The model can include dummy variables, DM. So as to determine which dummies to include, the squared values of the residuals were checked to identify any significantly large jumps which usually imply an outlier, Patterson 2195. The lag structures M and N were chosen using the AIC criterion because it tends to select a greater numbers of lags than the big and a sufficient number of lags is required. Eliminate serial correlation. 15. In order to test for the existence of a long-run relationship between LNY and LNK, the ECM was estimated via OLS and the null hypothesis was tested that, using table CI4 and CI3, in Pasaran, 2001, 300 to 301, for the model with and without a trend. 16 Rejection of the null hypothesis allows one to conclude that a long-run relationship exists. Since the bounds test requires the absence of serial correlation in the ECM, the data was previously tested for autocorrelation using the Briesk, Godfrey LM test. 17 In cases where the bounds F test statistic fell between the two critical values and implied an inconclusive result, we followed the Engel, Granger two-step procedure, investigated the order of integration of both time series and tested for the existence of a co-integrating relationship between them with Dickey, Fuller tests. Wherever it was possible to identify a co-integrating long-term relationship, we used the corresponding model. To obtain the coefficients of the long-run relation, where, and the coefficients, and were saved from the Ol's estimation of the model and used to calculate. The final step was to estimate LNY*, which we interpret as the log of capacity, LNU, by applying the imputed long-run relationship coefficients on the capital stock time series, and the dummies and time dimension. The co-integration-based estimate of capacity utilization was then obtained as previously depicted in Appendix Figure 6.6.1. Table June 7, 14 summarized the regression output. A comparison between new measure and the Federal Reserve Board measure, available from 1967, is presented in Chapter 6, Figure 6.4. 7 final measures of profit, capital, and the rate of profit. Appendix 6.7, Section I.2 established that the profit rate of the non-corporate sector, corrected for the wage equivalent of proprietors and partners, is close to the rate of the corporate sector. We are therefore justified in treating the corporate sector as representative. 4 new variables are relevant here: 1. Corporate value added adjusted for imputed net interest; 2. Corporate net operating surplus adjusted for imputed net interest, which makes it the same as corporate profit inclusive of net monetary interest paid, or what businesses call earnings before interest and taxes, EBIT. 3. Gross corporate current cost capital stock adjusted for the effects of the interwar period; and 4. The rate of capacity utilization, which is the ratio of actual output to normal capacity output. The ratio of the output to capital defines the maximum rate of profit, output, capital ratio, and that of profit to capital the average rate of profit. The corresponding BEA measures are in terms of official corporate value added, inclusive of imputed net interest, and corporate profit, relative to the official BEA corporate net capital stock. Each pair must be further adjusted for capacity utilization. Chapter 6, Section 8, reviews the derivation of the new output, value added, profit, capital, and capacity utilization measures developed in this appendix, presents and analyzes the resulting profitability patterns, and compares them to conventional measures. Table 6.22 in Chapter 6 summarizes the differences between the 1947 to 1982 Golden Age and the 1982 to 2011 neoliberal eras. Finally, it is noted that once the GPIM rules are understood, new measures of capital stock and capacity can easily be derived even at the industry level, and these two factors turn out to be sufficient to develop good proxies for the corrected measures even without adjustment for imputed interest or inventories. Chapter 6, Figure 6.6. Even more strikingly, it is found that the incremental rate of profit, the rate of return on new investment, which is so critical to the classical theory of intersectoral profit rate equalization, can be approximated to a high degree without having to make adjustments for imputed interest, inventories, or even capital stock retirement patterns. Chapter 6, Figure 6.7. The 1994 International Sectoral Database, ISDB, OECD 1994, contained annual data, now discontinued, from which it was possible to derive measures of gross operating surplus, that is, GDP minus indirect business taxes, net of subsidies, minus employee compensation, gross capital stock, and gross investment for various OECD countries. This was used to derive measures of average and incremental rates of profit by world industry. 1. In order to achieve comparability and consistency across countries and industries, the analysis was limited to the period 1970 to 1990 and focused on the profitability of 8 manufacturing industries: food, textiles, paper, chemicals, minerals, metals and metal products, machinery and equipment, other manufacturing products, across 8 countries: United States, Japan, Canada, Germany, France, Italy, Belgium, and Norway. World totals for gross operating surplus, gross capital stock, and gross investment were calculated for each industry, using PPP exchange rates to make the translation into US dollars. This data was then used to calculate average and incremental profit rates for each industry at the developed world level. Since the US BEA now only calculates net capital stock, the rate of profit on total capital is defined here as the ratio of nominal net profits, gross profits minus depreciation, to current cost net capital stock. On the other hand, since gross investment figures are widely available and are independent of the debatable assumptions needed to estimate capital stocks, the incremental rate of profit is defined as the ratio of the change in nominal gross profits to lagged nominal gross investment. Further details of the derivation and use of these and other relevant variables are listed in 1, 2, 6. 1. The basic flow variables were taken from the U.S. Bureau of Economic Analysis, BEA, Gross Domestic Product - GDP, by industry tables 1947 to 97 by &_VA_NAICS and 1998 to 2005 by &_VA_NAICS, available at http://www.bea.gov/industry/gdp by ind_data.htm. From these were calculated current gross value added, GVA, employee compensation, EC, gross operating surplus, GOES, to the price index for GVA, VAPI, which was used to create real GVA, GVAR, and employment data on full and part-time employees, FTPE, self-employed persons, SEP, and full-time equivalent employees, FE. All of these were available for 1987 to 2005 except SEP and FE, which were only available for 1998 to 2005. 2. For each sector a wage equivalent, WEQ, was calculated by applying the average full-time wage per worker, WEC/fee, to SEP, and the resulting value was subtracted from GOES to create gross profits, PG. This was done because the NEPA calculation of GOES implicitly treats all of the income of proprietors and partners, i.e., of self-employed persons, as profit-type income. Since SEP and fee were only available for 1998 to 2005, the 1987 ratios of fee/FTPE and PEP/FTPE were used along with 1987 to 1997 values of FTPE to fill in these earlier years. 3. Current cost capital stock, K, gross investment, IG, and current cost depreciation, DEP, for each sector, and the quantity index for net capital stock, KQI, were taken from the following BEA wealth tables, Table 3.1 ES. Current cost net stock of private fixed assets by industry, Table 3.4 ES. Current cost depreciation of private fixed assets by industry, and Table 3.7 ES. Historical cost investment in private fixed assets by industry, and Table 3.8 ES. Chain type quantity indexes for investment in private fixed assets by industry, all downloaded on November 8, 2007, last revised on August 8, 2007. The industries in the wealth tables were matched to those in the NEPA accounts, which required aggregating sectors 50 to 51 and 69 to 70 in the former tables. Real capital stocks, KR, were created by scaling up the quantity index using the base year, 2000, values of current cost stocks. 4. Imputed values for owner-occupied housing, O, were removed from the real estate industry values of GVA, space rent line 134 minus intermediate input line 135, GOES, GVA minus taxes net of subsidies, line 135 minus line 136, and DEP, line 140, there being no imputation made for EC, using NEPA Table 7.12. Imputations in the National Income and Product Accounts, Bureau of Economic Analysis, downloaded on November 4, 2007 at 12:55 and 31 seconds p.m., last revised on August 1, 2007. But whereas the BEA NEPA accounts now allocate all imputed values for O to the real estate sector, it still splits the wealth stock components of O imputations between farms and real estate, which had to be removed using Table 5.1. Current cost net stock of residential fixed assets by type of owner, legal form of organization, industry, and tenure group, lines 15 to 16, respectively. A similar adjustment was made for IG, using Table 5.7. Historical cost investment in residential fixed assets by type of owner, legal form of organization, industry, and tenure group, lines 15 to 16. 5 inventories were added to the capital stocks of manufacturing and wholesale/retail trade industries, using NEPA Table 1 Bulletin. Real manufacturing and trade inventories, http://www.bea.gov/national/NEPA___nepa_select_table.asp, and Table 2 AUI. Implicit price deflators for manufacturing and trade sales, both downloaded on November 8, 2007, last revised on February 3, 2004. The 1987 to 2005 average ratio of real inventories to real capital stock ratio in each sector was taken to be its normal ratio, and this was used in conjunction with annual real capital stocks to create annual normal inventories for each sector. These were then converted to current cost inventories using the implicit price deflators for manufacturing and trade sales. For the construction industry, data on inventories of materials and supplies was available from the 1992, 1997, 2002 Economic Census of Construction, Table 3. The value of construction work was available for establishments reporting inventories, reporting no inventories, and non-reporting. The ratio of the construction sales of the first 2 sets was used to split the last set into subcomponents with and without inventories. The inventory sales ratio of the first set was applied to the first subcomponent of the last set to estimate its inventory levels, and this was added to reported inventories to get an overall total. The average inventory/GVA ratio for 1992, 1997, and 2002, which was stable around 4%, was then used to define a normal ratio, and this was used to estimate annual normal inventory stocks in the construction sector. The same ratio was also applied to the sector's fixed investment in equipment and structures in order to estimate normal inventory investment. Total capital and investment were defined as the sums of their fixed and inventory components. In the insurance and related activities industry, total reserves were calculated as the sum of checkable deposits and currency, money market funds and security RPs in U.S. flow of funds tables L.116, property casualty insurance companies, lines 2 to 3, and L.117, life insurance companies, lines 2 to 3, downloaded January 8, 2008, 10:30 p.m. Since the ratio of reserves to net current cost capital declined over time and fluctuated from one year to the next, its normal level was defined by its exponential trend. This trend value was then applied to annual capital stocks to get the normal reserve stocks, and to annual investment flows to get the normal investment in reserves, the resulting figures being added to fixed capital stocks and investment to get total capital stock and investment. A similar procedure was followed for the banking and finance industry, which encompasses commercial banks, savings banks, and credit unions, with reserves defined as the sum of vault cash and currency, reserves at the Federal Reserve, banks' own checkable and time deposits and currency, but not that of their customers, and Fed funds and RPs, as taken from U.S. Flow of Funds Table L.109, lines 2 to 4, L.114, lines 2 to 5, and L.115, lines 2 to 4. 6. The NAICS data set has 61 individual private industries, plus an overall aggregate, all private industries, and several sub-aggregates such as total, durable, and non-durable manufacturing. Detailed descriptions of each industry are available online, Stat Canada 1997. Particular care was taken focus on industries that were dominated by profit-driven enterprises and were also competitive on a world scale. This led to the exclusion of 31 of the original 61 private industries, with a concomitant redefinition of the overall rate of profit and incremental rate of profit. The first set of industries was excluded if they were dominated by non-profit activities enterprises, example arts, museums, educational services, and social services, or if the available data on the wages of employees significantly understated the wage equivalent of the proprietors and partners, say as in the case of law firms or medical offices. Point 3 Such considerations applied to administrative and support services, ambulatory healthcare services, educational services, funds, and other financial vehicles, hospitals, and nursing and residential care facilities, other service except government, which include religion, grant-making, civic, professional and similar organizations, performing arts, spectator sports, museums and related activities, legal services, computer systems design and related services, and miscellaneous professional, scientific, and technical services, publishing industries, and social assistance. These sectors typically had either extremely low or negative profit rates, example educational services, or very high ones, example administrative and support services, and the various subsectors of professional, scientific, and technical services. Finally, another 18 industries were excluded because either their average or incremental rates of profit had period averages below 5%, several even had negative or near zero averages. Point 4 These were deemed internationally uncompetitive on a world scale. The full list of excluded industries is available in Shaikh, 2008, Appendix B. Appendix 9.1. Matrix Algebra of Classical Price Theory. In what follows, vectors and matrices will be denoted in bold. Let P, L, and denote 1xn, rho, vectors of prices, direct labor time, and integrated labor times with elements Pj, Lj, Vj, and denote nx1, column, vectors of gross and net outputs, respectively, where A equals the matrix of input, output coefficients, K equals the matrix of capital coefficients, the matrix of given depreciation coefficients, equals the matrix of integrated capital coefficients, and diagonal matrix with elements of some variable xj, all matrices being I. Competitive prices in simple commodity production. Let Yj equals the hourly incomes of producers in production activity J. Given that they work Lj hours per unit output, their total earnings per unit output are the difference between their selling prices and their materials and depreciation costs. Then if competition among producers equalizes their hourly labor income, competitive prices will be proportional to, vertically, integrated labor times, in which case prices will be proportional to integrated labor times. 2. Competitive prices in capitalist commodity production. Let W, R be the scalar wage and profit rates, respectively. Then the fixed capital price system, for sake of comparison with SRAF written with wages excluded from capital advanced, 1 is. Where and in the special case of a pure circulating capital model K equals A and. The preceding system consists of n equations in variables, n prices W, R. When the wage is 0, this reduces to, where P, R, is the all-positive dominant left eigenvector of H and the maximum rate of profit R is the reciprocal of the dominant eigenvalue of KT. When the wage, W, is positive, the relation between the wage rate, the profit rate, and relative prices is complicated by the fact that a chosen numeraire may contribute its own variations to all price ratios. SRAF shows that there is a standard commodity, sector, which need not vary in price as the wage changes, and that the wage in terms of the price of this standard commodity will then be a linear function of R/R for any given single product technology. Since the standard commodity is unique for viable single product systems, imposing this linear relation W equals 1, R/R on the price system in equations, 9.1.5, or, 9.1.6, is equivalent to selecting the standard commodity as numeraire, SRAF 1960, 30-32. Hence, the system of standard prices, prices expressed in terms of the standard commodity, can be written as the SRAF standard prices in equation, 9.1.7, are implicitly in labor units, since P, 0, equals V. Then the three components on the right-hand side of equation, 9.1.7, can be given familiar interpretations. The first component is the Ricardian term, the total labor requirements, labor value, vector. The first two components can in turn be viewed as the Marxian term, within a Sraffian context, the vertically integrated equivalent of Marx's transformation procedure. This is the sum of labor values V and price value deviations, the size of the latter being dependent on the rate of profit and on the degree to which industry vertically integrated organic compositions differ from the average, i.e., standard, composition. Point 2. Finally, the third component is the Wicksell, Sraffa term, P, R, V, KT, which represents the feedback effects of standard price value deviations on the prices of means of production. These feedback effects are central to Sraffa's analysis. 3 properties of integrated output, capital ratios. It useful to express the JTH price as where vertically integrated output, capital ratio, which is a function of R. Sraffa tells us that each output, capital ratio VR, R, J starts from a particular value which is specific to the industry at R equals 0, and each then converges to the common ratio R at R equals R, Sraffa 1960, 17. This is evident from the price system in equation 9.1.7 at R equals 0, P, R, equals V. So the JTH labor value of the vertically integrated output, capital ratio is, where KT is the JTH column of the total capital coefficients matrix KT, so that represents the labor value of the total input requirement per unit output, i.e., vertically integrated constant capital per unit output. On the other hand, at W equals 0, R equals R, and the price system reduces to, so that the JTH vertically integrated output, capital ratio is, which is the same for all industries and is also the labor value of net output, capital ratio, i.e., the living labor, dead labor ratio, in the standard sector. Point 3. If the individual industry output, capital ratios proceed smoothly from their individual initial values at R equals 0 to their common value R at R equals R, standard prices will deviate smoothly from values. But if, as Sraffa appears to suggest, industry output, capital ratios cross back and forth with R before arriving at their common limit, R, then the corresponding industry standard prices will follow complicated paths. 4. Aggregate wage, profit curves. To derive the aggregate wage, profit curve, multiply the price system in equation 9.1.6 by the net output vector Y to get. The first term is simply aggregate value added evaluated at prices of production. Given the definitions, and total employment, the second term is simply the total wage bill. And the third term is aggregate profit, the product of the profit rate and the aggregate capital stock. Where the aggregate capital stock evaluated at prices of production. Then we can write the actual wage share as where R is a weighted average of individual integrated output, capital ratios. This is a convex combination of the weighted average of the integrated output, capital ratios VR, R, J, since the weights sum to 1. The empirical finding that industry integrated output capital ratios are virtually linear implies their weighted average R will be almost exactly linear. In that case, both the numerator and denominator in equation, September 1, 10, will be linear functions of R, so that the actual wage, profit curve will be a rectangular hyperbola. The closer the initial, labor, value of the aggregate output, capital ratio is to, labor, value of the standard industry ratio, R, the less it will vary and the more linear the aggregate wage share curve will be. 4. V eigenvalues and the linearity of standard price. The matrix KT in equation 9.1.6 is semi-positive. Since is strictly positive and K is semi-positive, it may have many zero rows because only some goods enter into the capital stock. If all the eigenvalues are distinct, we can reduce the matrix to diagonal form. Let Q equals PR1, PR2, Prn be the matrix whose rows are the row eigenvectors Prk. Then Q, xs1, xs2, xs1, is the matrix with columns that consist of the eigenvectors xsk, and that QKTQB diagonal matrix of the eigenvalues, Lancaster 1968, 287 to 288. The dominant eigenvalue is positive, and the corresponding row and column eigenvectors PR1, xs1 are strictly positive. From equation 9.1.6, we can see that the price of production at is given by, so is the dominant eigenvalue and P, R, equals PR1 is the dominant, left-hand, eigenvector of KT. A similar relation can be established as where the right-hand column vector can be interpreted as the gross output vector of the standard system. Applying this to the basic price of production system of equation 9.1.6, and noting that I equals QQN because the dominant eigenvalue yields. The columns of Q represent column eigenvectors xsk, and since these are only determined up to their proportions, we are free to normalize them by. Since Q is the matrix whose rows are the eigenvectors Prk, we get. But we know from equation 9.1.7 that at, so. Combining equations, September 1st, 17, and September 1st, 18, denoting and recalling that equals 1/r yields. It was noted in the discussion of the expanded equation, 9.1.7, that SRAFA prices of production are linear, as in Marx's initial transformation of labor values, if the Wick cell, SRAFA feedback vector R, P, R, V, KT0. Utilizing equation, September 1st, 19, and recalling from equation, September 1st, 12, that we can express the Wick cell, SRAFA feedback effect as. So now we can see that the feedback effect will be small and hence prices of production will be approximately linear if I, 0, i.e., at profit rates which are low relative to the maximum rate. The profit rate R is the ratio of total profit to total capital, and the maximum rate of profit R is the ratio of value added, maximum profit, to total capital, so, R/R, is the profit share in value added. Observed profit shares are on the order of 0.30, so we may expect that prices of production calculated at the observed profit rate will be dominated by the linear, Marx, component. 2, but remain distinct as required for equation, September 1st, 14, which means that all subdominant eigenvalues are small. This corresponds to similar structures of coefficients in each industry column of the vertically integrated capital coefficients matrix KT, although capital, output ratios can differ if columns have different means, scaffold 2010, 20, and capital, labor ratios can differ since in any case the labor coefficients differ across industries. Such a condition follows from the random matrix hypothesis of Brody, 1997, and scaffold, 2010, in which the distribution of elements in columns, and rows, becomes increasingly similar, albeit with different means, as the matrix size so that the subdominant eigenvalues. Appendix 9.2. Sources and methods for Chapter 9. Data sources and list of industries 1998. The following data was taken from the U.S. Bureau of Economics, http://www.bea.gov/idable/index_industry_io.cfm, industry by industry 65 order total requirements input, output tables after redefinitions designed to match commodity flows to industries, the vector of direct sectoral wage bills constructed from the employee compensation portions of value-added flows in the use tables after redefinitions, and the market values of industry gross outputs from the same use tables. All data is available for 1997 to 2009, but here we use 1998 to illustrate the general patterns. Industry list: 1 farms, 2 forestry, fishing, and related activities, 3 oil and gas extraction, 4 mining, except oil and gas, 5 support activities for mining, 6 utilities, 7 construction, 8 wood products, 9 non-metallic mineral products, 10 primary metals, 11 fabricated metal products, 12 machinery, 13 computer and electronic products, 14 electrical equipment, appliances and components, 15 motor vehicles, bodies and trailers, and parts, 16 other transportation equipment, 17 furniture and related products, 18 miscellaneous manufacturing, 19 food and beverage and tobacco products, 20 textile mills and textile product mills, 21 apparel and leather and allied products, 22 paper products, 23 printing and related support activities, 24 petroleum and coal products, 25 chemical products, 26 plastics and rubber products, 27 wholesale trade, 28 retail trade, 29 air transportation, 30 rail transportation, 31 water transportation, 32 truck transportation, 33 transit and ground passenger transportation, 34 pipeline transportation, 35 other transportation and support activities, 36 warehousing and storage, 37 publishing industries, include software, 38 motion picture and sound recording industries, 39 broadcasting and telecommunications, 40 information and data processing services, 41 Federal Reserve banks, credit intermediation and related activities, 42 securities, commodity contracts and investments, 43 insurance carriers and related activities, 44 funds, trusts, and other financial vehicles, 45 real estate, 46 rental and leasing services and lessors of intangible assets, 47 legal services, 48 computer systems design and related services, 49 miscellaneous professional, scientific, and technical services, 50 management of companies and enterprises, 51 administrative and support services, 52 waste management and remediation services, 53 educational services, 54 ambulatory healthcare services, 55 hospitals and nursing and residential care facilities, 56 social assistance, 57 performing arts, spectator sports, museums and related activities, 58 amusements, gambling and recreation industries, 59 accommodation, 60 food services and drinking places, 61 other services, except government, 62 federal general government, 63 federal government enterprises, 64 state and local general government, 65 state and local government enterprises. 2 Correction for Owner-Occupied Housing, O. 1998. The input, output matrix and the gross output vector incorporate entries for a fictitious real estate sub-industry because the BEA treats private homeowners as businesses renting out their own homes to themselves. Meyerhauser and Reinsdorf 2007. The B's addition of the imputed rental value of owner-occupied housing doubles the listed gross output of the real estate sector, just as its addition of the imputed maintenance and repair costs of owner-occupied housing raises the listed intermediate inputs of the real estate sector by 50%. On the other hand, no addition is made to employee compensation because homeowners are not considered to pay wages to themselves. 1 These imputations raise total real estate market price and intermediate input but not the corresponding labor requirements, thereby greatly enhancing the deviation between this industry's market price and its corresponding labor values and prices of production. Removing the imputations brings us back to a more representative picture of actual real estate transactions. 2 corrections are necessary. First, we reduce real estate gross output by the imputed gross output of owner-occupied housing, which is equivalent to dividing the original input-output coefficients in the real estate sector column by the ratio, x, of non-imputed gross output to originally listed gross output. Second, in order to remove home maintenance and repair expenditures from this column, we multiply its coefficients by the aggregate ratio, a, of non-imputed intermediate input total to the originally listed intermediate total. The aggregate ratio is used, since we have no information on the detailed distribution of these imputed expenditures. The combination of the 2 steps amounts to multiplying the whole real estate sector column by input, Output tables and labor coefficients for 1947 to 1972 were taken from Shaikh, 1998a, as compiled in Ochoa 1984. These tables were rebalanced to exclude the real estate sector, the great bulk of which is from Ochoa 1984, 252. 3 calculations. The total requirements matrix published by the USBEA is where is a 65-order identity matrix, from which we can derive the direct requirements input-output matrix. The JTH component of the wage bill vector is where the average wage in the JTH sector and the total employment in the JTH sector. This is used to derive the JTH component of the labor coefficients vectors as, where employment per unit gross output, and the JTH sector wage rate relative to the economy-wide wage rate W. The variable is treated as a rough index of relative skills, so that may be considered the skill-adjusted labor coefficient of the JTH sector. The economy-wide wage rate W for 1998 was derived from NEPA tables as the ratio of aggregate employee compensation, Table 1.10, Line 2, and aggregate employment, full and part-time, Table 6.4d. Point 2. It is important to note that while theoretical matrices are in terms of physical quantities, empirical matrices involve market prices. Since is a similarity transform of A, it has the same eigenvalues as A. If we designate as the market price of a unit of output of the JTH sector, then, whereas these two sets are easily related through the diagonal matrix of market prices, then we can show that the empirical equivalents of the theoretical variables are the ratios of these variables to unit market prices, Shaikh 1984b, Appendix B, 82-82. As noted in Appendix 9.1 in the discussion of equations, 9.1.6, and 9.1.7, the maximum rate of profit R is the reciprocal of the dominant eigenvalue of VRJ, were calculated as in equations 9.1.8, September 1, 11, in that same appendix. All of these being ratios of price terms, the market price elements in cancel out. Finally, profit is defined as the difference between value added, VA, and employee compensation, EC, indirect business taxes, IBT, and depreciation, D. In the pure circulating model, the stock of capital is assumed to be equal to the flow of material costs and depreciation is assumed to be zero. See the discussion in Appendix 9.1 of Equation 9.1.6. For construction of capital stock and depreciation matrices. The consideration of fixed capital in the calculation of prices of production requires matrices of capital stock and depreciation flow. Since capital stock figures represent end-of-year figures, the beginning-of-year stocks needed in, say, the 1998 price equations would come from 1997. The BEA only publishes the total value of net capital stock and depreciation flows in any given year for each of 65 industries, which yields a 65-element vector for each of these variables in any given year. The only available data on the composition of fixed assets appears in the form of capital flow, gross investment, matrices in benchmark years, in which each column displays the different asset types which enter into an industry's gross investment. For capital stocks, each asset type in a given industry's capital stock is assumed to grow at the same gross rate of growth, retirement and expansion, as the total net stock of the industry. This implies that for any industry the proportions of asset types in net stock are the same as those in gross investment, that is, the capital flows, gross investment, and capital stock columns for a given industry have the same proportions. We can therefore use the data on the former to derive the proportions of each asset type in the industry's capital stock and multiply these by the industry's total net stock to derive the industry column of the capital stock matrix. For depreciation, it is assumed that the depreciation rate of an asset type is the same regardless of the industry in which it is used. This implies that the rows of the depreciation matrix are proportional to the rows of the capital stock matrix. The capital stock procedure turns out to be the same as in Ochoa, but the depreciation procedure is not, since he assumes that depreciation columns are proportional to gross investment flow columns, Ochoa 1984, 234 to 235, 242. The theory and empirical methods are elaborated next. 1. Theoretical procedures for constructing capital stock and depreciation flows matrices. In Industry J, value of aggregate capital stock, value of gross investment, and the gross rate of growth of the industry, so that the gross rate of growth is the retirement rate plus the net expansion rate. So if an industry is expanding at, say, 3% and has an average retirement rate of, say, 2%, its gross rate of growth is 5%. Individual machines in the industry's capital stock may have gross rates of growth which are different from the industry average. If we can assume that these differences are small, we can estimate each component of Industry J's capital stock by dividing each corresponding gross investment component by the industry's growth rate. Then for asset types H, I in the JTH column of capital stock matrix, and, so that is, the JTH column in the capital stock matrix has the same proportions as that in the capital flows matrix. On the issue of depreciation, it seems plausible to assume that each type of capital asset depreciates at roughly the same rate regardless of which industry it is used in. Let the capital stocks of the ith asset type used in Industry J and K, respectively, with corresponding depreciation flows and common depreciation rate. Then and so that is, the row elements in the depreciation matrix have the same proportions as those in the previously calculated capital stock matrix. Finally, the capital and depreciation coefficient matrices are calculated by dividing the column elements by industry gross outputs. 2. Empirical procedures for constructing capital stock and depreciation flows matrices. Data for total capital stock and total depreciation for private industries in each given year from fixed asset tables 3.1 ES, current cost net stock of private fixed assets by industry, and 3.4 ES, current cost depreciation of private fixed assets by industry, and these were mapped into the 61 industries appearing in BEA input-output tables. The remaining 4 industries in the latter tables are federal and state/local general government and federal and state/local enterprises. Depreciation totals for these industries are available in NEPA Table 7.5, Consumption of Fixed Capital by Legal Form of Organization and Type of Income, lines 23 to 24, 26 to 27, respectively. Current cost net capital stock industry totals are available in Fixed Asset Table 7.1b, Current cost net stock of government fixed assets, for federal, state/local, general government, and government enterprises in lines 18, 46, 63, and 66, respectively. In order to disaggregate these into the 4 government categories in the input-output tables, it is necessary to assume one relation among the 4 elements. I assume that the ratio of the net stock of federal government enterprises to total federal net stock is the same as the corresponding ratio of gross investment, the latter being available from NEPA Table 5.8.5a, b as the ratio of line 58 to line 2.3. Private industry capital flows, gross investment, matrices are available in benchmark years such as 1997 with 180 commodity rows, plus a row of column sums, and 123 industry columns. Government is not shown. The first step is to aggregate these into a matrix of industries. Point 4. This is then supplemented by adding 4 government rows, all 0 since government is not a producer of capital goods, and 4 government columns of capital flows. Investment by asset type for federal and state/local government is available http://www.bea.gov/industry/xls/annual_reDefinitions_before_redefintions_199852010.xls in which total federal is the sum of columns and total state/local is the sum of columns and 5. The next step is to split each of these 2 columns into general government and government enterprises, which is done by using appropriate investment ratios derived from NEPA Tables 5.8.5a, b. Finally, the full industry-by-industry capital flows matrix is normalized by dividing all industry elements by their total so as to obtain capital flow proportions, which are then utilized along with the total capital stock and depreciation vectors to derive corresponding 65-order matrices in the manner outlined in section I. V. Construction of real wage curves 1947 to 1998. As shown in section 9 of chapter 9, we can create real wage curves by multiplying each year's actual wage share curve by a productivity index taken from the Penn World Tables, real GDP per worker in PPP terms, RGPWOC, converted to an index, 1950 to 2010. For 1947, the 1950 ratio was multiplied by the 1947 to 1950 ratio of the NBER index of output/labor, taken from BEA 1966, Series A 163, 209. Appendix 10.1. Incremental rates of profit for banking and for all private industry were previously derived in Appendix 7.2. Data for 3-month CD rates was from the U.S. Federal Reserve, historical data H15, selected interest rates at http://www.federalreserve.gov, while data on the discount, federal funds, 3-month T-bill, high-grade municipal bonds, and corporate AAA bond rates is from the 2012 Economic Report of the President, U.S. Department of Commerce, Bureau of Economic Analysis, http://www.gpo.gov. The source of the prime rate is listed above, while the business profit rate was derived in Appendix 6.7, Appendix Table 6.7.4 and calculated in Appendix 6.8.I.3. The long bond yield was created by splicing together two long series. The railroad bond yield from 1857 to 1937 was annualized monthly data on American bond yields taken from Macaulay 1938, Appendix Table 10, A142, A161, and made available in the NBER historical database at http://www.northbyestar.org/databases/macrohistory/rec data/13/m13019.dat. The corporate bond AAA yield for 1936 to 2002 was from the many historical statistics taken from the Federal Reserve HS 39 and supplemented for 2003. 2010 from the previously cited Economic Report of the President. The composite long bond yield was created by splicing the railroad bond rate to the corporate rate using the 1919 to 1937 average ratio of the latter to the former to rescale the former. The U.S. Producer Price Index, Wholesale Price Index, for 1857 to 1976 is from Jastrom 1977, 145 to 146, Table 7, and updated thereafter from the BLS using growth rates of the PPI. The corporate yield is the previously described long bond yield, and the 10-year government bond yield and the dividend yield, calculated as the ratio of dividends to stock prices, are from Schiller, 2014, at http://www.econ.yale.edu/tilde/schiller/data.htm, based on his annual long-term data on the S&P Composite Stock Price Index from 1871 onward. This series appears on his website under Long-Term Stock, Bond, Interest Rate, and Consumption Data since 1871, which is an update of Chapter 26 from his book Market Volatility, 1989. Rates of return on large company stocks and long-term corporate and government bonds for 1926 to 2003 are from Ibbotson, 2004, 30 to 31, Table 2 to 2. I thank David Stubbs for having updated these to 2010. The current cost, real, equity rate of return uses stock price, and dividend, DV, data from Schiller, 2014, converted to real terms, PREC, VREC, using the BEA gross investment deflator in Appendix Table 6.8.2.7 and calculated according to the formula in. The current corporate incremental rate of profit is calculated as the change in real net operating surplus, NEPA profit plus monetary interest paid by the non-financial sector, divided by real gross investment in fixed capital and inventories, and its NEPA proxy is calculated as the ratio of the change in gross NEPA profits to BEA real gross investment, as described in Chapter 6, Section 8, derived in Chapter 7, Section 6.4, and calculated in Appendix 6.8.2.7. Shiller's constant discount rate of 7.6% is from Shiller 2014, 10. The corporate current equity rate of return was described for Figure 10.11, and the average corporate rate of profit is the ratio current cost net operating surplus adjusted for interest imputation, and the corrected current cost capital stock as described in Chapter 6, Section 8, and calculated in Appendix 6.8.2.7. Figure 10.13. The actual real stock price is Shiller's nominal price deflated by the BEA gross investment deflator as described for Figure 10.11. The classical warranted price was derived in Chapter 10, Section 6, according to the formula in Equation 10.31, in the context of Shiller's critique of the efficient market hypothesis and calculated using real variables in the spreadsheet in Appendix 10.2. Data tables for Chapter 10, Sheet DAT Intraprice. Shiller's own rational stock price is from his website, http://www.econ.yale.edu/tilde/shiller/data.htm, in long-term stock, bond, interest rate, and consumption data under the name P*, present value of real dividends, const R. Since this was in terms of his CPI index, it was converted to nominal terms and then deflated by the BEA gross investment deflator described under Figure 10.11, so as to make it compatible with my own real variables. All data is in the Excel file Appendix 10.2. Data tables for Chapter 10, available online at http://www.anwarshikhecon.org. Appendix 11.1. Data sources and methods for Chapter 11. I coverage. 1960 to 2009, all index numbers, Australia, Belgium, Canada, Denmark, Finland, France, Germany, Italy, Japan, Republic of Korea, Netherlands, Norway, Spain, Sweden, United Kingdom, and United States. 2 raw data. CPI, ULC, PMFG, PPI, E, X plus M, int rate, rel GDPR. Consumer Price Index, CPI US Bureau of Labor Statistics, BLS, Division of International Labor Comparisons, August 18, 2011, CPI derived as the ratio of unit labor costs to real unit labor costs in local currency from Tables 7 and 13, respectively. Missing values for Australia 1960-1989, Spain 1960-78, and Korea for 1970-1984 were taken from BLS Supplementary Table 1, Consumer Price Indexes, CPI, 16 countries, 1950-2009, 1982-84 equals 100, Rebus to 2002 equals 100, Korea from 1960 to 1969 was set equal to the 1970 value. Unit labor costs, ULC unit labor cost in manufacturing is from BLS, International Comparisons of Manufacturing, Table 9, Unit labor costs in manufacturing, national currency basis, 19 countries or areas, 1950 to 2009. Missing data for Korea 1960 to 1969 were set equal to the 1970 value. For Spain, 1960 to 1963 was set equal to the 1964 value, and 1964 to 1978 were taken from Roman, 1997. Data for Australia was also missing for 1960 to 1989, so it was proxied for these years by the ratio of aggregate employee compensation to GDP, http://www.abs.gov.au/ausstat/abs@nsf/details page. This tracks actual unit labor costs in the years after 1989. Producer Price Index, PPI from the World Bank, World Development Indicators 2010. Missing values for Australia 1960 to 1989 were estimated by multiplying the corresponding CPI by the average ratio of from 1990 to 2009, and for Korea 1960 to 1969 values were set equal to the 1971 index of the nominal exchange rate, foreign currency/dollar, from BLS International Comparisons of Manufacturing, Table 11, Exchange Rates, Value of Foreign Currency Relative to US Dollar, 19 countries or areas, 1950 to 2009, 2002 equals 100. Sum of exports and imports, from the International Monetary Fund, IMF, International Financial Statistics, IFS, exports and imports in US dollars. Missing values for Belgium for 1960 to 1992 were taken from Amico database, http://ec.europa.eu/economy_finance/amico, imports, UMGS, and exports, UXGS, in current prices and units, which were then converted to US dollars using the exchange rate, XNE, in terms of US dollars per nominal interest rate, int rate 3-month Treasury bills, compiled from the IMF, IFSY, Statistical Office publications and central bank bulletins for 1960 to 1967, and from the OECD, 1968 to 2009. 3 calculations for Japan and United States. Trade weights for a given country in a given year were calculated as the sum of exports and imports of the country over the sum of all exports and imports of all countries in our sample. These were used for the United States and Japan to calculate in each year the variables in equation 11.16 of the text, where the producer price index of a country, the producer price index of its trading partners, and the exchange rate of the country vis-a-vis its trading partners, and where are proxies for the vertically integrated real unit labor costs of a country and its trading partners. We use direct real unit labor costs and due to lack of data on vertically integrated costs. Given that the price data involves index numbers whose scale is arbitrarily defined by the base year, the real unit labor cost variable was rescaled to have the same period average as the real exchange rate. This facilitates visual comparison but, of course, has no effect on the econometric tests, and are adjustments for the difference between non-tradable and tradable goods. In all cases, trading partner variables such as and so on are calculated as geometric averages of individual for all countries using THIRD-WORLDISM. In effect, each country is compared to the geometric average of all the others in the sample. This same procedure was also applied to interest rates in order to calculate the nominal and real interest rate differentials, using percentage changes in PPI. For each country, nominal interest rate differential equals domestic nominal interest rate, foreign nominal interest rate, and real interest rate differential domestic real interest rate, foreign real interest rate. 4 econometric procedures. In order to test for the existence of a long-run relationship between the real exchange rate and relative unit labor costs, we deployed the bounce test ARDL approach, Pasaran, Shin, and Smith 2001, using Microfit 5.0, Pasaran and Pasaran, 2009. The main advantage of this method is that it does not require prior unit root testing. There are 2 steps in the ARDL method. In the first step, an F-test is used to investigate the possibility of a long-run relationship between the variables in an error correction model, ECM. Consider the following ECM for a bivariate system involving 2 variables y and then if and the ECM is. This ECM should be free of serial correlation. The framework tests the null hypothesis, which is the non-existence of a long-run relationship between the variables, against the alternative hypothesis. A significant F statistic for the joint significance of n permits us to reject the null hypothesis and conclude that there is a long-run relationship. Pasaran et al. Have computed approximated critical values of the F statistic. There are 2 sets of critical values, of which one set assumes that all the variables are while the other one assumes that all the variables are if the computed F statistic falls outside this band, a definite conclusion can be reached regarding the existence or non-existence of a long-run relationship. If the F statistic is greater than the upper bound, at some level of significance, then we can reject the null of the non-existence of a long-run relationship between Y and X. In addition, as Pasaran, Shin, and Smith, 2001, and Pasaran, 2009, argue, a significant F statistic also shows the existence of long-run forcing relationship which identifies which variable explains variations of the other one. Consequently, in the tests below we carry out the F test by making first the real exchange rate and then relative unit labor costs the dependent variable. Once a long-run relationship has been shown to exist, the next step is to estimate the long-run coefficients from the underlying ARDL relationship along with the error correction coefficient from the associated error correction mechanism. The appropriate lag length of this ARDL is chosen by using the Akaika information criterion as Pasaran and Pasaran, 2009, 463 to 465, show an ARDL equation has embedded it an error correction mechanism, ECM, that relates the dependent variable to all the predetermined variables. From this ECM one can read off the coefficients that pertain to the hypothesized co-integrating relationship, i.e., the real exchange rate and relative unit labor costs. It will be recalled that the F test was carried out on the non-existence of a long-run relationship involving these two variables only. 1 variables. And, the natural logs of real exchange rate, relative unit labor cost, and the real interest rate differentials for Japan and the United States, respectively. INPT is the regression intercept, and delta next to a variable signifies its first difference. To Japan. We estimated a conditional ECM with as the dependent variable, see table 11.1, using dummies, and, for 1979, 1993, 1999, and 2006 to 2009, respectively. In the interest of parsimony, we used a lag length of 1 on the conditional there was no serial correlation in the conditional ECM, the Lagrange multiplier statistic and the F statistic. The first step of the test yielded an F statistic of which exceeded the critical bounds values of at the 99% level, for 2. In the conditional if the RULC-JAPE is made the dependent variable the F statistic is 5.5, which puts it in the indeterminate range at the 95% when the bounds are this provided the strong conclusion that there is not only a long-run relationship between the two variables but also that relative unit labor costs act as the long-run forcing variable, Pasaran and Pasaran 2009, 310, that drives the real exchange rate. The microfit 5.0 tables on this step are omitted to save space. Tables 11.1.1, 11.1.4 show the final ECM and associated long-run coefficients selected via the AIC.